perfectly great for the world, too. Fred Kemp, thank you.
Thank you.
All right, for playing along. All right, Tim.
Coming up, public health groups filing a new suit against HHS Secretary Kennedy over new vaccine policies. We've got the details next. And as we head to break, check out shares of Circle. Mizuho Securities initiating coverage of the stock with an underperform rating. Price target of $85. That represents a 59% decline from yesterday's close and is significantly below the average analyst target of around 200. We'll be right back.
Oh man, charge up my phone.
Get it done.
Organizations that represent pediatricians and public health experts have sued HHS Secretary Robert F. Kennedy Jr. over his decision to change government recommendations on COVID shots for healthy children and pregnant women. They're challenging Kennedy's decision, calling it arbitrary and a violation of the legal structure set up by Congress for vaccine recommendations. On May 27th, Kennedy announced that the federal government would no longer recommend COVID vaccines for those populations. Agency websites were updated days later. Typically, such changes are reviewed and recommended by an outside panel of vaccine advisors. In this case, Secretary Kennedy bypassed that panel and later fired all of its existing members and replaced them.
Coming up, the CEO of Natera will join us on the company's cancer detection technology. That's next. And later, White House economic advisor Stephen Myron will be our special guest in the 8 a.m. Hour. Sparkbox coming right back.
You're fired.
B+.
Advances in detecting cancer recurrence earlier and more accurately are transforming how the disease is treated and monitored. One of the companies on the leading edge is Natera. Joining us now, Natera CEO Steve Chapman. The company is celebrating 10 years since going public on the NASDAQ, and you got a real market cap at this point, and some really good, not only peer-reviewed research. You've got a product. I think did you have a profit or at least cash flow positive at this point?
Yeah, cash flow positive.
Yeah.
Yep.
But a market cap, what's your market cap right now?
Yeah, we're about $22 billion market cap.
22 billion.
Yep.
Mostly on this one compound, this one technique that you do. Can you explain it and what it's called?
Yeah, so Natera is a market-leading genetic testing company. We specialize in looking at extremely tiny quantities of DNA. We deployed that across 3 areas of healthcare. The first is in cancer, where we can detect cancer recurrence up to 2 years in advance of imaging. The second is in organ health, where we can detect organ rejection ahead of biopsy. And then the third is in prenatal care, reproductive health care, where we can detect abnormalities in pregnancy as early as 9 weeks.
So someone gets colon cancer. So then
Yep.
they detect it, they go through whatever intervention their doctors think is appropriate. They try to remove it. They use chemo. They might even use some new therapy. So you don't know whether it's gone. So you're waiting around, and if you have that horrible news a year later that it's recurring usually from imaging. So you've got something that's called Signatera, and it's specialized for each patient. So how does that work? You look at what their normal cells would do and what the genetic imprint of that normal cell is, and then you compare it to, you take a piece of their tumor and sequence it, right?
Yeah, exactly. So one of the biggest problems with cancer care is disease recurrence. So about 20 to 50% of patients will have disease recurrence in their lifetime. So what we do is we look for tiny fragments of tumor DNA that are circulating around in the patient's blood. And to do that, we make a unique test for each patient. So we do an entire sequence of the genetic tumor, either the whole exome or the whole genome. We find a signature that's unique just for that patient. And then we make an assay that can be used in the blood that looks for that unique signature. So from a simple blood draw, we can detect cancer recurrence up to 2 years in advance of imaging, or after the doctor's done everything they can possibly do to get rid of the cancer from the body. We can do a blood draw and we can tell whether there's still tiny fragments of DNA there.
Do you compare the mutations that this person's tumor has to a norm? Is there a standard of what it's supposed to look like, or
Yep.
is it? There is.
Yeah.
So you use a standard of what a normal, healthy person has, and then you take the tumor of a person who has colon cancer, and you find these little, it could be a single point mutation.
Yeah, exactly. So what we do is we sequence the entire tumor, and then we also sequence the patient's germline DNA, and then we look for
Somatic
differences
cells, yeah.
between the somatic and the germline DNA. So the DNA from your blood, from your body, compared against the DNA from the tumor, and then we also have historical data on
Okay.
what genetic information should look like, and we can see what variants are driving the cancer.
How much do these tests cost, and are they covered by insurance?
Yeah, so we follow standard billing and reimbursement guidelines. We're in network with the vast majority of the insurance plans. So in the vast majority of the cases, the patients don't owe anything out of pocket, but they may owe a copay or deductible, which is usually a few $100s. Sometimes if they haven't met their deductible, they could owe more, but we have patient assistance programs and financial hardship programs.
So 12 million tests processed so far. What's your total addressable market at this
Right.
point?
Yeah, so we think overall, when you look at the broad portfolio of tests that we're doing, it's around $50 billion. So if you look just at the MRD segment, which is Signatera, and the oncology section, it's around $20 billion. These are very large, unpenetrated markets that we're operating in with very significant unmet clinical needs.
It's not really a therapeutic that you're trying to accomplish here. You're just trying to find it so early that then you could do some intervention. So it's not a panacea, I don't think, but it certainly gives doctors much greater tools. If you knew 2 years before an imaging would show it, you'd keep up whatever treatment you're doing, or be on the lookout, or is that why survival rates are boosted?
Yeah, I mean, that's exactly right. We're telling you one simple question, which is whether there's tumor DNA in your blood or not. And that's used in 3 ways. The first is after surgery with curative intent. The doctor's done everything they can to get rid of the tumor. Is there still a tumor present? And if there is, they may give you more chemotherapy or they may change the chemotherapy. So that's the first. The second is in surveillance, looking for disease recurrence. So we said earlier 20 to 50% of patients have disease recurrence. We can do quarterly blood draws and we can detect disease recurrence. Now in the future, what's going to happen is pharmaceutical companies will be able to treat the patient just simply on molecular relapse. So rather than waiting until the cancer's recurred clinically and become stronger, they'll treat the patient immediately on seeing just that simple molecular relapse. We're already showing data on that. And then the last is patients that are with cancer, very sick patients, we can actually use Signatera to tell whether their therapy is working or not. So if the therapy is not working,
Right.
we see
It might not be any walk in the park, the therapy. That it'd be nice if it wasn't working. You certainly don't want a lot of that chemo. So you couldn't have done this in 20 years ago. I know the resolution for you to be able to quickly sequence something that small in terms of the size of the DNA for a single point mutation. What is that? What do you use, PCR or something? What is that? Has that limits of resolution allow you to do that? What technique is that?
Yeah, so Natera has a proprietary technique that's a multiplex PCR NGS capability.
Of course.
Yeah.
I mean, you knew that, right? What was that again? A PCR multiplex. We have an AMC multiplex out. Is that different? What's it called?
Yeah, multiplex PCR with next-gen sequencing.
Okay, that's it. All right, we got to end it there. Well, that's clear now. Clear as mud. Steve, thank you. Good luck.
Thank you very much.
Yeah, 10 years and 22 billion. It's working. Keep it up. 7 a.m. On the East Coast. You're watching Squawk Box on CBC. I'm Joe Kernan, along with Melissa Lee, Becky, and Andrew Roth. Among today's top stories, President Trump unveiled new tariff rates for 14 countries. The rates range from 25% for larger trading partners like Japan and South Korea to 40% for countries including Laos and Myanmar. The president signed an executive order formally delaying the deadline for all reciprocal tariffs now through August 1st. And Samsung Electronics is forecasting a big drop, 56% in profit for the second quarter. That's worse than analysts were expecting. The company said that inventory value adjustments, hate those, and the impact of U.S. restrictions on advanced AI chip for China contributed to the fall. And the Transportation Security Administration, the TSA, may change its policies. This might be the biggest news today. For me, that requires airline passengers to remove their shoes at screening checkpoints, as according to multiple reports. Say the TSA has begun rolling back that requirement at some airports in recent days. The agency has not officially announced that change yet.
Think of all the footwear you can now wear to the airport without.
That's what I told you. High shoes.
Come off. I mean,
boots. Who wants to wear boots? Who wants to be struggling with
it's possible. Wear cowboy
hernia
boots.
while you're trying to get on a?
Taking a check on the futures at this hour. We have the S&P looking to add about 8 at the open. The Nasdaq looking to be up by 64, and the Dow looking to give up about 26. Let's get to Dom Chu with a look at this morning's pre-market movers. Dom.
Good morning, Melissa, and good morning, Joe. Let's talk first about what's happening with Oracle shares because they are actually higher this morning after dropping yesterday. That's when the U.S. General Services Administration, the government basically, announced that they were getting a 75% discount on Oracle's license-based software for government agencies. It also announced, quote, substantial base discounts on Oracle's cloud infrastructure, or OCI. Now, it was a rare break in the rally for Oracle because those shares have been rising over the prior 3 trading days. They were roughly 41% higher for the year. They're currently hovering just $3 shy of their record high that they hit last week. So Oracle resuming that kind of upward move up over 1% today. Also, CoreWeave in the green despite a downgrade to hold from buy over at Stifel. Stifel's bullish on the long-term move of CoreWeave's acquisition for Core Scientific yesterday, particularly on the potential energy capacity CoreWeave could receive for its data centers, but it says it could introduce some near-term overhangs, especially the dilution in shares of the stock. It's an all-stock transaction, remember. CoreWeave stock pulled back on the news, but they're resuming their rally now, just around 300% higher over the course of the last year. And European spirit makers are in focus. Pernod Ricard among them, also they're the owner of Jameson Whiskey, also Campari, the owner of Aperol, taking higher this morning after An EU diplomat spokesperson told our own Silvia Amaro in Europe that spirits were among the categories that could possibly be excluded from tariffs in a new trade deal between the EU and the US. They also said that nothing had been finalized yet and that the final decision, of course, remains with President Trump. So, Melissa, keep an eye on some of those European spirits companies. I'll send things back over to you guys.
All right, thank you, Dom Chu. Coming up, earnings season is on the way. How the markets are preparing for the latest round of quarterly results. Plus, Mark Zuckerberg's AI hiring spree continues. This time, he's luring away a top executive from a rival with a package worth tens of millions of dollars. More on Meta's AI strategy coming up later this hour. Squawk Box will be right back.
For certain.
Welcome back to Squawk Box. Earnings season right around the corner. Let's talk markets now with Emily Rowland, the co-chief investment strategist at John Hancock Investment Management. Emily, good morning to you. We're pretty much at record highs in the S&P 500 as well as the Nasdaq's. That's a terrible setup or a very difficult setup going into earnings season. Where do you stand on this rally in general in terms of the strength of it?
Yeah, Melissa, there's a lot of things going right from a technical perspective. You mentioned new all-time highs for the S&P 500. We're seeing broader participation from sectors like financials and industrials. That's really, really healthy here. We're also seeing sentiment, it's turned from pretty deeply negative to positive, but there's likely still some room to run here from the sentiment perspective. Then we move over to the fundamental side of markets and economies. The economy's in decent shape. That's been evidenced by positive labor market data that we've received. Corporate defaults remain low here, and earnings are very, very healthy, especially as it relates to the S&P 500. So there is a lot of things to love about this market. I would say the only challenge here, the only risk in markets is there really is no risk being priced in. The S&P 500 is now trading at 22.3 times forward earnings. That is near the 10-year high. High yield bond spreads at 268 basis points, very close here to 10-year tight. So markets are pricing in a lot of positive developments that is being supported by the fundamentals. But as you mentioned, we're just sort of at a tricky point here heading into the back half of 2025.
What's your biggest worry about the markets then? I mean, as you take a look at it, it seems like the markets have become a little bit inured to trade headlines at this point. We've got the tax cut extension, so policy-wise, we're on a good track. What's sort of that outlier thing that could take the markets down?
Yeah, I mean, I think, as you mentioned, there's been a lot of things going right as far as the passage of the bill and markets responding positively to that. I think, markets are tending to expect that tariffs are a negotiating tool and are certainly not kind of repricing worse tariff risk here. So there is a lot of good news in markets. I think, hopefully we can turn our attention to earnings season here and markets can move past some of these political developments. It's really hard to handicap those geopolitical inputs into markets. So hopefully we can move on here to profits and earnings. It sort of reminds us of that famous Bill Belichick interview where he said, we're on to Cincinnati, and he wouldn't really answer any questions about the game, meaning that the next game is the most important one. And that's what we're looking at for earnings season here.
Yeah, it probably didn't end well for me. I can't believe you picked that that city. Emily, you've been.
That's my hometown.
Oh, it is?
Yeah.
Did we talk about that? You're an East Side person. You're an East Side person.
No, I'm a Boston girl, North Shore.
Oh, well, what did you say? Oh, that's your hometown. I thought you meant Cincinnati.
Yeah.
If you were from Cincinnati, you'd be from the East Side. That's the better side. Then I was not from there. Not that I grew up in squalor. No, that's not what I'm saying. But you've been kind of chill about these things. You are the anti-Fred Kemp that we had on a little bit earlier. You have thought a lot of this is like, just relax on some of it, especially bonds. You think that bonds represented a lot of value. You have to, finally, in your world where you have to have money has to be there for a lot of people that John Hancock do business with. So it's different. But you've always thought that you didn't think the bond market was going to implode from this bill, did you, or from anything else?
No, because Joe, there's something going on underneath the surface that you and I have talked about, which is significant disinflation, especially coming from the housing market. Shelter represents about 2/3 of CPI readings. That's incredibly important. Yes, there may be an inflationary impact on the good side of our economy that comes from tariffs, but service is a much bigger driver of inflation readings. We're seeing the biggest supply of housing since 2020. We're seeing demand starting to slow in the face of unaffordability and untenable insurance costs. People are a little bit more worried about their labor market prospects. So there's big changes happening on the housing market. And we think once real-time measures of housing catch up to CPI, you'll see us hit the Fed's inflation target here, and they'll be able to resume cutting. So we don't see the potential deficit increase really creating a ton of volatility around bonds. We see that disinflation from housing actually being a more important element here, meaning there's a lot of value in bonds at elevated rates. Bonds are mispriced. They're not sniffing this out, where stocks here are relatively priced for perfection.
See, we think bonds are mispriced, not sniffing Armageddon. The end of the world out. We think that we were just talking about that yesterday. That we had a report. It's a wait and see attitude for how bad it's going to be in terms of deficits, and the bond should be trading at like 5. The 10-year should be at like 5%. You think the opposite. You think they're cheap.
We've been increasing the size of the deficit, Joe, for years, and bond yields have come down over the last 10 years. And we think that continues to be the case. Again, it all comes back to disinflation, not only related to the economy, but the incredible disinflation you get from productivity enhancing AI. We think that's going to play a big role here. The only thing that changed the inflation picture is that we pumped $5 trillion into the economy and acted like we were in a world war. During tariffs. We don't see that one-time hit to inflation here coming back. Yes, the deficit's going to continue to increase, but the pace of that increase here is likely to slow. And as rates can come down here, that means we can start servicing that debt at a much lower level, which is another positive.
You want to just keep her for a while longer, I think?
You do.
I know. Half full. I said
Yeah, half full.
half full.
Yes.
She's more than that. I think you're like completely full. You're,
Of good
Of good things.
Yes, when you say somebody's full,
no. You're right. Half empty.
Thanks, Melissa.
Half full.
Thanks.
But I remember. I'm glad I remember things, and you have been on the right side of a lot of this stuff for the last 6 months or so. I mean that I can remember the conversations we've had where it's kind of counter to just the constant drumbeat of tariffs and end of the world.
Yeah.
All right.
thank you, Emily.
Thank you.
Coming up, CNBC out with a new list of the top empires in sports, not umpires, empires. We're going to unveil the top 5 next, and later, Council of Economic Advisors Chair Stephen Myron with the new data on tariffs and inflation. That's at 8:10 a.m. Eastern. Squawk Box returns in just a moment.
Now.
CNBC out this morning with our list of the most valuable sports empires of 2025. These are the biggest names reshaping the business of sports. Combined value, $225 billion. Taking the top spot in this inaugural year is Kroenke Sports and Entertainment, worth $21.2 billion. Jerry Jones' Cowboy Empire takes a second spot, valued at just more than $15 billion. Harris Blitzer Sports and Entertainment comes in at third at $14.6 billion. Fenway Sports Group in Madison Square Garden Sports round out the top five. Joining us now is the man behind the list, CNBC Sports senior reporter Michael Ozanian, and the Lakers. That deal hasn't closed yet. What would they have been in the top five at that?
I don't know, because I don't know how much of the Lakers Mark Walters going to eventually own. But they certainly have been on this list. And this is part of a trend we're seeing. You mentioned Walter buying the Lakers. He already owns the Dodgers. He's got investments in, women's professional ice hockey and the WNBA. Woody Johnson, the Jets owner, is another person who could be on this list next year. He just bought a significant stake in the English soccer team Crystal Palace. He already owns the Jets. And this trend that we're seeing where individuals or entities increase the size of their ownership of sports investments, teams, companies that run venues like Legends, sports networks, is one of the ways that they're increasing their valuations. And this trend's going to continue, I think.
What goes into the calculation of how much an empire is valued? Because there's the sum of the parts, just straightforward, but then there's also some synergies that you might, that might enhance the valuation.
Absolutely, that's exactly right. So the reason we use multiples that range from, let's say, 1.1 to 1.4 times the sum of the parts is because of the great scale you get. You can cross-market sponsorships, the knowledge you have. The owners of the Commanders, who also own the Philadelphia 76ers, have talked about how they've used that knowledge for the 76ers arena situation, for the Commanders situation. And in fact, we see these valuations based on sale prices. So Stephen Ross sold a minority stake in his sports empire, which is the Dolphins, the F1 auto racing, and the stadium that he owns.
Did you see the F1 movie?
I did. I liked it a lot, actually.
I liked that. I didn't know any of that
A
stuff.
whole lot of love in the opening scene. Pretty cool, too.
That was
Led
pretty good.
Zeppelin.
Led Zeppelin. But did you know, there's a lot to know about that. It's apparently about that sport. All revolves on the tires. Which tires, how long the tires, when you go in, when you come out. Amazing at those pit stops, was it not?
Yeah. And I actually saw Ron Howard's movie Rush, which was F1 2, which was, if you haven't seen that, is spectacular, too.
Amazing, all converging. This is what I'll say, Mike, that, I'm seeing, troubles at CBS, blah, 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 60 Minutes. The new guy, sports. It news maybe to some extent, but there's nothing like the content that sports gives you.
Yeah, and we've seen rights go up, which is one of the reasons why the value.
It's all converging. All media is converging on sports, isn't it?
Yeah. Live content. It's one of the
Live
few
content.
things people still will pay to see live. We've seen now that they're talking about redoing possibly the NFL's broadcast rights earlier than scheduled. The WNBA, via the NBA's new TV deal, got a big increase in TV rights. The WNBA is talking about now it's going to add 3 teams, right? That's going to increase the value of those sports empires because those teams are going into situations where the owners already own NBA teams and control the arenas. So to your point, Joe, it's all converging.
CNBC Sport.
CNBC, we're going to capitalize on it all, and I'm going to be here talking about it, hopefully.
I thought you were going into philosophy. You told me off camera, didn't you?
That's
no,
my
that's your daughter. That's your daughter. And I said, just like the apple doesn't fall far from the. And you immediately started laughing, like that was the most ridiculous thing anyone's ever said.
I'm in for trouble when she starts coming back from school.
And ask you some philosophy question. Mike, thank you.
Thank you.
For a complete list of sports empires, check out cbc.com/sport, and be sure to check out our game plan event. That's September 16th. Josh Harris and Ted Leonsis going to be talking about their empires. Go to cnbcevents.com/game plan.
Coming up, Amazon's Prime Day sales event is here, but are consumers going to get real bargains? We'll get a price check from our Courtney Reagan. And later, Senator Tim Scott on his push to make it easier for companies to offer gig workers benefits without making them full-time employees. That's at 8:40 a.m. Eastern Time. As we head to break, check out some of the gig economy names. Squawk Box returns in just a moment. Welcome back to Squawk Box, and we are looking at a higher open across the board. This after the S&P 500 lost about 0.8% in yesterday's session. The S&P looking to add 10 at the open. The Dow looking to be up by 1.5, and the Nasdaq looking to be higher by 69 points. As for Treasuries, the yield on the 10-year at 4.41%, pretty stable all morning long so far. 2-year yielding 3.9%. On the oil front, we are seeing a continuation of declines here. WTI crude down by 0.25%. Gold, we'll check out the action here as we have gold lower by about 0.25% as well, and Bitcoin moving fractionally at this hour, up by about 0.7%.
Coming up, Meta's Mark Zuckerberg sparing no expense to acquire the top AI talent that the world can offer, even grabbing a top executive from one of his Silicon Valley neighbors. More on that next. And as we head to break, check out some of the mega cap tech names where they're trading pre-market. See all higher. Squawk Box returns in just a moment. Apple AI executive Roming Pang has reportedly left the company for a role at Meta. This is the latest move in the ongoing battle, tech battle for top AI talent. Joining us now, Lauren Good, senior writer at Wired. Lauren, it's good to see you. I mean, these guys, I look at it, they're so young. They must be like off the charts, genius. If someone comes to me and says, Mr. Kerner, what should I take in college? What are these people? What are they? EE? What computer program? Are they coders? What are they?
Well, at this point, a lot of them have probably pivoted to studying generative AI in particular. If they were machine learning or AI engineers before, now they're focused on whatever this definition of super intelligence is going to be.
Oh my God. Okay, it's whatever it is, I don't.
It's not too late, Joe. It's not too late for you.
Oh, it is so far.
Coding now.
It is so far too late. What do you think he was making at Apple, Lauren? And the reason I say that, I mean, Tim Cook has all the financial wherewithal in the world to keep whomever he wants. Does it have anything to do with him thinking that Meta has a better shot than Apple, and it's not just the money?
That's an excellent question. I can't say for sure what the folks at, say, Apple or OpenAI were making prior to being lured away by Meta for this new superintelligence lab. But I think it's safe to say that for some of these engineers and some of these operators, the pay packages are certainly going to be an incentive. And for others, they're probably evaluating which company or which lab is the next rocket ship in AI and what the missions are and whether or not it makes sense for them at this stage in their career to join.
So if you, reminds me of like the Dream Team or something in the Olympics. They did win, but they still got to play the game. Is it a given that if he gets the best people that Meta's going to win? It's still not a given, is it?
Yeah, so the thing that researchers and technologists and executives have been saying, at least I've heard some of them say around the Valley lately, is that what's going on with generative AI right now is that it is overhyped in the short term and underhyped in the long term. And so this is all just still shaking out. It's still very early days for generative AI. And I think in a sense, people are making bets on their teams, who they want to be with, for whatever this sort of super intelligent future looks like. People have been making some of the comparisons to sports teams, saying that these sound a little bit more like locking up people in contracts or packages rather than just like your standard AI or engineering job. But it's hard to say who ultimately is going to shake out as the quote unquote winner. I think it's more realistic that there would probably be a lot of winners in this space.
Right. I wonder how many will be like top 3, top 4. I guess we know some of the players at this point. We said that it was tens of millions. We heard he was offering packages worth hundreds of millions. Then we said it was tens of millions per year. Do you know what specifically? Is it tens of millions per year?
So Wired has reported that as many as 10 people have been offered packages that are, upwards of tens of millions per year, with some as high as $300 million per year overall, including $100 million in the first year. Some of that is in bonuses, some of that is in equity, some of that is in just cash, a cash salary. We've also reported that in some cases, these employees would vest within the first year of joining the Meta Superintelligence Lab, which is sort of an accelerated vesting schedule. Meta has basically disputed some of this reporting around this that's been floating around the internet, and even Meta's own CTO has specified that this would be kind of a certain subset of engineers who receive these incredibly high pay packages. And I think that that's an important note to make in terms of what this does for hiring and AI talent in Silicon Valley in general. I would be very surprised if this ends up being something that totally disrupts the pay scales of every engineer around the Valley. I do think it's going to be a specific group of highly specialized talent, since talent is one of the most critical parts of it. It's really talent, data, and compute power at this point that are sort of helping these companies, set up for this next era of AI. And I think it's going to be a specific subset of talent that are offered these kinds of pay packages, or counter-offered for that, for that matter, if you're OpenAI and you're trying to retain an employee.
Lauren, once upon a time, the talent pool might have grown because people might come into this country to work or to study, et cetera. And I'm wondering what you've seen in terms of how that pool has remained maybe stagnant, maybe not growing as much because of the ongoing trade wars.
That is an excellent question, and actually I've been doing some reporting for Wired about what's been happening around high-skilled tech visas here in the United States. Right now we're still sort of in the middle of what you might call H-1B season, where folks are getting their applications in and waiting to see whether or not they're approved for the next round of visas in the fall. We know that the immigrant pipeline is an incredibly important pipeline for the talent pool in Silicon Valley. And we have reported that there have been some more restrictive measures and more requests for evidence or requests for additional information during the application process for these visas. But actually, at this moment, it's still a little too early to tell whether or not that's going to affect the ongoing AI race.
Is there a perception that Apple is that is still somewhat behind? And this guy had a 100-man team or 100-person team. Is this a significant setback? And what did they do?
This is a really good question, because there is a lot of emphasis right now on who's behind and who's ahead in this moment, and even in evaluating sort of what's going on with Meta and reporting on that. There have been some criticisms of how the latest rollout or the rollout of their latest model went and how effective it is. And I think right now, you're hearing from folks, people are focused on the specific models or the specific applications and sort of the speeds and feeds of it. And those are all very valid critiques. And certainly what's going on at Apple seems a little bit confusing for a company as big and powerful as Apple that has the resources to devote to this effort. But I do think, once again, if you sort of look at it as overhyped in the short term and potentially underhyped in the long term, it's still a long game, and Apple does have a lot of resources. It also has one of the most powerful and lucrative distribution platforms in the world with all of its iDevices. So if and when it does kind of figure out what it's going to do in AI, whether or not it's going to remain, sort of keep it private, and how it's going to distribute it, I think it still could have a pretty good chance of, in the same way that Google sort of sped up and caught up, of making an impact here with AI.
So you yourself use what? And do you have how many? And do you use different things for different models for different questions? What should I be using?
Oh, this is a good question. I use ChatGPT intermittently because it's sort of a professional obligation at this point, Joe, I would say. Not that I use it for Wired work, but just I'm constantly testing these things.
No one's saying that. No. Do you pay? Sorkin has the one where you pay and it remembers every. See, I don't want a history of things.
It's sort of paying $200 per month.
On my browsers, I go to silent mode. I don't need it in memory for.
I've used Google Gemini. I use, apparently I'm using Apple AI every time Siri summarizes my iMessages, but those are sometimes hilariously off key. So I would say that those are the three that I'm sort of rotating through at this point. But there are a lot of offerings out there now, and it's a really interesting race.
And it's so early, and it just boggles the mind what it's going to be like in a couple of years. Lauren Good from Wired, thank you.
Thank you so much.
Okay.
Coming up, prime time. Amazon kicking off its annual summertime sales drive, which is now 4 days long, but are consumers getting any real bargains? Courtney Reagan's on the hunt. But first, check out Amazon and some of the other big box retailers that are joining in on the summer fun: Walmart, Target, and Costco. Swap Box returns in just a moment.
to learn more.
A call on some big financial names this morning. HSBC is downgrading Bank of America, Goldman Sachs, and JP Morgan, setting a more cautious stance over what the analyst calls a still choppy macroeconomic backdrop. BAC goes from a buy to a hold, though HSBC is raising the price target to 51 from 47. Goldman Sachs cut to reduce from hold. Its price target also raised to 627 from 558. And JP Morgan downgraded from a hold to a reduce, with a price target increase to 259 from 237. All three, by the way, hit new highs in Thursday's session. Amazon Prime Days have arrived, and consumers will be hunting for bargains, but will they find any? Courtney Reagan joins us now with more. Courtney.
Sort of the question everybody always asks, right? I mean, how good are the Prime Day discounts? And like usual, it's sort of hard for me to tell you that exactly for a variety of reasons. But this year, it's actually a little bit harder because of the possible tariff influence. Makes it murkier. But here's what we know. Amazon CEO Andy Jassy told our Jim Cramer that prices have not gone up appreciably due to tariffs going into Prime Day. However, several outside pricing analyses suggest that's not true for every item. Commerce IQ says an analysis of 57,000 SKUs on Amazon shows the average selling price increased 2.3% in May from April. So on average, maybe that isn't necessarily what you would call a, quote, appreciable increase. But Commerce IQ says while value brand pricing is mostly flat, so lower priced items, upper priced products show prices have increased between 5 and 15%. Now, a data weave pricing analysis of more than 1,400 items made in China sold on Amazon from January to mid-June found the median price increased on 475 items, 633 were unchanged, and 299 actually saw prices fall. Now, this is according to Reuters. Overall, the median prices did outpace inflation, increasing 2.6%, with prices increasing more sharply in May and June, particularly in home and furniture and electronics. Now, Coresight's Deb Weinswig says Amazon typically asks sellers to offer at least 20% to participate in Prime Day. But if that's on an item with, call it a recent price increase, like we just talked about, of maybe 15%, is 20% then that great of a discount? Amazon says it's confident in its deals and its focus remains on delivering value to customers as the trade landscape may be changing. Beyond pricing, inventory, though, that's another key thing we want to watch because retail experts want to know how willing and able some brands, maybe even smaller ones, are to stock inventory to fulfill Prime Day demand, particularly because they would have to do so in advance if it's something that's manufactured in a country subject to high tariffs. If it doesn't sell, they're going to get stuck with this item that cost them maybe potentially more than last year. So there's a lot of fluctuating factors going into this year's event.
So for a good to be considered part of the Prime Day event, it just has to go down in price by 20%, but it could have raised price by 20%. So in the end, up 20, down 20, you're actually higher than the original price anyway.
Exactly. That's kind of the tricky part. Now, you know, Amazon doesn't really give like hard and fast rules when we talk to them, but generally experts say, look, you need to be about 20% to be a Prime Day product that gets sort of any feature or algorithm push. But again, to your point, if you've just recently raised price, is 20% really that good? So it's like I would tell everyone all the time, do you think the price is good? If it is, then buy it. I know that's not the most helpful advice, but it's sort of true, right?
Yeah. Target, Walmart, all of them are matching or trying to compete also. How much pressure does it put on, you know, like a Target, for instance?
Yeah. So I think obviously Amazon started this deal, the Prime Day event deal, 10 years ago. It was in 2015, and they did it to celebrate their beginning, their anniversary. That's what they say. But many retail experts say, look, they also did it to sort of jazz up shopping during an otherwise pretty quiet period. And it has worked to pull some back to school sales forward, I think. Other retailers, like often happens with these events, feels like, well, I can't be the only one not offering it, so everybody gloms on. And shoppers have gotten much savvier about that. I think most of us, if we're looking for something, we'll check around and make sure the deal is the best. Now, Amazon probably has the most sophisticated dynamic pricing algorithm, so I think sometimes if it is an identical item, it will be very hard to beat an Amazon price on one of these big event days, but it can happen, particularly if the item is not identical. But when you look at, you know, companies like eMarketer that study online pricing, they say Amazon still is going to take probably 75% of all U.S. online e-commerce during this 4-day event. And by the way, it's 4 days this year instead of 2.
For Target, we've recently seen the stock perk up a little bit. And so when I was asking at Target, I was just wondering what sort of pressure this, if they're forced to sort of cut price and offer incentives, Could that put additional pressure on margins, but actually maybe draw people back?
Right. That's such a tricky one because I think Target in particular has really struggled with its merchandise, both with sort of the types of merchandise it has, the amount of inventory, and then how it's priced. And so, well, not at Target, at Walmart, but Doug McMillan always talks about that's sort of the key of a merchant, right? You have to figure out if you can drive more volume, then maybe you can afford to drop that price lower. But unfortunately, Target's sort of equation has not been so perfect for that more recently.
You are really fast money.
What?
Just really short term. It's a month. It's perked up. It's down from.
Well, a month.
It's down from 260.
A turnaround has to start from somewhere.
It's down from 260. It's at
I understand that.
Walmart's up from the.
But if you bought it a month ago, you're happy with that.
That's
now.
right.
Does that look like a stock that's doing a little bit better to you right there?
Well, and the longer term chart is hard to see the more recent trend, of course.
You are finding the silver lining.
I wasn't saying
Thank goodness she's here, right?
No, I know you're not, but I heard you, and I just decided I'm going to look to see if, because I knew how poorly it had been doing, and I looked to try and I see it, teeny weeny little on the right hand side.
Okay.
Go woke, you go broke, baby. That's simple. Coming up, thank you. A closer look at CoreWeave's strategy and the major energy boost that the AI and cloud company is getting with its acquisition of Core Scientific. CoreWeave. Those two deserve to be together, didn't they? Two cores. Shares up more than 300% since going public on March 28th. Squawk Box coming right back.
AI and cloud infrastructure company CoreWeave is acquiring data center company Core Scientific in a deal valued at roughly $9 billion. CoreWeave CEO talked to Jim Cramer on Mad Money last night about the deal.
We really know the team over there. They really know us. There's a lot of synergy between them. the two entities, and there's a lot of positive goodness to be extracted from just the interaction of these two entities.
Joining us now is an analyst who covers the company, Gil Loria, head of technology research at D.A. Davidson. Gil, great to see you. You think that this is yet another way that CoreWeave is financially engineering their results? Can you explain?
Yeah, CoreWeave is already buying all of Core Scientific's capacity. All they're doing here really is ensuring that Core Scientific doesn't turn around and give its capacity to somebody else, and they're really giving away 10% of the company to accomplish this. Core Scientific doesn't make any money. They lost money last year. They had negative cash flow, so adding them doesn't really add any profits to CoreWeave. And really, there's no, since the companies are in different businesses, there's not really a lot of synergy to derive there. So what they're really doing is they're spending their very expensive capital, their very expensive value of their shares in order to secure those energy contracts. Those are the key right now. We are going to run out of energy for data centers pretty soon. And so securing those contracts is really the motivation behind this deal.
Isn't that, I mean, that sounds like a smart thing then, Gil. I get your points, but I mean, in terms of making sure that you have the energy necessary to grow the business, that sounds like a savvy acquisition.
It is a savvy acquisition. Again, they're using a very expensive stock to secure energy and energy resources, and that is a savvy transaction. But again, it doesn't add to the profitability, and it doesn't change the unit economics of CoreWeave are negative. This is a company that borrows at 12.5% and only generates 5% returns on those assets that it is borrowing for. That would be like taking a 12.5% margin loan to buy treasuries yielding 5%. It doesn't matter how much you scale that, that's not a good business.
Right. Do you believe in the projections for cost savings? You know, the CEO is talking about it. It's like not paying rent for the next 15 years and the ability to access financing at a cheaper rate.
No, not really. Again, they're in a different business. CoreWeave is in the business of brokering deals to buy GPUs to put in a data center. Core Scientific is in the business of buying the land and building the buildings for a data center. Again, they've been a sole supplier to CoreWeave, so they've already been providing all those services. There's not really anything to cut out. And again, Core Scientific lost money. So all we're doing here is Core Scientific took $1.05 of expenses, sold them to CoreWeave for $1, who turned around and sold that $1 for $1.05. All we're doing here is collapsing $1.05 expenses with $1.05 of revenue. Still not a value generative enterprise.
Does this make Bitcoin miners in general more valuable? That was Core Scientific's business. It's not as attractive to mine Bitcoin anymore. I'm just wondering what that does to valuations, what this deal does.
Yes, it does make the Bitcoin miners more valuable because the business of mining Bitcoin, let's not forget, is entirely competitive, right? You're competing with anybody else that has that equipment anywhere in the world. The returns for that are very cyclical based on crypto winters and summers. Where AI, there's just such an explosion of demand that the value of that power that you can get into that data center, the value of a building that has access to that power is far greater than the value when used for mining Bitcoin or any other cryptocurrency. That does make anybody that has those types of facilities more valuable. And Core Scientific got an amazing price for a company that was bankrupt less than 2 years ago, because of this unique value, the scarcity value of having data center operations next to an existing power source.
So are you expecting more deals along these lines in this AI space? I mean, should we sort of broaden our view of what is for sale in AI and what is an attractive asset?
Yes, I do believe that we will see some of these other Bitcoin miners either convert to building AI data centers themselves, just like CoreWeave did a few years ago, or sell to your big hyperscalers, Amazon, Microsoft, Google, Oracle, or companies like CoreWeave or other that are running out of data center capacity to that has power contracts. So I do expect that will continue to happen.
Right. Interesting stuff. Gil, thank you so much.
Thank you.
Gil Luria.
It's 8 a.m. on the East Coast, almost, and you're watching Squawk Box on CNBC. I'm Joe Kernan, along with Melissa Lee. Becky and Andrew are off today. Among some of the top stories, President Trump announcing blanket tariffs on imports from at least 14 countries. Those tariffs would kick in starting August 1st, unless a deal is struck with the White House before then. The rates range from 25% for larger trading partners like Japan and South Korea to 40% on the high end for countries including Laos and Myanmar. And along with a trash strike in Philadelphia, Waymo says it will start testing its self-driving vehicles in that city, of brotherly love this summer, with safety drivers behind the wheel at the same time. It's the company's latest expansion after announcing plans to test cars in New York City. And Elon Musk's xAI is set to release the latest version of its AI chatbot, Grok. Musk posted on X that Grok 4 would be released tomorrow at 8 a.m. Eastern Time.
Let's talk markets now. Kate Moore is Chief Investment Officer at Citi Wealth. Kate, welcome to the show. Good to see you.
Yeah, good morning.
Where do you stand on the rally here? Sitting pretty much at record highs for the NASDAQ and the S&P 500.
Yeah, so I've been saying I've been pretty uncomfortable with the rally, in part because a lot of it has not been driven by fundamentals. We know against the backdrop of this rally, there's been a decline in terms of earnings expectations. We've continued to take down estimates for this year. And the key thing that I'm focused on is that the uncertainty factor hasn't faded. This is still coming up in CEO and CFO surveys, some of the soft data that we've all been tracking. We don't really have a great sense for what the next 6 months look like for one's own company operations or for the overall economy. So we're grinding higher on a lot of hopes and enthusiasm and expectations that the Trump administration will keep on backing off some of the most punitive measures, particularly around tariffs. But I don't know if that's a great investment strategy. I think we have to stay really anchored in high quality and consistent earners.
In your view, what sectors are those? Because a lot of those sectors are also at record highs. I mean, financials are at record highs. Industrials are as well. Tech is dropping. I mean, what is quote unquote safe? What is defensive in this market where you're uncomfortable?
Yeah, well, so this is part of the reason why I'm uncomfortable, because the high quality stuff, the companies, the sectors, the industries that have sustainable earnings, that we think will be less sensitive to some of the pain and pressure from tariffs, will be able to either pass through prices or have a lot of margin buffer, are really being priced to perfection. And, at this point, tech and AI, which I think we all understand is a durable theme and where companies will continue to have to spend in this space, regardless of what happens to overall economic growth, is very well owned by all segments of the investment community, by institutional investors, by individual investors. And as such, it's tough to say put new money to work there. That said, we would not be selling our positions in the tech and AI adjacent names. The one area that
I think I was giving you a hard time last time you were on about the stuff that were making you that was making you so bearish was so front and center. So it's still front and center. I don't know whether you missed this latest 25% or whatever it is. Maybe you held some of it. But what is your position now that we're not going any higher at this point?
Well, Joe, I think we're at a top end of a comfortable range at this point until we get the clarity. For what it's worth, yeah, I've been uncomfortable for much of this rally because of the lack of clarity and because it's not based on either macro or on fundamentals. That said, at Citi, we did not go underweight equities. In fact, over the course of this, we continue to rotate into the large cap, into these high quality, and to really stay anchored in these secular themes. So, even with my discomfort, I didn't want to step away from the equity market, so we have continued to be market weight in terms of equity.
In general, if I'm comfortable, I'm selling. If I'm complacent, I would be selling. And lack of clarity. Have there been times in your career where things were really clear for you in the stock market?
Well, of course, there were times where I felt I had more clarity, Joe, than I do today. But There are certainly times where I have reduced risk because, on balance, I didn't have any sense for what the next 3 or 6 months would hold. My job here at City Wealth, though, is to think not just over the next 3 to 6 months, but what could be the next 6 to 12 months. So a longer duration than I've invested in parts of my career. But look, Joe, you know this as well as I do. If there was perfect clarity on anything, that those of us who were making investment decisions may not have a job. The machines would have taken over. They would have just plugged in all of the inputs, algorithms would have spit out an allocation, and that would be it. There's always some judgment, and there's always some degree of uncertainty. That's what makes us love markets so much. We're constantly learning.
Kana, I'm curious, the next 6 months or so, I would think that there's more resolution to what's going on with trade, that CEO optimism could be firmed up because of that resolution. We've got tax cuts that are extended at that, so we have the certainty of that. I mean, is that what the market is trading on? Because that seems, I understand the point about earnings, estimates and revisions downward, but that seems like those are fundamental things to trade on to back this rally.
I will say, as we think about 2026, there are additional themes that we could get more, encouraged by. One of them, of course, is in terms of CapEx. I don't think we're going to see a big pickup in CapEx in the second half of this year, in part because companies are still trying to understand what impact and what levels tariffs will come in at, whether or not they will be able to pass all or some or none of the costs on to their end consumers. But as we think about next year, some of the tax treatment for companies and some of the expensing, I think, will encourage spending across the board. And that could be a very powerful and new theme for investors.
What is the recommended allocation for investors at this point, Kate?
Yeah, so, our overall allocation is, as I was just mentioning when Joe was asking this question, we've been neutral, which is 60% equities, for us at this point. Again, more favored in kind of the large cap. We reduced our small cap allocation. We added a bit to Europe over the course of the last few months, which we think could be quite interesting from both a fundamental and also a policy easing perspective. And then very consensus, I would say, within our fixed income allocation, we've continued to anchor to the short end and just basically say we want to stay shorter duration. I think despite the fact that we will get more and more international investors reconsidering where they want to put their marginal dollar to work, that U.S. equities are still going to be the most attractive house on the equity street. I think it's going to be a more challenging conversation around bonds. And as I said, I think that's quite a consensus position for institutional and retail asset allocators.
Kate, thanks for your time. Great to see you.
Thanks for having me.
Kate Moore. Coming up, a tax hike on college endowments, a breakdown of rates, who pays and who escapes. And then businesses and investors are hoping for some clarity on tariffs. Council of Economic Advisors Chair Stephen Myron will join us next to discuss goods prices, and inflation. Squawk Box, be right back. Taft University endowments are being hit with an 8% tax, but it could have been worse. Robert Frank joins us now with a breakdown of who gets hit and who escapes.
It's
Robert.
good to see you. In fact, it could have been much worse. The tax on many university endowments will more than quadruple in the new tax plan. Universities currently pay a tax on their endowment of 1.4%. Now, the big bill creates 3 new tax rates based on the student-adjusted endowment. So that's the total endowment divided by the number of students. So schools with adjusted endowments of between $500,000 and $750,000, they will still pay that 1.4%. Those between $750,000 and $2 million pay 4%, and those above $2 million will pay 8%, much better than the 21% that have been proposed by the House. The elite group of 2 million plus includes, yeah, you guessed it, Harvard, Yale, Princeton, MIT, and Stanford. Princeton, in fact, has the highest adjusted endowment of $3.7 million per student. Harvard, which of course has the largest overall endowment at $53 billion, is just around the $2 million level per student. Now, the bill does exempt schools with fewer than 3,000 students. So even though Amherst, for instance, has an adjusted endowment of $1.9 million, its enrollment of 1,900 students will exempt it from this higher tax. In fact, they get a tax cut because they currently pay that 1.4%. Now, some schools that will pay the 4% tax include UPenn, Columbia, Dartmouth, Caltech, Notre Dame, and Vanderbilt. There was a discussion of exempting religious affiliated schools. So Notre Dame thought they were going to be in the clear in the House version. The Senate removed that exemption, so now Notre Dame will pay that 4%.
Do they do a mark to market? I mean,
I was going to ask that. How do they calculate
because
that?
Harvard is
it goes up and down. It goes up and down. So
Harvard is supposedly totally illiquid at this point. Have you heard of Ackman make?
It's not totally liquid. Typically, they have, as Melissa knows, about 40% in alternatives, which are marked, but no one believes the private equity marks these days, so they could be lower.
Mohammed I think Alarian he was running the endowment for a while.
Well, of course, Dave Swenson at Yale pioneered the alternative.
He was great.
So and private equity was great back then as well. It hasn't done as well in recent years, but yes, the illiquidity has been an issue, and that's why a lot of these schools like Yale and Harvard are selling some of their private equity holdings to raise cash in anticipation of having to pay this tax and other taxes. So the schools would say, look, we use this money to pay scholarships. Why are you taking away money from kids that need it the most? Congress was saying this is a way to hold these elite schools accountable. They've gone too woke, and this is a way to...
You know, you got to tread a little lightly with Harvard.
I'm a delicate flower.
Said Mr. MIT. Mr. MIT.
That was great. But that don't really count. That I'm a Buffalo.
I do.
I'm a Buffalo. You do?
For you? I think it's a badge of honor.
Okay. All right. I'm going to wear it then. I'm going to wear it.
Can universities take losses on their investment losses?
So currently the average return is between 7 and 9% for universities, so they'd have to have a really terrible year. I have never seen an endowment have a year where they would be down. I mean, look, 8%, yeah, you could theoretically post-tax, I mean, you still have a gain, but it's going to be tougher for them to make the kinds of returns that they need to make to pay these scholarships and not dip into the principal.
Yeah. Wow. Robert, thank you.
Thank you, guys.
Robert Frank.
And a market flash before we go to break. Bank of America's Savita Subramanian is raising her year-end price target for the S&P 500 from 5,600 to 6,300. She cites the resilience of corporate...
Say that again. 5,300.
Yeah. Is that what it said?
Was it 53? Yeah. To 6,300.
Let's see.
5,600. Okay. Well,
I kind of had the same conversations with her that I had with Kate Moore, actually. She cites the resilience of corporate America. Meantime, Goldman Sachs' David Kostin also raising his S&P targets. He expects a 3% jump in the next 3 months, a 6% jump in the next 6 months, and an 11% jump in the next 12 months. Kostin cites earlier and deeper Fed easing and lower bond yields than previously expected, and continued fundamental strength of the largest stocks. His year-end target is 6,600. Yeah, I remember I was arguing with Kate, who we just had on last time she was on, it was April 11th. good time to buy.
Yeah, it was a very good time.
Really
to buy.
good time.
Yeah.
Not be sort of looking at. Right.
It's been a difficult market to handicap.
Yes. Yeah.
Next on Squawk Box, Joe Lubin, co-founder of Ethereum, home of the cryptocurrency Ether, on the buzz around institutional capital moving its blockchain and much more. And later, Senator Tim Scott working on a bill to make it easier for gig workers to access benefits and retirement accounts. He will join us in just a bit. We'll be right back. Ethereum captured the attention of major financial institutions, which are increasingly building on the blockchain and processing about 24 million transactions daily. The rise of tokenization and stablecoin hype also helping Ethereum-linked stocks. Joining us now to discuss the crypto market is Ethereum co-founder Joe Lubin. Joe, welcome.
Yes.
We were talking about this in the break, what's going on with Ether. If you take a look at the ratio, Ether to BTC ratio, it's been pretty much coming down for the past few years. Why is that? Why do you think there's that discrepancy?
So Bitcoin has had a very clear narrative, and it's got a value proposition that people can understand and get behind. It's had Michael Saylor doing a really good job growing the brand and buying lots of Bitcoin. So Bitcoin's value proposition is now. Ethereum's value proposition has been perceived to be in the future. We've been building scalable infrastructure, layers of enabling infrastructure for about a decade, anticipating that all the activity of the internet and the web will move to Web 3. And Web 3 is really the natural evolution of the web protocols, sort of a re-decentralization of the World Wide Web. So Ethereum is scalable enough, affordable enough, legal enough in the United States. It's very usable right now, but we haven't had the applications and we haven't had the consumer end users and the enterprise end users because former Chair Gensler made it really unattractive to use tokens or issue tokens or build applications in our ecosystem. So that is all behind us. We still have a lot of Ether out there and not enough activity to sop it up. And so that's a reason why we and others are doing the Ether treasury strategies. Yes. Not only is it a great business to run, but it's going to be critical to enable the supply-demand dynamics of Ether to right size as we build more and more applications.
So let's back it up because people think of a Bitcoin treasury company like a MicroStrategy, and now there are others who are participating in that model. And so you and your team identified SharpLink Gaming,
yeah.
Which is it the first Ether treasury company?
So there have been some other treasury companies. They're pretty small scale. So one that switched from being a Bitcoin miner to Ethereum. Yeah. So BitMine joined more recently. BTCS has not a large amount of Ether, but they've been really dedicated to becoming an early Ethereum treasury company. So we're at this point the biggest and making the biggest splash. Tom Lee is doing a great job. Big fan of Tom. Great narrator of the paradigm shift. So we look forward to welcoming other competitors, complementary competitors into the space and even collaborating with them.
What is the hope of this SharpLink move in terms of, does it demonstrate to the public? The public is used to thinking of MicroStrategy as a Bitcoin proxy and they use, is this to demonstrate, to sort of tell that story that you think isn't being told or hasn't told?
Yeah. It's about telling the Ethereum story. What does Wall Street pay attention to? It pays attention to being able to make money. What are we going to demonstrate? Because decentralization is the direction of travel for the world, we believe. We believe that we're going to see Ether and Bitcoin continue to rise over the next years and decades as we paradigm shift to more and more decentralization. So that's going to put a bid under these tokens, and the anticipation of us and Saylor accumulating more and more consistently, both in large chunks as well as just selling ATM. We're able to acquire tens of millions of dollars in Ether a day via these ATM sales, and so we're just going to stay the course and continue to grow the concentration of Ether per fully diluted share.
What is I'm curious, obviously you're an Ether evangelist, backer, believer, whatever you want to call it, but what is in the Joe Lubin crypto portfolio? Does it go beyond Ether? I would imagine it does.
In terms of tokens, so I work at a company called Consensus Software Inc. We publish the MetaMask wallet. We have a lot of developer infrastructure like Infura. We built a layer 2 ZK EVM technology called Linea, which is about to make some really exciting announcements and is about to change the game, I think, in terms of layer 2 rollup technology. We're going to be 100% Ethereum compatible, which nobody else is, and we're going to be beneficial to the economics of layer 1 Ethereum.
So I always have the same question, and I think it might be really naive. Joe, will you work with me like I'm a child? Would you do that?
Absolutely.
Okay.
But you're pretty sophisticated with respect to our technology.
I wish. So stable coins, I think they're fascinating, and they're one for one, and you have treasuries or whatever you back them with.
Yeah.
And I could see those being used for whatever you're doing, transactions globally, but they're still based on fiat. At this point, and Ethereum,
they're still very centralized. Yes.
Yeah, and it's based on fiat. And if Bitcoin eventually got to the point where it was transactional instead of just a store of value, wouldn't you rather be using Bitcoin to do everything because it's not based on Fiat?
So you want a stable numeraire, stable.
Could it ever get to that point? Because you cut out the middleman, and when you cut out the dollar and just base it on.
I think Ether and Bitcoin will be high-powered money, collateral money, and I think Bitcoin is going to be disinflationary for a very long time. Ether is disinflationary, but it's also deflationary when a lot of transactions happen because we burn Ether. So it may not be a great means of payment and numeraire, but both of them are the highest powered money on the planet currently, and this is why you see the Bitcoin treasury companies and the Ether treasury companies trying to accumulate as much of the highest powered money as they can, because if you have giant piles of high powered money, you can do things geopolitically and financially and economically that just nobody else can.
Right. I just wonder if Bitcoin ever becomes actually not only used to hedge against money printing as a store of value, but at the same time also, does it ever have that transactional quality?
We're very excited about stablecoins in our ecosystem. It's a validation. It's a great use case. First massive product market fit in the Ethereum ecosystem. Real world assets right behind it. But it also represents an existential threat to Ethereum, even while we want the US to be able to effortlessly dollarize the world, where stable stores of value is incredibly important. We want the US to reformat trade relationships and military relationships, etc. And having a politically strong US dollar and a weakened US dollar in terms of the exchange rate is going to be consistent with what the US needs to do. So that's great. Love that Ethereum's contributing to that. But we also don't want, say, another administration to come in, a very progressive democratic administration potentially, and start to see this massive stablecoin base on Ethereum, recognize that it's all based on centralized reserves in banks, and pull the rug out from under the Ethereum project. So there are stable coins that are based on collateralized debt products that are actually decentralized stable coins. And what we need for those things to become relevant is we need what's called greater decentralized economic bandwidth. We need the price of Ether, the price of Bitcoin to go way up so that they can collateralize much more decentralized stablecoins.
Joe, thank you.
Whoa.
I don't know if I was talking to a child, but it's very interesting.
Maybe I'm a child prodigy or something. He must have been. I think I'm going to invent Ethereum. Profound. Good to have you on. Finally, yeah. And please come back because I need maybe some follow up. That's possible. Up next, businesses and investors are hoping for some clarity on tariffs. Council of Economic Advisors Chair Stephen Myron is going to join us. As we head to break, here's a look at J.P. Morgan, Bank of America, and Goldman Sachs. HSBC downgrading those names and adopting a more cautious stance after a rally in that sector. Squawk Box. We'll be right back. I guess it was a nice...
happy with it.
The White House is out with a report this morning that finds that the prices of imported goods have not only fallen and haven't risen, but they've fallen, but declined faster than overall goods prices since February. Join us now with the details. White House Council of Economic Advisors, Stephen Myron, and okay, maybe now, but they're going up any time now, Stephen. One of these CPI or PPI prints is going to be frightening because of tariffs. No, we've been waiting and waiting, and you're telling me that prices have actually been declining.
Good morning. Thanks for having me. Yeah, so what we did was we looked through the details of the PCE inflation data and CPI too, and then at every good in those data, we looked at its subcomponents. And so what parts are originating in the US, what parts are originating abroad. And so we're able to really get into a holistic measure of how much everything is imported. And what we found, and this paper's on our website now, you can find it on the CEA website, on the White House website. What we found is that since December, and you have to compare since December because tariffs began in January, since December, the prices of overall goods in the PCE data have gone up by about 0.4%. Meanwhile, the price of imported goods, and that again includes all the components and the finished goods, the price of imported goods has gone down by 0.1% in this time. So not only is there no evidence that tariffs are leading to significant price pressures for imported goods, but we're actually finding the opposite in the inflation data. And this helps explain why overall inflation has actually been extremely tame since the president took office.
And that's core as well. I mean, I can understand maybe from energy, but it's core as well, Stephen?
Yeah, so if you look at the paper that's on our website, what the numbers that I just gave you are for overall, but we've got numbers for core too, and a similar pattern emerges in core, where maybe instead of the overall price going down for imported goods, it's relatively flat, whereas the price for overall goods has gone up by more. But you still see the same wedge by which domestically produced goods have gotten expensive, have had more inflation, much more than domestically produced goods, which are exhibiting none whatsoever.
But this doesn't mean that it's not still to come. I mean, we can't completely dispel all the fears because many people have said, well, it just hasn't happened yet. When we get some of these cooler inflation numbers that we've seen that have been really great to see, obviously, but there's always that caveat that, okay, it just, the effects of the tariffs is just not there yet.
Yeah, I'm sorry, let me just correct what I just said. The price of domestically produced goods has gone up by more than the price of imported goods. So it's still consistent with a pattern by which there's no inflation driven by tariffs. What you just said is won't it come eventually? And I mean, sure, eventually, a meteor is going to strike or whatever, but we've been waiting and it's been many months now, and that evidence has just not emerged. There's no sign of it in higher frequency pieces of data either. Like you see the various research put out by academics where they use scanner data. That just looks like noise and mean reversion. There's no sustained pattern of a tariff-driven price pressure anywhere. And the same thing happened in 2018, 2019, where critics claimed that there would be some sort of huge inflation, and we kept waiting and waiting and waiting, and it never happened.
But see, we've had, the president has put off and delayed some of the implementation. Whenever we talk tariffs, we slap tariffs on, but we've delayed the slapping of the tariffs a couple of times. If they were all to go in and reciprocal tariffs were actually in force, and if we don't make any deals by whatever the next deadline is, would you still expect that not to be inflationary?
Well, I've always maintained that there could be volatility in the inflation data, just as there's been volatility in some financial markets or volatility in some other economic data. As you saw with the Q1 versus what it looks like how Q2 is shaping up much stronger from a GDP perspective. I've always maintained volatility was possible in the price data too. However, I do expect, based on the basic economics of what economists call tax incidence, whereby the party that's more inflexible ultimately bears the burden of a tax or a tariff, I've always expected in the long run that foreigners, that countries were tariffing, would bear the burden of the tariffs. Now, that was a long-run argument. What we're seeing so far is that even in the short run, there's been no pain for American consumers at all.
Maybe the short run is too short, though, Stephen. What we've heard during earnings season from companies is that there was a pull forward of goods, and that perhaps, maybe now, those goods that had been pulled forward, ordered early, extra inventory brought in to avoid tariffs, that inventory level is now low or gone, and so the impact will now be passed on. Do you discount this notion of pull forward and selling those goods that had yet been tariffed?
Well, the only thing I can say is that we've seen no evidence of price pressures to date, either in the official data or in some of the unofficial, much more high-frequency data that are studied from individual stores that are studied by academics. And so, as a result, all I can say is we haven't seen that yet. Is it possible that we ultimately get some volatility in prices along the lines I described before? Sure, it's possible, but other things are possible too. Rare events happen. We get pandemics or meteors or whatever. So look, it could happen. I never say never, but nevertheless, there's just no evidence thus far of it happening.
But I mean, if you're going to compare it to a pandemic or being hit by a meteor, then it seems like you're really saying that it's probably not going to happen. It's very unlikely, and that pull forward of inventory, it may have happened, but it's not going to result in ultimately prices down the line being raised on consumers. Is that right? I mean, when I hear hit by a meteor or things like that, it sounds dismissive.
No. Sorry, I don't mean to be dismissive. All I mean to say is that prediction is difficult, and we should always speak in terms of odds and possibilities and probabilities, never in terms of deterministic. Like, I don't have a crystal ball telling me the future, and neither does anyone else. All I can tell you right now is there's no evidence of it thus far. It's possible it could happen, but we just have there's no basis in data for saying that that's the case. There's no data that would support that position thus far.
Yogi, primarily predictions about the future are difficult.
They're tough, and lots of economists pretend that they're much better than they are. The idea of giving a precise point estimate when the uncertainty intervals are so wide has always just struck me as nuts. And I think that economists should generally be humble, and that's why I'm framing things the way that I am.
Right. Why the outlook going forward is always more difficult than the outlook going backward.
Of course.
Because we know about it. The way we talk in this business, Stephen, let's talk about the OBB. Is it the OBBBB? OBGYN? The big, beautiful bill with so much conjunction. See Larry Summers. Wow, he thinks it's dangerous. Imagine that. Would you make the case, Stephen, and I've been making this case, that none of us like deficit spending, and maybe you argue that that it's not going to be deficit spending, or maybe the deficit will come down from the growth aspects of this. But maybe not all deficit spending is equal. If you deficit spend and just blow out a bunch of programs with the IRA or New Green Deal or whatever, versus cutting taxes and leaving capital in the private sector, maybe to do things with and maybe to grow the economy, there's a difference between those two types of deficit spending, isn't there?
Oh, absolutely, absolutely. And so using government money to fund, what may or may not be economically productive activities. And so you mentioned, some of the Green New Deal activities. I don't think the government has any edge whatsoever in predicting what kinds of cars consumers are going to want 5, 10, 15 years from now, whether those are electric or gas cars or coupes or sedans or convertibles or pickup trucks. The government really does not have a historically strong track record of predicting those things, which is why many industrial policies targeted at specific sectors can often end up failed, as you see, for example, in China, where they have empty cities of apartment buildings that nobody wants. Or that nobody can use. Whereas what's going on in the One Big Beautiful Bill isn't an industrial policy targeted at a sector that the government may or may not have a good sense whether it's a productive use or not. What's going on in the One Big Beautiful Bill is a generalized incentive to investment, but one that gives firms the ability to choose what they're investing in based on their knowledge of their markets. And so full expensing on new factories, full expensing on equipment, full expensing on R&D gives firms extremely powerful incentives to invest and to build out the capital stock of the United States so that we get more production, so that we get a more productive economy, better labor productivity, higher wages, lower inflation, higher GDP growth, right? But it lets firms choose what they're going to invest in, which is exactly what you want to do, because that's the basis of capitalism. That's the basis of a market economy, that households know what's best for them and firms know what's best for them, not the government.
The Treasury Secretary has argued several times that that you actually see the deficit shrink, and God help us if it doesn't shrink. What are we at in terms of GDP, 6 or 7% or something? But when you're spending, it's hard to see how that would really happen. You're assuming that there's going to be enough growth in tax receipts that the deficit comes down, or because it doesn't seem like there's that much spending. The cuts aren't as much as a lot of fiscal hawks would really like in this.
Yeah, sure. So look, we estimated, and this paper is also on our website, the One Big Beautiful paper and the One Big Beautiful chart book. We estimated that the totality of the President Trump's policies would bring down deficits relative to the tax hike baseline by about $8.5 to $11 trillion over a 10-year period. And let me break down where that comes from. We have our policies between the tax bill, the incentives for investment that we mentioned before, things like no tax and overtime. These are actually quite stimulative. Between those and deregulation, which is also extraordinarily pro-growth, because companies often don't build things because they find a snail. But if you make it so they can build things, you get more buildings. So between tax, deregulation, and energy abundance, we have GDP overall going up by about a point a year over the course of a 10-year window, which creates about $4 trillion of revenue from better economic growth. We've got a further $3 trillion of revenue from tariffs. We've got a further $1.5 trillion of reductions in spending from cuts that are in the pipeline from the budget that the Office of Management and Budget put on its website a few weeks ago. As well as from the efforts of DOGE reducing federal headcount. That adds up to a lot over 10 years. And then finally, because you're doing all this reduced borrowing from those savings, you've got lower interest expenses too, because there's less debt to service. So that's about $1.5 trillion too. So you add all these four things up, and you get to about $8.5 to $11 trillion. Again, as I said before, I think economists should be humble and not give a precise amount, because there are ranges about how, there are confidence ranges around all these things. But you add up all those things, and that's where we end up.
Very good. All right. Good. We'll have you back, and we will check whether if this works the same way as some of those the disinflation you're talking about. We will. It'll be amazing, because it's not the way it seems, Steve. But we'll check back with you, and hope springs eternal. Thanks.
Thanks for having me.
You're welcome. Up next, Senator Tim Scott working on a bill to make it easier for gig workers to access benefits and retirement accounts. So join us next. We're coming right back.
Media has filed with the SEC to list a new ETF called the Truth Social Crypto Blue Chip ETF. It will hold Bitcoin, Ether, Solana, Kronos, and Ripple directly, with 70% weighted to Bitcoin. Crypto.com will act as the ETF's digital asset custodian and prime execution agent, as well as liquidity provider. DJT shares are up % right now.
A Republican Senator, Tim Scott, has joined Senators Bill Cassidy and Rand Paul in legislation proposed to make it easier for companies to offer gig workers benefits without making them full-time employees. Senator Scott joins us this morning with the details. Senator, it's good to have you on this morning.
Thank you, Joe. Good morning. Good to be back with you. I hope you're doing great.
We're doing great. Hope the same for you, Senator. The three Republicans, would this ever be bipartisan? To me, it seems like it's something we definitely want to do, make it easier for gig workers to access benefits, and they could be portable.
Yes.
And then I'll bet you Democrats wouldn't like this, because there's a lot of places where they want to make they don't want gig workers because they can't do minimum wage type stuff, and I don't know, and guarantee other worker benefits. What's the problem with Democrats and gig workers?
You know, Joe, that's a great question. We need to go to California and ask about the PRO Act if we're going to have that conversation. The PRO Act basically said we're going to stop Uber drivers from making decisions on whether they're working for Uber, Lyft, or whomever. We're going to stop folks from delivering food. We're going to stop independent contractors in insurance and financial services. They want to have an oppressive environment for work. What we need as a country is exactly the opposite of what the Democrats want in California. We want an environment that is conducive to increase our labor force participation by giving workers the kind of environment that allows them to choose who they work for, when they work, and how they're going to be compensated. If we can get there by relaxing the tests on the common law with the NLRA, we find ourselves in a position where we can attract more people back to the workforce. And as you know, Joe, with the benefits for businesses and the big, beautiful bill, plus deregulation and an environment that attracts more workers back to the workforce, we can have this economy humming. Why Democrats want to stand in the way of working families finding their path to higher income, keeping their benefits longer, and not having leakage in their 401k plans, I don't understand that. The good news is I think there are Democrats in the Senate who want to work together for the working families across this country. Well, I think we'll get this done, actually.
It's confusing. I don't know if you will. It is confusing. It reminds me sometimes of like charter schools, or the idea that charter schools means that public schools won't be any good. And it's almost it almost looks like it's entrenched union supporters. Is that the same thing with this? Is this anti-union if you have portable benefits for gig workers?
It doesn't have to be without any question.
But is that what their argument is?
45% of the.
Yeah, is that the argument?
That's the argument coming out of California. Coming out of California, they wanted to do everything they possibly can to empower unions. What we want to do as a nation is give people options and choice. Optionality is incredibly important for the 21st century worker. They don't always want to be an employee. Sometimes they're better off being a contractor, so they're working for 3 or 4 different companies at the same time. That kind of flexibility allows for folks to meet their needs at home and at work, and frankly from an educational perspective as well. I used to be an independent contractor before I became an employer who hired independent contractors. So this is something that's quite personal for me. I started working on auto portability and 401ks back during the first Trump administration. The easier we make it for folks to have their benefits, 401ks and health plans, the more likely people are to come back to the workforce, stay in the workforce, and actually make a lot more money. Who's against making more money for the average American family? I'm not.
The great Robert Johnson, our friend, that's a huge thing that he's trying to work on. It makes no sense not to be able to move things around. It hurts the people you're trying to help. It's
exactly.
Yeah, go ahead.
You hit the nail on the head. Yeah, you hit the nail on the head. Bob Johnson and I actually partnered together back during the first Trump administration. If you think about the small 401k plans, an employee leaves the place of employment and they want to go work somewhere else. They either leave their money behind or they cash it out. That's what we call leakage. When you cash it out, that's devastating. First, you pay that 10% penalty. Second, you don't have that money when you need it when you're retired. And third, you get into the habit of not thinking about your retirement. Anytime we can put the employee or the contractor, the worker, in a position to keep their benefits, lock them up so it's there when they desperately need it when they're no longer working. This is
Senator, would you need 60 votes? I don't know how it's inscrutable how you guys operate down there half the time. So you got 3 Republicans. Would you need 60? You won't get. There's just no way. It's the board collective. They won't vote for you on this.
I believe that the Democrats won't have any chance at all to make sense in front of the American people. They're going to vote for this legislation when it comes to the full in front of the full Senate. We'll get it done. I'm very optimistic. I'm an optimistic person, but the truth of the matter is, on the banking committee, I was able to move legislation around fentanyl 23-0, on banks 22-1. There is a bipartisan coalition that's available if we thread the needle and sell it right. Let's not sell it as Republicans versus Democrats. Let's sell it as the American worker making a decision that's in her best interest. If we do that, we have a real shot at making this legislation a law.
I mean, can you name one of your colleagues on the other side of the aisle that would vote for this?
I can tell you that there are several on my bank committee where I'm the chairperson that I was able to get 5 Democrats to support the Genius Act, cryptocurrency, when the ranking member was opposed to it. So yes, there is a way for us to thread that needle. It takes
That's a totally different thing.
Joe, every bill is different. So what we have to do, buddy, is make sure that we keep working hard at that coalition, because the coalition's available. I've done the same thing with AI with Chris Coons. We continue to look for partners where there's common ground that makes common sense. If we find that here, and I think we can move it forward. It will not be from California. It won't be from New York, and it won't be from Illinois. But there are folks from other states that may work with us.
We've seen, some members of the Senate and House. They make a career out of writing legislation that is never going anywhere. And I just was wondering whether this is part. They know who they are, right? I mean, and it's I can't. If I told my staff that if I had a staff, which I don't, to do something that I knew was never going to pass, how do they do that? It's like to make a statement.
Yeah, we don't do that, Joe. We get things done. As a matter of fact, my apprenticeship programs that some people say no Democrats will support, Cory Booker has worked with me on that. So the good news is that we have really good, solid examples of bipartisanship. If it's red versus blue, we're in trouble. But if it's red, white, and blue, we actually win.
Okay, all right. Hope Springs. I've said that a couple times today. Hope Springs eternal, Senator. Good luck. I hope you are. I think this makes sense, but who am I? Anyway, thanks for your time today, Senator.
You're a smart cookie.
See you smart cookie. Thank you. Chocolate chip. No, I like sugar cookie. What's your favorite?
I think chocolate chip.
Yeah.
Yeah.
If they're made right.
It's like the go-to. Yeah. Up next, a list of free market movers. We had to break just getting from Wendy's. The CEO, Kirk Tanner, is leaving to become the CEO of the Hershey Company. The move is effective July 18th. Wendy's board of directors has launched a CEO search, and CFO Ken Cook will serve as interim CEO during that process. Back in January, outgoing Hershey CEO Michelle Buck announced her intention to retire in 2026. Squawk Box will be right back.
and make it count.
All right, welcome back to Squawk Box. I'm Dominic Chu with your morning movers. Keep an eye on NVIDIA shares trading right near its all-time high, $160.98. It hit last week. If it ends today at that level or above, 160.46, NVIDIA's market cap would surpass the record high close set by Apple of $3.915 trillion. And if shares reach 163.93, it would eclipse the coveted $4 trillion mark. So keep an eye on that. Meantime, take a look at the major banks falling after a group of downgrades at HSBC, taking B of A to hold from buy, Goldman and JP Morgan to reduce from hold. HSBC citing a stretch valuation following a melt up in stocks. Goldman has jumped more than 50% in the past year. JP Morgan, B of A also grown as well. So keep an eye on those. HSBC instead shifting its focus to super regionals like PNC, US Bank, and Truist. So keep an eye on all those banks. I'll send things back over to you guys.
Why talk about trillions when you can talk about billions, right? You know who that is?
No.
Dr. Evil, I think.
Oh.
One of those Mike Myers. Anyway, this is only part one. Part two tomorrow.
See you
You'll be here?
tomorrow.
All right. Make sure you join us. Squawk on the Street is next.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 of the New York Stock Exchange. Faber has the morning off. Futures stabilize a bit here after Monday's tariff-related sell-off as the market pins its hopes on more deal announcements, maybe some implementation delays. Got some bear steepening in bond yields. The long bond near 5% once again. Our roadmap begins with market fallout from the president's tariffs moves as Goldman and B of A raised their S&P forecasts. A major coup for Mark Zuckerberg, hiring Apple's top AI expert. And Amazon kicking off its Prime Day event. What's at stake for the retail giant amid the uncertainty over tariffs? Let's begin with the markets, though, trying to shrug off these tariff and trade jitters. Yesterday, the president was asked about the letters he sent to trading partners regarding steeper tariff rates. Take a listen.
Are the tariff letters that you sent today final offers, or are they negotiable?
Well, that's final offer.
So South Korea, Japan should take it or leave
We're
it?
subject to negotiate something that's fair, but we've talked to most of the countries, and pretty much they've had their way for many, many decades, as you know. And it was time that we just wanted fairness.
So, Jim, given that some of these levels are not that different from the ones we saw in April, does the market deserve to be 25% higher?
Well, look, I think that this was an ideal time to start being tough. It seems like the president recognized the stock market was up big. Yeah, I know you can say, well, that's somebody's looking at, but the fact is that it's up big, and he can go boldly. I do think that I'm not saying he's blushing. I am saying that if I were one of these countries, I would say, okay, look, I've been holding off, and maybe I can't hold off anymore because beginning on a certain day, we're going to start losing a lot of share. And I think that, look, I now look at this thing as, I look at the stock of Ford. Ford's probably the most hurt and most helped. Ford's making its first move in multi-years. And that says to me, not that the F-150 is selling well, best trucker. So,
yes.
But that something's happened. And Ford's going to take share. And if Ford takes share, these companies got to come to the table. They have to. They can't lose share to Ford, because Ford has been a whipping boy for them. That Ford has been, they've had their way with Ford long enough. And that's how you gauge this thing, because it is autos. And they're not, remember, Trump's not trying to get them necessarily. You see that you can either get away by building a new plant or by buying stuff. And it's quicker, of course, to buy stuff. But I've got to tell you, something's going on here that might be meaningful. And that is that this is the win for Ford.
The win for Ford, given the prospect that
it's going to cost
foreign exporters,
their stuff is now going to cost too much. Everything's going to be like the Range Rover. And I do think, by the way, that Ford would tell you, Ford has been saying, look, we're being hurt by minerals, we're being hurt by dumping, we're being hurt by the way that they're doing tariffs in Canada and Mexico. So, I mean, if Ford goes up, then it's real. It's real. It's not just bluster. And I think that that's what the president knows. I also know, I mean, yesterday we had Peter Navarro on, who's very controlled, but when you speak with Peter's saying, listen, you better get on board here, because it's pretty obvious this is real. And I think that if you put Ford on your screen, take everything else off, it's going to tell you everything.
Right. That's a great proxy. But why wouldn't a foreign country look at the last 90 days, see the can get kicked, and think I'm gonna play this one in summer reruns, as one said?
Because the piper's about to be paid. I mean, I think that you're going to find it's like when you come up from Mexico and you think that it's all going to be fun and games. You get to the border. You know, there's just lines of Walmart trucks because people trying to figure out what has to be paid, what's not. Take Raj Subramanian, okay? What is Raj doing at FedEx that's different from everybody else? He's got the tariffs. He knows the numbers. He's got the AI. I mean, he's ready. And I got to tell you, if you think it's all just fun and games, FedEx doesn't. FedEx knows the numbers. And so, and by the way, they knew it when in Brexit. Like, you knew that, oh my, here's the actual number. And you're going to start hearing from the dealers. Like, guys, we can't sell our cars yet. It's too expensive. And that's what's going to happen right now.
Interesting.
Yeah. And that's why Ford can take huge share. I mean, remember, this is to help American companies. It's also to bring more business in. You can see Katie Huberty with all those fine points, but the one that really stuck in my mind is great Morgan Stanley house, Reshore. And this thing is the proxy. And this thing hasn't moved. You should have like a 5-year chart of Ford. It hasn't moved. I mean, I always thought it was like it's like a straight edge. You know, you could use it as straight edge if you're like building something in your house.
Yes.
Oh, look at that. Okay. I mean, the far left was just the vast hope that Farley was going to change it and make it so it was less like the Lions. And then the Lions started doing well.
Well, I wonder how much of since we're on autos, how much is rolled in on that sort of binary? Do we go electric? Do we stay legacy? That picture got a little clearer.
Well, yeah. I mean, we no longer have to worry about that. I mean, because it's obvious that that we favor hybrid gas guzzlers.
Even the president's posts say hybrid doing great.
Yeah, I mean, Jim, listen to me. I know you watch the show. Can't the commercial with the F-150 lighting up the house? If I have to have my house lit up, believe me, I don't want my truck there. I'm going to have my truck and get the hell out of there. Wait, why would you? Wait, I want my house. I want it lit up. No, it must be because something's wrong.
Something's definitely
wrong. Now, General Motors, her thing, she's been buying back stock endlessly.
Yes.
So that Mary Barra, and she's a total pro. Gets no recognition whatsoever. I mean, what's that all about? I mean, she's trying. I mean, look at that. Look at that. My God, if David were here, he would recognize this as reverse head and shoulders. No, it's going right to 60. But it's happening, and I think that we all kind of feel like, well, wait a second, it's all bluster. Well, to move Ford stock, I mean, that's a monumental move.
Right.
I mean, that's like turning a franchise around that hasn't won a game in years. That's like the Chicago Bears.
Why would the president talk about August 1 as being maybe malleable, could be pushed, offering more flexibility than he sounded like?
Well, I think that he's, September's the new car season. I mean, I think he's like kind of between seasons. Hey, believe me, this guy's very for real. And he waited until the market's up big. We're all pretending that it won't matter. I mean, like, are you kidding me? It's really serious business when Raj Subramanian says, okay, I want that, look, we got to start charging it. When FedEx has to, FedEx is the principal way you get stuff in this country. And FedEx is going to be ready. I mean, thank heavens FedEx is going to be ready. They are so good. And we all miss Fred. I mean, like, we don't talk about Fred Smith enough because this man revolutionized, remember, we didn't have same day until this man. That guy was a visionary. But I'll tell you, he set up FedEx, and we're going to see FedEx stock go up. I mean, its stock had a bad last quarter. We'll forget that. That stock's going higher. And we watch Ford, and we recognize that the share is changing right now. And if I were a Korean car company, I would say, guys, Samsung's doing absolutely horrible. Don't hobble us anymore. And they're going to say, well, we make a huge number of cars in the United States. And then you're going to hear from the Navarros who say, no, you assemble. You don't make. All the stuff that has real intellectual properties made there and assembled here, it doesn't count. In the same way that Apple didn't count in India. I mean, I don't think people should be speaking to these guys. If you speak to these guys, they are not about to let this thing go. This is real. It's now real. As we get to September, they better make a move. These countries are going to start losing share big.
Right. Well, Japan continues to talk tough, although their negotiations continue.
They can talk tough all they want. I mean, look, we haven't even gone to the 58,000 soldiers we have in Japan. That's next.
Meaning?
We provide all of your defense, we are like if you look at your constitution and it's like ours, we promote the general welfare for you guys, we provide for the common defense. Well, why don't we just be the U.S. Constitution?
So you're looking for escalation.
Oh, yeah.
And you don't think that'll be market negative?
This market, great piece this morning about corporations.
Well, I was just going to mention B of A and Goldman.
Great piece.
B of A in particular says the U.S. might not be exceptional, but corporate America is.
Oh, and I love that. I mean, this is the era of the CEO, and the CEO can get anything done. And that's one of the why do we get an upgraded Vertiv today? Who's really running that company? Well, I would say that Dave Cody. Dave, he's picked a good CEO, but someone the latest upgrades Vertiv. Well, I mean, that's just like upgrade up. It stocks up at 130. Look at the semis. Datadog is an example of why we don't like the enterprise software anymore.
Getting added to the S&P tonight.
Yes, and so it's interesting to get out of it now. The semis, hardware. This is where we're ascended. Autos, we're going to be ascended. I find that we're obviously ascended in the data center. That's what I learned from CoreWeave last night.
Great interview last night.
I mean, there's some people who downgraded CoreWeave, and I don't blame them. The stock's up a lot, but now they're going to be able to use that market cap to be able to buy a lot of things. I see many areas of the United States the company's doing quite well, and I don't want to sell their stocks. I just don't.
Part of Goldman's thesis, as Costin raises his 3-month, 6-month, 12-month targets, is based on an earlier Fed cut, lower bond yields, which is not what we're getting today.
No, today's not in sync with David. But look, David has done something that I've always felt analysts should do. Be a little bit more circumspect, but when it gets there, you can raise. I mean, no broad sweeping stuff. Now, we love David. And why do we love David? Because David is very considerate of what's happening now. I'm not saying he's from the church of what's happening now. Right. What I'm saying is that remember he went away and wasn't as bullish. Well, now he's getting a little more bullish. Now, what is he getting a little more bullish ahead of the tariffs? I would say because the tariffs plus the $1,000 we're all going to get, which is in a low an index fund, some money coming in this market. Why are people avoiding not talking about the Trump baby windfall?
No, we mentioned it yet. We've mentioned it a few times,
well,
actually.
But I mean, it's coming into the market. Look out, it's a fire hose.
Right.
And, oh my God, we're seeing some great pieces. My favorite one, Bank of America. Biggest week of selling in almost a year. Big equity outflows led by institutions. Oh, they've really caught this rally. They really caught this rally. Oh, they're in the rally. Are you kidding? They've completely left the building. Because they're listening to all the stuff we're doing, like, wow. I mean, we have people come all the time that are very negative.
Yes.
Well, could they look at they have, I got to give them a Quotron or something? It's right on your PC. You don't need a Quotron anymore. It's happening. We have companies that are doing incredibly well, and we have analysts and hedge funds who come on and they're circumspect.
No, they're pressing their short bets. There's no doubt about that.
Why don't they just... Well, but you know what? I'm going to send them an interview,
Do you remember how negative we were the second week of April?
Well,
when we were talking about a 14 multiple?
Because we didn't know at the time that there'd be some flexibility.
And you don't think, but you do not think there
was that Dr. Yardini,
yes.
the Days of Armageddon, whatever.
Yes.
Well, no, at that point we felt that there was no, at that point Peter Navarro was totally in charge. And all you needed to know was the Vietnam, the 46%. Because remember, Peter very seriously believed that everything that was a Trojan horse, the Vietnam was a Trojan horse. Forgot the fact that there had been major wars between China and Vietnam is historically, even in the 50s, they hated.
You mean label washing and
yes.
Exactly right.
But it turned out to be when you actually talk to the American companies, when you talk to Laura Albert, when you talk to Dixon at Gap, it's like, wow. I mean, these companies should not be hurt. So so then we do a deal with Vietnam. It's quite good.
Right.
Everyone's going to have to come to the table to a deal like Vietnam did. They have to. They're going to start hearing from their companies, and their companies are going to say, "I just lost. I'm not selling any sedans. Everyone's buying a Ford sedan." Now, I don't think anyone's bought a Ford sedan for a very long time. But you know what? The Navigator, what is that? I sell a couple of Navigators. And then suddenly, like Jim Farley, you look at their multiples. Their multiples do not indicate what I'm saying. Well, actually, Ford does. Ford's now at 10. Ford had been at 6.
Not too bad, yeah.
Ford had been at 6. Do I want to be long Ford? If Japan and Korea don't come to the table, you got $20 stock.
That's
because the share is going, and those.
I mean, I'm not sure what it says about consumer choice.
Well, what? Huh?
I'm saying we're back to a period where we're going to start. making things.
It's about what you can afford.
Exactly.
Well, no, I mean the president doesn't care about that. He wants Korea and Japan to pay the price of protecting those countries for all these years with nothing. They buy nothing of ours. That's what he says.
When we come back, we'll talk more about AI today as we get some more AI pain for Apple. Meta reportedly hiring one of the iPhone maker's top researchers. Take a look at the pre-market. Jim's right, got a bunch of calls to get to as well on names like CoreWeave, Shack, the banks, and Tesla when we come back.
I'm here. I'm here. So we had a pretty good sell-off yesterday. A little stuffy outside. 79 in here. I got this money. $200. Okay. It's going down in this Memphis town. Make informed decisions.
It's another sign of an intensifying battle in the AI arms race. Meta has hired a top Apple researcher to join the Facebook parent's superintelligence team. This comes after Scale AI CEO Alexander Wang became Meta's chief AI officer, joining the company along with researchers from OpenAI and Anthropic. Jim, Roaming Peng is the name, and a lot of discussion about what it means for Meta and Apple too.
I think it's always amazed people that you don't have NBA, NFL kind of thinking when it comes to these guys. That there are people who are game changers, and why aren't they making a lot more? There are LeBrons in this game, you know, there are Saquons, and their salaries have all been negotiated by the CEOs. It seems like everyone's become a free agent. Now, this is something this industry has never had before, and I don't know how whether they know how to deal with a free agent. I don't think they do. I think Apple might be flummoxed by free agency because there was loyalty.
You mean like you're playing for Belichick in the golden days?
Okay. David Moranis, all right, in the Vince Lombardi moment, where Jim Ringo comes to him and says, you know what, I got a call from the Philadelphia Eagles. I'm making $10,000 a year. The Eagles want to pay me $12,000. And Lombardi says, get the hell out of my office. I never want to see you again. That's the way it's been.
Right.
The Lombardi way is the way that it's been in the Valley. That's all. It's free agency now, and I'm not sure these people know what to do because the only guy, or the Steinbrenner era. I mean,
I'm taking my talents to South Beach.
Yes, and I'm looking at Zuckerberg. I'm thinking, why has it never been like Lombardi, where he's trying? It's been negotiated, and then suddenly you blow it up.
Do you think it's odd that you would recruit from a company that has had, shall we say, hiccups in their AI evolution?
I don't know internally what really happened. I know that there's always the possibility that there's someone who's a malcontent now because it's something that didn't go well. I mean, look, I remember during the era of data general and digital equipment, there were people who realized those franchises were going down the tubes, but they weren't recruited by anybody because they were considered to be losers. I think that now we know that there are certain stars, and those stars are beginning to get their worth. And it's really amazing that it's taken this long.
Right. Meantime, as for Meta, Wells goes from 664 to 783.
Oh, I think Meta's so great. I think people do not understand that. Again, I keep saying that Zuckerberg has said, you send me a check, I'll send you the customers. Let's say, I really think that if you're Linda Rendell from Clorox, I think you just say, you know what? Here, Mark, here's $100 million, and just get me customers for the rest of my life. Because that's what they can do. They can do that. They can make the ads so that suddenly your eye is attracted. They know what you want. They know what hour you buy it. Now, of course, you can be on Prime, where I bought a pair of shoes, wingtips, Reebok, wait, they're for $125, and Jassy's now saying $79. I went right to Jassy. I said, what are you buying? See if he's come back.
We're going to talk about Prime Week as a deflationary force in a bit. We'll get Kramer's Mad Dash, countdown to the opening bell as futures try to find some stability after Monday's air pocket. Stay with us.
Monday's air pocket. Is that what you call it? Get my tea. I'll be right back. Monday's air pocket.
Kramer's Mad Dash as we count down to the opening bell. Got some shakeup in the food business.
Yes, Kirk Tanner, who just actually, I don't know, a year, took the Wendy's job now out, going to Hershey, which is, I think, is a big step up. The Hershey franchise is a lot stronger than the Wendy's franchise. Ken Cook, the CFO of Wendy's, moves over to the CEO. Michelle Buck is retiring. I've got to tell you, Carl, if we put a chart of Wendy's, I don't want you to look at it because it really does feel like a really bad Netflix show, of which there are only like a few. And will you look at that?
Yeah.
And is this a franchise on the brink? I don't know. Look, I could ask my wife. The bacon era was as good last week as it was 2 weeks ago, but I just don't think this is the one you have to worry about. Now, McDonald's has not been a great stock either, and people are worried about GOP-1s. But Wendy's is really, it's not come back yet. But Wendy's is, this is rather shocking for a person to be there. Do you know that Tanner had been at Pepsi for 30 years? So we could say, well, hold on, is this like Silicon Valley? Do you have a contract? I don't know. But this is something, this just happened. And it's major to see this kind of thing. This doesn't happen.
Do you think it might change the calculus on Hershey as a takeover play?
Well, it's still got that,
I know it's got the
very strange ownership structure, but it seems more of a jump ball now. Michelle Buck did a great job, I felt, in a very challenged industry. I mean, chocolate doesn't really go with Eli Lilly or with Novo Nordisk.
Although page 1 of the Times today talks about candy companies pushing back on the dye push from RFK Jr.
Yeah, but I remember speaking to Raymond LaGuardia, who had said, listen, food has to look like food. Is there anything worse? I mean, what does food look like? I mean, Soylent Green. I don't know what food looks like, but I'll tell you, a lot of the food those maraschino cherries
more
that
minutes.
my mom had on top of that Dole fruit cup, which I thought was a luxury. What did I know?
Ugh.
We'll take a break. Opening bell in a few moments, and don't forget you can catch us anytime, anywhere.
4 minutes, not moments.
Walk on the Street Opening Bell podcast.
What is a moment? How many seconds are in a moment? Is there a time lapse of some certain point at a moment? The moment is now. It's going to be a moment. Well, I have a feeling that they want to pull back in this market. A little bit, a little bit, so they can get the next breakout. That's what I think. And I don't know if they're going to get it. I have a feeling that they want to. Good morning, Mannequin. Good morning, Robert. Taco Tuesday. Less than a minute, 2 minutes. Oh, better put that up.
Tesla is rebounding a bit in the pre-market after posting the worst day in over a month, falling nearly 7%. EV maker losing $68 billion in valuation after Musk announced the formation of that new political party, the America Party, Jim, which is actually the focus of a few notes today.
Yeah, Dan Ives has a really great piece. Dan, we're all familiar with Dan. He talks about that it's time for the board to stand up. New incentive-driven pay package for Musk as CEO.
Goodbye. Goodbye. What we got here? PLTR. Watch PLTR. PLTR. Cheers. And it could still be overbought. Mobile's up 15 from when I saw it. We got AMD pulling back after a great run this morning. Give 50%, somewhere around 136. 136.20. NVIDIA breaking out a little bit. It had a breakout this morning. We had an active market this morning. PLTR, okay, here we go. Could it go down more? I think so. We could have a red week. And then buy it next week, long. Today's what? The 8th. So, 140 strike. Better buy one at 137. Maybe a couple of them. Jimmy was too late. Well, shoot. $30-minute. The 5-minute's at the 200 on the /ES. Let's get this other one up here, see if I want to trade it up. Yesterday I traded SPY mostly. Thought about buying an RV, but man, I'm hearing so many horror stories. Come on, hurry up. SPX. The 3250s. Lotto for SPX. $32.50 Lotto for SPX. Are you serious? I'm serious. Okay, we had a small breakout. We had 3 black crows. We're back at the orb. We did not hold previous high. Okay, get ready. We're going to see how bullish this day is right now. I've got some patience going on here at the sports arena. We have Sally on bass. Oh, here we go. Get ready. The 6250s. Let me see here. Leave that right off the orb. Today will be July 8th. Yesterday was International Chocolate Day, and I found out today that because I gave 2 pieces of chocolate to 2 lovely ladies, and they said, "Jim, did you know yesterday was International Chocolate Day?" I said, "You gotta be kidding me." $3.20. Yes. It's going to be an ugly day if this doesn't hold. I'm in this trade. $32.50 at $3.20. And I bought it off this here support right here. But $3.50. I got 2 contracts. So if we break that, next resistance is going to be that previous high right here on this 1 minute. You get out right now, $40 a contract. We're getting close to a resistance level. There we go, here we go. Uh-oh. Uh-oh. What the heck was that? Did y'all hear that? Anybody hear that? That's what I thought. And they asked, what was that sound? Well, that was the Washboardjim burp. Back in the year of 2025, it was very commonly known that after a good hot chocolate and a good trade, that he would indulge in a little bit of a burpage. We're at $3.80. I think you could make a business decision, but now we've gained respect of the old resistance. Oh, look at that, 390. $3.80. Oh, somebody asked me on YouTube a question here. Jim, my mother is listening to you and she would love to come over and teach you some manners. I don't think so. Tell your mother she got to wait. She got to wait her turn. Okay, we're back at a double bottom. Retesting support. $3.40, or should I wait? That's the question. Right here. We're going to see if I'm right. $3.30. There's $3.70. Oh, that's $3.30, you dick. He's up on Oracle 300%. Damn. They're now at $4. Out at $4.10. Thank you very much. Yabba dabba doo. Jimmy just got through calling a double bottom. Did you see that, Rob? So let's talk about this trade. My name is Washboardjim, and these are now at $4.30, $4.40. So I'm going to make a business decision at $100 per contract because we double top now. What was a double bottom turned into a double top. Do you understand? I'm all out at $4.40. Double top. I think I could write a perfect Sesame Street song on double tops and double bottoms. Let's see if I can come up with a line. Double top. Now I'm going to put, watch this. This is going to be a trick shot. Duplicate. Oh, that's supposed to be a double bottom. Never mind. It was a waste of time. Confirmation of the orb. He's back. $460.
With a 15 mole to a cell? What world? Don't you see the multiple expansions?
Some of the parts here, but they point out the track.
Oh, it's been awful quiet. I'm sitting here watching. Beautiful double bottom mirror. $5.10 now. Shoot. Well, Jeffrey Purdy. He's watching it here.
Road for everyone.
Well, hopefully this creates room, because the problem that we see on most roads is that the traffic is caused by the fact that each car has only one driver. If you were to double that up, it would cut it in half. Quadruple it, 4 people, it would bring it down by 75%. So one of the goals of autonomous taxis and autonomous driving is to reduce traffic. And I think that will, over time, have a significant impact in doing that. And, you know, a car is an underused asset. It sits in the parking lot or people's driveway most of the day. So if you can create alternative uses by having fewer cars that are constantly moving and picking up and delivering people, as well as picking up packages and delivering packages, I think you could eliminate traffic significantly.
Let's zoom in on Uber, obviously.
Uber
in this space. Going up in the stock as well. I mean,
that's funny.
Headline saying, you know, obviously they don't want to compete
Uber
with Tesla and Elon Musk, but you know they're doing something too. How are you looking at their sort of position right now in this space?
Well, that is part of the value, the future valuation, definitely of Tesla and of Uber, that they're going to have autonomous ride-sharing services with the vehicles being deployed everywhere that people can hail, just, you know, like you call with an Uber with the app, and being able to pick up and deliver people. And that's a big part of their future, their focus, and the whole business model for them, for a Lyft as well. And one of the interesting companies that I believe is a great play on autonomous driving is Mobileye. Mobileye is the camera and processor provider for a lot of the ADAS systems today that will eventually evolve to level 2, 3, 4, and then full autonomy.
NVIDIA at 159.
And Uber at a 52-week high today. I mean, what's next now for this company, do you think? Do you think we have legs when it comes to what we've seen here?
Well, they continue to expand in partnering with delivery services with retailers, as well as that they need to grow their driver base, and eventually the autonomous vehicle will enable them to grow their service base, because they won't be dependent on adding drivers.
What about Lyft then?
Same story. That's their goal as well, is to really supplement their service and eventually transition to a robo-taxi service provider, and that people could own cars and have them leased out on these autonomous platforms to provide pickup and delivery services of people and of goods as well.
No doubt this whole theme has been a bit of a tailwind for some of these companies. Obviously, many are looking at Tesla, you know, now as a sort of technology company because of this future of AI, robotics, and of course the robo-taxis. We saw that big launch a couple of weekends ago, which many were highly anticipating. But I'm just wondering, you know, if you see any sort of road bumps for this rollout. I mean, we've already seen that, you know, Tesla has caught the attention of the regulators now because of some of the videos that have surfaced. I'm just wondering how you're watching some of the risks.
Well, it's going to be some time before we see full driverless autonomy. So, I mean, Waymo continues to expand in more and more cities. They're just announced that they're going to come to New York as well as Philadelphia, along with, you know, San Francisco, Austin, and some other cities. So there's going to have to be huge regulatory changes to allow this. There's going to be a much more significant infrastructure to enable autonomous vehicles, including the vehicles being able to communicate with traffic lights, with other vehicles, as well as, you know, improved mapping software that provides you know, lines on roads that may not be there because they've either faded or covered with mud or dirt. So there's still a lot of components. And right now, all of the service is really just purely on board, whether it's like Tesla, that's camera driven, or LiDAR and radar driven. And so there's going to be a lot of increases and improvements in this technology. So I think that we're probably still 5 years away from complete driverless autonomy. but we're going to continue to see the improvement in the services, more test markets being rolled out, test markets with curated drivers on board in case of an emergency.
So you're saying sort of 5 years away from full autonomous sort of driving. I mean, is that everywhere?
Like that,
or
yes.
once we right, and then obviously that depends on how quickly we see some of that technological progress and some of
Yes.
the regulatory approval.
It could happen quicker
and also
as
public
the technology
acceptance.
advances.
People are a bit hesitant to sort of get in a driverless vehicle too. They're sort of psychological, isn't it?
Well, I think people are maybe hesitant, but they're also curious, because when I talk to people all the time that when they go to different places and it's available, they want to try it. It's kind of a weird
You want to
feeling
try
to
it?
be in the back of the
Micro
car,
try
you see,
check.
but I've done early on. I did the GM Cruise. I've done several Waymos, and then I've been in a lot of the service
280.
providers test vehicles, and to watch it work is fascinating.
Yeah, no doubt. Ivan, it's been an absolute pleasure. Thank you so much for that great chat. Ivan Feinseth, who is from Tigris Financial Partners. Appreciate it. Let's trade Uber with Tom White now, host of Fast Market. Let's start with your bullish example trade, Tom.
Yeah, Sam, if you look at this, implied volatility levels relatively low as the stock hit all-time highs in today's session. Stock's up over 60% this year. So the momentum continues to be to the upside. Not getting dented at this point by the autonomous vehicles. With momentum moving to the upside, how do you take advantage of that with a low volatility environment? So they report earnings that first week of August. So I kind of want to avoid that event, but maybe take advantage in this example of maybe a further rally into that event. B of A did raise the price target to 115 from 97 earlier today. So if you think that's going to happen, this strategy takes advantage of it. Going out to the August 1st weekly options that expire just before earnings, we're going to buy basically an at-the-money call vertical, buy the 97 strike call, and then against it to offset some of the costs and reduce the break even on this one. We're going to sell the 103 strike call against it. So just a bullish $6 wide call vertical to the upside. You're going to pay roughly about a $250 debit for the $6 wide call vertical. That means your break even is going to be $99.50 to the upside. That's only about 2.5% above the current share price in Uber. So it's not like you need a massive move to the upside. You offset some of the costs on the long 97 strike call that's bullish. It's got the higher delta. It reacts more like the stock by selling that 103 strike call. So maybe capping some of your gains, but also reducing your risk in this bullish position. With IV percentile rank only about 35%. So we're in the lower 1/3 basically of implied volatility levels that we've seen over the last 52 weeks. So this might be the way to play it if you think it's going to continue to grind higher into that earnings event while avoiding the earnings event.
Okay, so that's a more bullish example. What would a more sort of neutral trade look like, Tom?
Well, I think a lot of traders, investors out there feel like they've missed the boat here on Uber on this rally higher. So I looked at another strategy, a little bit shorter term as far as duration goes, where I'm going to look at a cash secured put in this name, where I can sell something that's out of the money to the downside on the puts, taking advantage maybe of a pullback where I can buy the shares cheaper, or if it doesn't pull back below the strike that you sold on this one, you still get to keep the credit that you collect. So I went out to the July 25th weekly cycle, so just 17 days to expiration, about 2.5 weeks in this one. And I looked at selling one of the 95 strike puts. You're going to collect a credit of roughly about $2 on that. So that's what you can make, $200. But this type of strategy is twofold, right? I either want to keep that credit that I collect on this one, or if the stock falls below the 95 level, I get to buy it at the break even because I collected a $2 credit on the 95 strike put. Takes my break even down to $93 to the downside. That's over 4% below the current share price. Now it's more capital intensive because you'd have to purchase the shares if you stay short that put over the next 2.5 weeks and it goes below there. But this might be the way to look at it is, hey, I missed the run up, but I'd be willing to buy it if it pulled back here a little bit. And this strategy takes advantage of that with the cash secured put.
Thanks for those, Tom. We'll check in with you a bit later. Well, we're about 30 minutes into the trading day. Hour 2 is coming up where we'll cover Amazon.
We are in 30 minutes, baby.
Gets underway. Morning Trade Live. We'll be right back here.
We'll move on PLTR.
Trading at Schwab is
SPY at a double bottom higher low
the power of Thinkorswim.
on 5 minute.
The award-winning trading platforms. Bring your trades into focus.
Prepare ye.
on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trade brilliantly. Trade with Washboardjim. The 6250s, we have a triple bottom right here. And I just missed it by a second, so I'm going to jump in these. Probably not as big now as I would have if I'd bottomed down here. 3 black crows with a spinning top and the inverted hammer. All we got to do is break that 63. So let's do it. I think you know what to do. Give it to 20. Please. There is. I got my first couple here at 320. Should have kind of waited for 310, but right now. $3. The 6250s at 3 and 320. With a triple bottom off the bottom of the orb. Come on, Jimmy. Let's go. This is not good. Okay. So I've got 4,275. We're going to hit the 200. Right now we're at 280. There's kind of at support, everything but the 2 minute. Yeah.
Test of the day is right here. Market bulls would like to see a bounce and a move back towards those session highs, which really aren't that far from where we are now. We're talking, 10 points or so in terms of today's trading action.
Okay, let's switch gears to
Alex.
the bond market. Treasury yields higher today, particularly on the 10-year, looking at 4.421, I believe, right now. How are you looking at things there? What does that mean for stocks as well?
$622 and
April,
28
March,
cents.
The initial reaction with some of these tariff concerns was yields lower, bond prices higher. Ultimately, we saw that pivot when yields started to spike and the Treasury market started to unravel way back.
Okay, get ready to
April.
add, Jimmy.
This time around, though, not a ton of volatility just yet in the bond market, but notably yields higher and the bond price continues to move lower. So a different reaction this time around, which I think is notable. You're talking range bound, though, with the intraday action.
Could go down one more candle.
The Treasury market has been very, very range bound really for the last quarter, continues to trade within that range.
2.35.
We're starting to move up those levels and get to the higher end when you're looking at yields, lower end when you look at price.
Yeah, as I was speaking to Michelle Gidley about it, seems to be a sort of a phenomenon in the bond space that we're seeing internationally right now. Let's turn our attention to gold as well. I mean, it's been some interesting moves in this asset class. I mean, particularly given, sort of the trade we were talking about last year. I heard someone this morning saying it seems almost like gold's tapped out.
Yeah, and one has to wonder if that's not the case, because you look at all the things that are going on in the background, you would think that these would be net positives for the gold market. Not necessarily been the case just yet. All that said, though, I've always said, one of the things for sure that seems to show up in gold is geopolitical tension. And if anything, maybe the temperature around geopolitics has come down a tad over the last several weeks relative to where it sort of peaked out for the year with the war between Israel and Iran. And so, if anything, maybe gold is cooling off because some of those fears have dissipated. But also, this could just be a consolidation period in the midst of what's not only been a really nice run over the last year, but really a 3, 4, 5-year run for gold, as its returns have really rivaled, the likes of the NASDAQ 100, which is not necessarily typical for gold. So perhaps a cool-off period, perhaps it's tapped out. But I also think it's a reflection of some of that complacency we've talked about in the near term and some of those risks coming out on the geopolitical space.
Ali Scobie, thank you so much. I really appreciate your analysis. All right, well, time now for the morning trade at Amazon as Prime Day begins. For more, we welcome in Jeff Pierce, Senior Manager, Derivatives Trading at Charles Schwab. What are your expectations, Jeff, for this event?
Well, yes, Prime Day's here, and we've got 4 days instead of 2 this year. So we have research firms and analysts coming in expecting some pretty big numbers. If we look at research firm eMarketer expecting to bring in a record $12.9 billion in the U.S. this year, up 53% from last year. An analyst at B of A said that Prime Day could generate more than $21 billion in gross merchandise value, up 60% from last year. They also said this would be about 10% of their gross merchandise value for Q3. Adobe on Monday said they expect consumers to spend a record $23.8 billion in online retailers during this 4-day event. Now, and remember, we've got Target and Walmart having discount events at the same time. This is going to be a good test for Amazon, though, especially if you look at some of their new tools, their AI shopping assistant, which helps them, ask questions and uses AI to refine those searches. They can use Alexa Plus to notify on pricing updates. And even though, this tool is expected to maybe not be used by everyone, it is likely going to give a boost to their marketing segment, which we've seen grow very quickly, exceeding $50 billion last year. And finally, these events are normally peak time for Prime member signups, which sits at about $139 this year, and of course offers that faster shipping, streaming, and the other services.
Yeah, good day for sales, not so much for margins, but as you say, really the metrics that are important are those Prime sign-ups and also, obviously around the advertising too during that 4-day event, which obviously has been extended, which perhaps tells you a bit about inventories. You mentioned some of the competition though. I mean, how do these other companies sort of stack up? And, is that a test for Amazon, or, on that level?
It is. I mean, Amazon has been the clear winner when it's come to these events, but we do have companies like Walmart and Target specifically that have started their discount days. Target's Circle Week runs from July 6th to the 12th. Walmart's deals are from July 8th to the 13th. But we've even seen names like Best Buy, Kohl's, and Dollar General put on promotions ahead of Prime Day in an effort to try to lure consumers with some of those earlier sales. I think consumers are going to be hyper-focused on deals to try to fight tariffs. Of course, we've got some tariffs that, potentially go off pause here soon. I think investors are going to be interested in seeing whether or not these deals are worthwhile for the consumer, or if they're still afraid to spend because of this environment. For Amazon, Prime Days have slowed over the last few years, typically only single-digit sales increases, but because in part because they host more events throughout the year. It'll be interesting to see whether this one makes a bigger splash now that we're seeing it at 4 days instead of 2.
Okay, and so what does this all mean for the stock? I mean, trading down, shares lower by about 1% this morning, but, where do we go from here?
Yeah, historically, Amazon shares have gotten a little bit of lift following Prime Day, gaining a little over 1% the week after the event, a little over 3% for the month after. I think we're going to have this event. We're going to then see our Q2 report. That's where we'll see whether or not this is worthwhile for the company and really made a big splash. We're also going to see whether the consumer is likely to continue to spend throughout the rest of the year. This event goes across 20 countries. They've got those new enhancements. They've got their new big deals, which they're launching this year. I think that's what investors are going to be focused on, whether or not this growth that we're seeing out of the third-party seller service, the web service, the advertising, whether all of that is going to continue and the consumer is willing to spend in the face of these tariffs.
All right.
Exactly.
Wait and see. Thank you so much, Jeff Pierce, for
They
that.
were at the 200 right down here.
With Tim Bigham, options strategist at Buy Alerts. How are you approaching your example trade on this one?
Yeah, absolutely. Looking really for continued consolidation in this stock.
Small
It's
little
been kind
nap.
of the big underperformer of one of the big cap, mega cap stocks in the NASDAQ 100, certainly trailing the triple Qs on a performance basis by about 6% this year. And as Jeff and you alluded to, you normally get a slight bump post, Prime Day, about 1% or so might get that lift there. July actually has been by far the best performing month for Amazon and the market generally since the financial crisis ended some 17 years ago, showing almost a 7% gain for the month here. So I'm cautiously, I guess, somewhat bullish on Amazon, although I think the market's gotten ahead of itself, so it's kind of a yin and yang. I think we'll continue to bleed out sideways. So taking advantage of what is somewhat elevated IV has popped recently in Amazon, and just selling a short-term iron condor, the July 18th traditional 235, 237.5 call spread, and 215, 212.5 put spread, basically with a nice cushion on either side from the current price of the stock for the shares to move up or down here, collecting about 75 cents or so, risking
We got a snake off the 200.
So like that risk return here of about 42% if the stock stays somewhat range bound, and we have earnings at the end of the month, so I think that'll kind of mute the stock reaction as big moves in front of earnings.
Okay, so cautiously bullish, as you say, a lot of wait and see mode when it comes to this, particularly when it comes to the report card, but also with regards to a little bit more visibility perhaps on tariffs too, as Jeff Pierce was describing just before you came on. I mean, there's a lot of metrics for investors to sort of, look through. What are you looking at specifically? What's most important?
Yeah, I think, if the companies kind of give more of an all clear that business hasn't been hurt that bad, certainly Amazon being one of them going forward, I think that will provide a little bit of relief. But, looking back,
VLTR's retesting.
Stocks generally at extreme simply because AI has kind of outweighed.
Yeah, blah, blah, blah. Blah, 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 blah. I want Caroline back. No one does it better than Caroline. 225 from SPXs. Let's go. Okay. We're 245 now. I think I'll be able to get out if we can hit the 50. SMA. Right now we're at a resistance. Semiconductors are up today. Go get my water and I'll be right back. Seems like the market's been open for a while, not very long at all. 48 minutes. No.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today. –
the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live, everybody. Let's focus now in on crypto. Joining us, I'm pleased to say, is Ben Workman, who is the Chief Investment Officer at Bitcoin. I'm so glad to have you with us on a day like today when things are a little bit quiet on the equities front, but we have seen actually the price of Bitcoin picking up. What is that telling you?
It's telling me that there continues to be strength in Bitcoin, and there's a ton of demand that's entering the market. And you've seen that with all the announcements and the emergence of all these Bitcoin treasury companies, is that these corporations that are adopting Bitcoin as their reserve asset on their balance sheet, they're providing a higher structural floor for Bitcoin. So you're not seeing the same drawdowns you used to see when there was weakness in the market. Typically, you would have expected tariff announcements like we saw yesterday to start having Bitcoin trade like a risk asset, but it stayed really resilient, and I think today it's trading just below 109,000, so it's been holding up really, really well.
Yeah, it absolutely has, and I suppose that sort of gives us a sense of how this asset class really trades right now, you know, particularly because we haven't seen it having to undergo extreme duress just yet, but certainly in these sort of minor bouts of volatility, we do see some interesting trends there. Back to obviously the tariff announcement, we've also had the big beautiful bill too, so from a headline risk standpoint, I mean, how are you seeing all these stories feeding into the broader narrative for the crypto space?
Well, Bitcoin's picked up a lot of momentum as a store of value asset. You constantly see it compared to gold, and one of the things that you're combating against with a store of value asset is the devaluation in the US dollar. So when the one big beautiful bill came out and got passed, what you saw was a big increase in spending. It was going to add like $2.8 trillion to the US deficit, and people are starting to get nervous about that. We're constantly looking for that moment where we think the politicians are going to come and they're going to right-size the budget and they're going to balance things, but we haven't seen that. So what we can depend on is inflation and devaluation in the dollar, and because of that, people are looking for alternatives. And one of those alternatives in the digital age that they're looking for is Bitcoin. It's got all the properties that gold has, except it's made for the modern age, for the digital age. So absolute scarcity and supply is one of the things that makes it highly desirable for both individuals, corporations, and nation states. You're seeing everyone come to the table to play Bitcoin.
Well, that's right. Obviously, we've seen a lot more sort of mainstream adoption, sort of the institutional money coming in as well as not to mention, obviously, a sort of more crypto-friendly White House too. Do you believe that that's going to continue to drive things forward, or does it need a little bit more of a tailwind?
I think it's going to continue to drive things forward. You've seen so many barriers move out of the way of Bitcoin and the other digital asset space where they're no longer thwarting innovation. They're embracing it now. And if the U.S. wants to be a leader, that's what they need to do. And you're seeing that through several of the bills and the acts that are coming through. You've got the Clarity Act that's coming out now. That's going to start putting some real definitive lines around these different types of assets and classifying them and telling them how the reporting needs to happen. So they're getting acceptance now, and that's going to continue to provide tailwinds. But that acceptance is also driving the adoption into corporations. One of the things that was holding it back was there was so much regulatory uncertainty in the past, and so it was a very difficult decision for executives to decide that they were going to embrace Bitcoin as a part of their own corporate strategy, but now you're seeing it happen in droves. So just this morning you saw an announcement, $384 million raised by a company called Saquons, who's going to be starting their own Bitcoin treasury. And it just shows that these executives that are out there, and the Saquons management team is among them, are really believing in Bitcoin as digital capital, and they're wanting to make that a core part of their business now.
Talk to us about this sort of treasuries playbook, because it is something that sort of propped up around 2020, but didn't really sort of, I suppose, become something that we talked about until about 6 months ago. So it is fairly nascent, you could say. I mean, so talk to us about, what we're seeing here and how much traction it's got.
Yeah, 5 years sounds like a long time when you say it, but with all the activity that's been happening recently, it really feels like more of a recent phenomenon than it is. Strategy was clearly the pioneer here, and Michael Saylor really viewed this as a way to reinvent a company that he deemed a zombie company. They'd lost the growth in the core business, and they needed a way to reinvent themselves. And what he found is that because of that absolute scarcity in Bitcoin and the continuous devaluation of the dollar, he had to turn to the balance sheet to drive value for his shareholders. So he changed the metrics and the KPIs that his company was following, and he now focuses on building the Bitcoin per share. So investors are now looking at how corporations are bringing Bitcoin into their own strategic plans to build that intrinsic value underneath each of their shares, by undertaking transactions in the capital markets, whether that's issuing equity, issuing bonds, issuing preferred equity offerings. And through each of those transactions, the primary goal is to raise the Bitcoin per share and bring more value in for your shareholders.
Okay, and I mean, how sustainable is this, when it comes to sort of Bitcoin treasuries? I mean, is this something that we see has a very long runway? Because, I was reading some analyst notes out sort of suggesting that, perhaps some of the companies that are getting into it more recently have a little bit less of a lifespan, potentially. I mean, does this have legs?
This has legs, and it has legs for a long time. I think that people see the announcements and they start to assume that this market's more mature already than it is. But what you have to realize is there's relatively little scale out there. Strategy is really the only company of scale, where they're about $100 billion, $120 billion company now. The rest of them are much smaller. A lot of them are below 500 million in market cap still. So there's a lot of activity that's yet to be seen here, and I think that now that the playbook is evolving and they're seeing the power of issuing preferred equities and being able to tailor-make products for institutional investors, where there's $100 trillion of institutional capital that can't come by Bitcoin itself, but it can buy equities and credit instruments.
Not good.
And that's the power that these companies are bringing to the market, is they're innovating around that space and bringing new, highly desirable assets into the market that they can participate in.
Yeah, it's fascinating,
Not
isn't
good.
it? And it's not just in the US. We have seen a sort of global adoption and expansion of this trend. Talk to us about that. I mean, where are you seeing the most excitement around that?
Well, you're seeing a significant amount of excitement in Japan. Japan has been a yield-starved country, but it's also one of the largest economies in the world. So a small hotel company called Metaplanet launched in Japan, and what they found was that they had an opportunity there because of the tax treatment of Bitcoin. So in Japan, if an individual is holding Bitcoin, their tax rate is going to be around 50%, but if they're holding it through their version of a retirement account, a NISA account, and they buy exposure through a corporation like Metaplanet, their taxes drop down to 20 to 25%. So there's a significant difference there that makes it highly desirable in that market. But with the preferred products and being able to offer yield to the market, yield is a problem worldwide. Countries are starved for yield, investors are starved for yield. And so these Bitcoin treasury companies being able to take advantage of the growth rate of Bitcoin relative to the devaluations in the dollar and provide those yields to the market is a huge service that's onboarding capital at a really rapid pace.
Yeah, it's interesting because you sort of started this conversation off with, I suppose the world becoming a little bit more digitally savvy as well. And Japan's a funny one because, I think they only phased out floppy disks a couple of years ago. But and that's such an interesting anecdote. And so what's sort of next for this space then? I mean, now that you see more of the adoption, where do we go from here?
I think this started as a very small movement, and you saw small companies that were adopting this, but I'm expecting that trend to grow. And I think you're going to see more and more larger corporations adopting this, not necessarily the leveraged aspects of it and issuing securities, but...
Okay, SPY, we hit my first support, 619.74, and I had a pivot point at 618.69. And there are a few supports before you even hit that, before you get there. So I'd call that a low. If the 74 does not hold. PERIOD. Period. Did I say that with authority? This guy, he's something else. His name's Washboardjim. Does anybody remember me mentioning something yesterday? You remember Lulu? Lulu. Lulu just broke out. Mm-mm. Oh, yeah. Nice little rebound here on 62.50s. Back to $2. It's 2.15. We could get back to the top of the orb. But I have a feeling I want to get out of them right here. Yeah, yesterday I mentioned Lulu. Shit. I forgot what I... Well, it could have been the 240s. Oh, looky, looky. Oh. Yeah. Woo! Oh, what? Oh. We're definitely at resistance. Now we could come up and definitely clear this here next one. And that'll be a nice bounce up to the upside. Somewhere right in here. Oh. Here we go. The crowd is going wild here at the sports arena today. Then I'm going to get out of these here trades here. Out at 285. Now they're at $3. Some guy put a $10 million on a bet on Tesla yesterday. I'll be right back. I gotta go do something.
Breakout during the past few sessions. We were traveling within an upward channel after hitting those 52-week lows. For the most part, moving within those boundaries.
Nice rebound.
And we had our big breakout on very heavy volume. Notice volume spikes at least 50% above the 50-day moving average of volume. That's that gray line here. So we were seeing volume more than 3 times the typical daily average here. So big volume on a strong move often shows conviction on the part of traders here. So now we can see that we are holding on above that supportive area for now. RSI remains high, but it is slipping out of that overbought area. Commonly, when we see some kind of breakout situation, we see the initial push to the upside, a retreat to a supportive level, then a continuation of the trend. Not saying that's going to happen or that's what's in the cards here for this stock here. Just saying it's a common situation, and now we're at that point of potential support. So traders need to decide what to do with that information here. If we were to look for further support to the downside here, well, we can also see we have a volume node lining up with our green line near 144. Heavy trading at this area lends additional weight to it as a supportive region here. We can also see volume picks up again near the 130 level. To the upside, we can see that where we stopped during the past couple sessions here, around 154, 155, another heavy volume area, matching up with a series of lows and then a subsequent high, as well as our +2 standard deviation channel. So 155 resistance to the upside, 136 or so to 130 for support.
Thanks for that, Rick. Getting back to Jenny, KLAC downgrades now at Wells Fargo. What's the story there?
So the story there is a downgrade to equal weight from overweight. However, they did raise their price target to $920 from $870. So that always to me says that right now you're considering valuation usually, and you're considering the outperformance, which is exactly really what they noted in this overall downgrade, saying that shares have significantly outperformed the group, now trading well above the median price to earnings at around 26 times. So for that reason, Wells does struggle with the drivers required to further deliver 2026 upside to its already above street estimates, lowering now their 2026 leading edge forecast as they do expect spending to be driven by right now what we're seeing from Taiwan as far as its 2 and 3 nanometers in Arizona, as well as highlighting this is still being a pretty major transition year for names like Intel as well as Samsung. So 27 analysts do cover this name, and there are no bears. There's 16 buys, 11 holds, and an average price target of $828. So that does imply actually about 10% downside from where we are trading. Street high is well over $1,000 a share, $1,035. The low though is $590. So that just I think illustrates the very wide right now range of conviction from the sell side. So 920 out of Wells, then I think contextually speaking tells you they're still definitely in the more optimistic camp, just perhaps taking on a bit of a more sideline approach, with shares now having risen about 44% on the year and only about 1.5% off of all-time highs. So I think that speaks to some of the recent outperformance. I also think when we talk a lot of these tech or semiconductor names, it's important to differentiate, where they stand and where they operate. This name, for example, does have about 11% of its revenue derived from the U.S. It is hugely exposed to Asia. If not, I would say the majority of their sales are from Asia. So they do generate about 43% of their revenue in the last fiscal year from China, and another 18% roughly from Taiwan. So North America, third largest market there. Japan then is next at around 10%. But I think safe to say this is a great read on the more so what we're seeing developmental wise in Asia, less exposed here, of course, in the U.S.
Thanks, Jenny. Okay, take us through the technicals on this one, Rick.
Yeah, so this one we're seeing a pronounced rally off of those 52-week lows that we hit, 550, 133 during all the tariff news. From there, we've risen about 66%, and we broke above an important area. There, our green line here, 830. If we were to backtrack over here, we can see, once again, it was the high point after a gap down, then a repeated ceiling, a persistent area that the bulls just couldn't quite crack through. Then we had our breakout here, our retest. Like I was saying for our last chart, we had the breakout, then the retest of the old resistance, which then becomes support. In this case, we did continue the rally to the upside after a bit of consolidation at another important high point, 896.32, all the way back there almost off the chart. That's the all-time high for this stock previously. So now we have a push beyond that level, 928.02, the new high water mark here. But it seems like perhaps momentum is slowing down a little bit. First, consider the general shape of the price action, a rising wedge here, kind of a contradictory to the name. The rising wedge is typically regarded as more bullish. It suggests slowing momentum, and the pace of the highs is starting to lose a bit of steam here, and that's really what the RSI is telling us as well. You can see bearish divergence here, price making higher closes, RSI trending downward here, despite also having an intact green upward sloping trend line. So this symmetrical triangle type of shape here, this compressing momentum, does suggest that things are perhaps
right to the shoulder line,
a little bit here.
To the top of the orb.
It's the consolidation phase before the next leg up. I'm not saying it's going to go one way or the other here. If we do keep moving to the upside, plus 3 standard deviation channel, 3 standard deviations above our linear regression line, comes in at about 976 right now. That could be one area to watch. Our +2 channel lines up with a volume node near about 892. This could be another supportive area. We've also got our 21-day exponential moving average, our short-term moving average, near about 877 or so.
Thanks for that, Rick. Okay, Jenny, lastly, Shake Shack downgraded over at Loop. Why is that?
So downgrade at Loop, and I will say this name has recently looked so strong in the overall discretionary space, but it's also gotten very expensive. So Loop today maybe sharing in some of that thinking with a downgrade to hold from buy. Unchanged price target though of 127, so that would imply weakness from where we are currently trading just below around 140 a share. The stock recently surpassed their price target after surging approximately 60% just over the past couple of months. And they said that while they remain positive on their near and long-term...
Shake Shack. Man, I've ate there probably 5 times. If that. We're at the VWAP on the /ES. And we're at support 62.30.79, which was resistance on the SPX. So we're at got a double support level here. $2.75, the 50/20s, 270. Can we go lower? We've had a pretty solid support. The confirmation right here, man. Yeah, man. See, there's the other confirmation right there. So that's 3 confirmations. Did y'all see that? No, I did not, Jim. I can't believe you found that. Great eye, James.
And around that area was the old ceiling here, lining up with our red line that the bulls have managed to overcome here. But, similar to our last chart again, symmetrical triangle shape on the RSI, declining momentum, bearish divergence here as price, kind of is struggling to find a foothold and hang out above these levels here. For now, 139 is the place to watch as we head into the close of the day. If we were to move lower beyond that, our green line here, 129, another ceiling that price repeatedly bumped into on the way up to these levels here. Also another high point, low points, and high and low points there as well. So we also have our 21-day EMA coming in just below 134 between that area as well. If we were to assess our volume study here, we can see pretty heavy volume near the level I mentioned earlier, near about 129, so that could be a supportive area. plus 2 channel for resistance comes in at 152.36. Could be one area to watch. And a quick look too at our 5-year chart. It's interesting because if you were to look all the way back here, the all-time highs 138.38.
It did not hold.
That's where we got stuck last time. That's where it's looking like perhaps we are pushing above now. Remains to be seen though if this move can hang on.
Great stuff, guys. Thank you so much for your analysis and your breakdown there. Rick and Jenny, appreciate it. After the break, we will discuss the day thus far with our market meetup panel. That's next on Morning Trade Live.
Well, we hit the 200 on the 1 minute. And on the 2 minute, we hit the 200. So that would have been, I would have took that trade maybe right there on the 2 minute. Per scalp. Yeah, I would have probably took that. If I could have got in it. Pretty sure of it. 98% sure. For scalping, nothing else. Unless it just felt different. So we will wait. Look at Tesla. I've been here too damn long. Tesla. New high. God darn it, I knew something was up. Beautiful flag. You got a Head and Shoulders and a 1-2 Freebus.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
We are experiencing that.
Schwab, a modern approach to wealth management.
Joining us is Kevin Hinks and Dan Grant.
We're at another support here on the SPY.
So I'll start with you, Dan. It's a bit of a flat day. I mean, what's your assessment of what's going on out there?
Yeah, what's going on, baby?
Yeah, so this is my first day kind of back after a week off, and I did notice that the yields are very close to unchanged today. Ahead of supply, we've got the 3-year today, the 10-year tomorrow, and then on Thursday, the 30-year bond auctions, FOMC minutes tomorrow. We had a big drawdown in the market. I walked in, there's a lot of red on the screen this morning, and we're kind of going back to green a little bit. World's most valuable company as far as market cap, and Nvidia is still on a tear with a VIX down at 17. So don't think that it's going to be, I don't think there's anything to stop it right now.
Yeah, no doubt. Kevin, I mean, you know, you and I were talking at the top of the show about how it's a bit of wait and see mode. The letters around.
$2.10.
So we're just waiting for a bit more confirmation and visibility now on these tariffs. So what's your assessment of how?
Oh, shut up. That's my assessment. 62.50s at $2.10. He's taking a risk, he's taking it twice, finding out if I'm naughty or nice. Someone's saying be careful. Oh, 180. See, that didn't work out too good. Here we go again. I'm sure we're gonna hold that. Got a head and shoulders. .35. We're back at a double bottom here, so we got to hold. Ooh. Let's go. Hit my lower support, so this is one I've been calling most of the day. Gotta hold it, gotta hold it, gotta hold it. I don't know what happened to Caroline.
Joining me there for today's morning panel. Thanks for joining us on Morning Trade Live. Trading 360 is coming up with Diane King Hall coming up next.
We gotta break to the upside. Oh God, come on. Okay, we're patiently waiting. We got a double bottom here, snake breakout, pull back. Newer low. Could have probably put a little caution to it. Uh-oh. I'm not going to hold on to this one because well, once they let it go, they let it go. Come on. The MD had a nice bounce back, and Meta's got a new low. Meta. $285. Route 170. PLTR had a new low. Interesting.
Monday. Over in the tech sector, you've got the NASDAQ 100 just a touch above the flat line, up less than 0.1%. Once again, looking at range-bound action there. Dow under a little bit of pressure, off by about 0.33%, extending the losses that we saw on Monday, where the Dow finished down by 1%. We'll see if that pressure remains on throughout the session for blue chips. Russell 2000, that was the weakest performer to start out the week yesterday, losing more than 1%, but regaining some of the ground that it gave up to start out the week. You are looking at the Russell 2000 better by more than 0.5%. All right, let's take a look at some of the other price action that we're watching today, some of the other asset classes. Yield on the 10-year up 3 basis points there. Dollar little firmer, up a little bit more than 0.25%. Gold off by more than 1% today, trading closer to 3,300. Crude oil marginally higher at the moment, up by just shy of 0.25%, above $68 a barrel for West Texas Intermediate. Bitcoin a little bit higher, up a little bit more than 0.33%. We continue to watch that choppy price action when it comes to Bitcoin, which has been typical of the past couple of summers, extending that pattern to a third summer. For a look at one of the top moving stocks we're watching in today's market, I'm joined by Alex Coffey, Senior Equities Contributor and co-host of Next Gen. Take a look at Uber. It's under a little bit of pressure today, but it hit an all-time high yesterday. And it's got one bank more constructive on it now. What's the details here?
Yeah, good morning, Diane. Bank of America keeps Uber as a top pick for 2025. It remains a buy-rated stock, and they're inching up. Well, actually, let's call it flat out raising their price target from 97 to 115.
No.
This, of course, due a little bit probably to the price action of the stock as of late, but some of the reasons cited: the no tax on tips provision of the big beautiful bill includes 1099 workers, including gig economy Uber and Lyft drivers in the deduction. And they see this tax benefit as a modest tailwind to supply, indirectly supporting take rates. They also cite Bloomberg second measure data showing modestly accelerating bookings growth for Uber, and again, keeping this as a top pick for 2025. Now, analysts as a whole, Diane, 98.20 is the consensus price target compiled by Bloomberg, factoring in 50 different analysts. 75% I should say, of the analysts are in a buy camp, the balance in the hold camp. And this general movement that we see from Bank of America today, I wouldn't be surprised if you start seeing more of that. Just a couple days ago, it might have just been on, over the weekend, Ken Gorelski over at Wells Fargo did something similarly, moving their price target from 100 to 120. So, given the price action of Uber, new all-time highs, if you remain bullish this stock and it caught up to your price target, probably either a rating change or a price target adjustment is in store.
Yeah, look, I'm not surprised to see this move, especially what's interesting about how Uber is performing this year compared to last year's. Last year, there were a lot of worries about the threat of autonomous vehicles and what that would do for market share for Uber. It feels like that's become, just a non-issue, or just, kind of in the rear view mirror when it comes to the potential threat factor, especially even though we've seen some developments on that front. It feels like investors don't care about that now. Anything else stand out to you when it comes to this upgraded view from Bank of America or any other analyst activity, Alex?
Well, I would just kind of comment on your point, which I don't think that investors don't care about autonomous vehicles, what it would mean to Uber. I just think that they think Uber is going to be a part of that, and they're going to be included in that process. It's a network, it's software infrastructure, and brand awareness does have value And if they can get either partnerships locked down with companies like a Waymo or a RoboTaxi or whatever it might be to license out that technology, if anything, it could be a boon to the stock. I would argue the technology is existential for Uber. We saw how quickly this space can be disrupted as Uber disrupted the taxi cab business. They can't get complacent. They're going to want to make sure they have something lined up for autonomous vehicles when that really starts to roll out in the coming years.
So in other words, that the view is, Alex, if I can, put a fine point on the point that you're making, that it would be autonomy or autonomous vehicles would be more friend than foe when it comes to Uber.
As long as they have those deals signed and that technology implemented, if they get cut out of this in some way, the Waymos continue to go direct to market, the robo-taxis go direct to market, and Uber doesn't find a way of either getting that technology broke through on its own or licensing it out, you could see how this could be very risky. But I think the market right now feels and is pricing it as if Uber is a part of those conversations and still brings value to the space, and it's going to be included going forward.
All right, that's our Alex Coffey, senior equities contributor and co-host of Next Gen, with a look at Uber. Shares under a little bit of pressure, but they hit a new record yesterday. Let's get some insights on the news that's shaping broad market action. For that, I want to welcome in Dale Smothers, President and CEO, RDS Wealth Management. Dale, it's good to see you. I was happy to see that you were in the lineup today. All right, let's talk about the current market environment. You say it is hard not to find much not to like about the current market environment, despite some global tensions. Give me your take on what's fueling this confidence, especially given the pullback that we had after the records last week.
Diane, good to see you as well. Always pleasure to be on the show. You nailed it at the beginning of the show. This tug of war between the bears and the bulls. It is slightly optimistic when you think about all of the negatives that you could be focusing on right now. It seems as if things are pretty much, if I were a town crier, I would be saying all is well. You've got record highs in the market, as you mentioned. The bond market doesn't seem to initiate any kind of run to safety for investors. It's staying exactly where it would be, even in a good time. Imagine that we weren't having record deficits potentially forecasted in the U.S. economy, or global war. This is the type of thing that would typically see bond markets start to be where people are running to, and it doesn't appear to be the case, which is a powerful thing. You also have a Fed that is potentially going to be cutting rates this year. We forecast 2 of those, which will be a tailwind in the market. And theoretically, I believe that this is all due to the optimism of what could be in this American First or America First agenda that we see being passed by the Trump administration.
Given your view that you see 2 happening this year, how do you see that shaping, say, market action through the balance of this year?
Yeah, I believe that the S&P 500 finishes somewhere around a 6,500 point range is kind of what our forecast would be. We have been bullish even in the lows of April, simply because of the pent-up demand and optimism. Nearly $7 trillion still sitting on the sidelines that hasn't got involved in this, and those who are involved, the money that is working right now in the market is not flooding to safety or leaving the market, going back to cash. That $7 trillion, when it gets added to the market, we do see that being, again, a tailwind in the overall S&P 500 performance. I could see 3% in the next 3 months, maybe 6% additional increase in the S&P 500 over the next 6 months, and again, being very bullish going to the end of the year.
Okay, so I'm curious. I want to know your thoughts on any broadening beyond the Mag 7. To be fair, there's been some bifurcation in the performance within the Mag 7, and we'll dive deeper into a few of the names that are on your list there. But you say, you've pointed out this adage that I've heard before: as tech goes, so goes the market. What are you paying attention to in terms of any broadening beyond tech?
One of the things that we haven't mentioned just yet that is very optimistic about the market is the broadening of the S&P 500.
Oh, here we go, 265.
Technology now. It used, like you said, used to be the Mag 7 that took everything higher and led us into the lows of April. But since then, we have seen a significant rally, one that rivals historic rallies of the past, back in the 80s and coming out of 2000's crash, and even out of 2020. We've seen these 3-month 25% move from the lows to where we are today in the last 3 months is significant, and it's not all been tech. We've got industrials, we've got financials that are helping lead us out of this. And to be real frank with you, that broadening in the market gives me a lot of optimism for investors in general. You know, we aren't really chasing returns in the tech industry, at least with our clients. We like a little bit of tech here and there, and we've got a few tech names on our list. But the reality is this broadening of the market is a very good thing for every buyer. What I would love to see, Diane, is consumer discretionary potentially climbing a little bit higher. And if we can see that, I think it solidifies this rally that we have experienced thus far in the year.
Dale, let's talk a little bit about some of the names on your list. Two of those, Amazon and Apple, they've been underperformers compared to the Mag 7. Amazon essentially, flat for the year, just slightly above water. Prime Day's here. That's not necessarily the needle mover when it comes to Amazon. Obviously, you have AWS, etc. Do you think the market is underestimating Amazon, as a performer this year?
In short, yes. The answer is yes. I do think that we've underestimated Amazon because it is not just a high-flying tech company. It's a diversified tech company. When you think about the cloud system that it is putting a ton of money in, last year, you mentioned AWS, last year nearly $107 billion worth of revenue with a significant margin in comparison to its retail side. And we've got advertising that is growing in the Amazon business model. This is a bullish sentiment for us. Amazon is a big buy here. The Mag 7, like you said, there has been that separation of the have and the have-nots of the Mag 7. This is one that stayed pretty flat through it all. I believe that over the next 6 months, Amazon is a buy for the reasons we just listed.
And then let's talk a little bit about Apple. Apple's also been an underperformer more so than Amazon. It's not the weakest in the list, but it's close to the bottom of the list. So what signals are you watching for a change in how it's viewed in terms of its performance with regard to a turnaround for Apple, especially when you still have these tariff concerns?
Very good point, baby.
Well, and namely, that is the biggest concern for us, and that's Apple's impact with Chinese trade war. The tensions that come from the China trade war alone, in our opinion, has been what's held Apple back from the Mag 7. Now, we're not a big proponent of Tesla, but just about anything else, you could throw a dart at the Mag 7, and I think you're going to make money over the next 6 months. Apple is likely the one that has the most upside potential, because when we see China's trade war, when all of that clears out, and the last time we were together, Diane, we were talking about this trade war and how when China clears, things start to look a little bit better. Apple will be the primary benefactor for that, specifically when we're looking at the Mag 7. Apple is a buy for us, and it's simply because of the momentum that will come from an Apple clarity around China.
Okay, and let's talk a little bit about a pick on your list that's outside of the Mag 7, outside of tech. That's J&J, Johnson & Johnson. I believe it's outperformed the S&P 500 so far this year. Do you see a continuation of that trend, and why do you like it?
I do. If you look at the 5-year chart of J&J, you've got this kind of restraint and support bounce back and forth that has weathered many different cycles in the market. J&J has a tremendous amount of subsidiaries, 275 subsidiaries, if I'm not mistaken, that are performing on 26 different platforms, over $1 billion worth of revenue last year. It is incredible when you look at the financials of J&J. It's got one of the largest R&D budgets for pharmaceuticals, and all in all, it pays a significant dividend. So for clients that we're working with that need that stability, maybe need a little bit of dependency, this would be one of those names that continues to pay a strong dividend. We're going to see some capital appreciation over time. It's a household name, and again, long term, I think this is a buy and hold type of strategy. Not a trade here, but a buy and hold strategy to harvest the dividend and benefit from, again, this America First agenda that is to come.
Okay, a bet on the America First agenda there with a Johnson & Johnson, longer-term view there. Dale, thank you so much.
Always a pleasure.
Dale, same. The feeling's mutual. That's Dale Smothers, President and CEO, RDS Wealth Management. Got a lot more to come on Trading 360. Next up is the big 33 stocks, 3 charts, 3 trades. Rick Ducat goes through the technicals, and Jessica Inskip takes us through the trades on her list: Coinbase, Fiserv, and Nvidia. That's next on Trade 360 here on Schwab Network.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall. Time now for the big 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts. Here to take us through the tickers on her list is Jessica Inskip, Director of Investor Research, StockBrokers.com. It is great to see you, both of you. Jessica, before we dive into the names on your list today, I'm curious to know your thoughts, big picture thought on the market action, especially given we saw some cooling after those records that we saw at the end of last week, but we certainly didn't fall off a cliff. What's your take?
Absolutely. The most dangerous position for the market to be in is in a euphoric state. And when we're at all-time highs, we tend to be in that euphoric state. So any negative news absolutely has the potential of pushing us downwards. That's a concern for me. But we've got a lot of tailwinds with what I'm calling not the AI rally anymore, but the efficiency boom. That is certainly a tailwind as we see lots of spending within the hyperscalers, this race to artificial general intelligence, and this fiscal policy that really supports digitization, tokenization, and stablecoins. That's a whole nother layer to this efficiency boom. But my big headwind actually would come around July 30th. That is a Fed day, but that's also when we get our quarterly refinancing of our budget. Yellen issued a lot on the front end of the curve. That's coming due. I want to see how much Treasury we have issuing, and if it's more than anticipated, I think that's the risk that could send the market down. But there's a lot of data we have in between now and that date. So paying attention to that and how that really affects interest rates, the deficit, but I'm still bullish on that efficiency boom.
Jessica, way to read the tea leaves, because I've been trying to figure out what the theme is for the back half of this year, but I feel like you've characterized in a nutshell a lot of what's been occurring this year. As you mentioned, it's not just about the AI trade, the efficiency boom, even when we think about labor and what's happening in the labor market. All right, I'm not going to go too far off on a tangent because we've got some names on your list today. You've got Coinbase, ticker Coin. That's been an outperformer compared to the S&P 500. What's your view on this one now?
Yeah, absolutely. Thank you, Diane. And I really wanted to go with you on that tangent, so thanks for rolling me back. Coinbase, it's transforming. So it's into regulated, scalable backbone of crypto finance. There's stablecoin growth and access to derivative markets, and that's going to position it, in my view, for long-term growth, independent of any of that short-term trading hype that we have. Stablecoins is going to be important relative to my macro thesis because those are backed by U.S. Treasuries. That's definitely going to have some volatility created within the credit market, but either way, there's still demand for Treasuries. That's an important component that I see in fiscal policy is backing that. So they're lean, scalable growth and stablecoins for derivatives. And when I say derivatives, what I want to get across is this regulatory edge. So there was a recent regulatory breakthrough that allows Coinbase to offer CFTC compliant.
So far, we've had support
for Bitcoin and Ethereum, and overseas, the global they can tap into 90% of that market. So that's another tailwind for them from a revenue perspective, inclusive of what's happening with blockchain and stablecoins. So I really think they're in the forefront of that.
Okay, all right. So Rick, you're up now. Rick, our lead market technician. So Rick, tell us about what you noticed about this chart for Coinbase.
Well, breaking above the old highs here, but not really able to make the push upward yet that the bulls may be hoping for. So we can see here 349.75 back here. That was our old high point from all the way back in November. We can see that after a gradual decline here, kind of a cup and handle type of shape here, we had the bottom come in near 142.58. Now, price has made its way back up to those old highs. We had a brief down swing here, and then we have so far managed to recover, but not really taking out those highs near 382. For now, our shorter term trend line here in white is still in play. We did have an interesting situation where we had our gap up, a brief period of consolidation here in a symmetrical triangle type shape, then the big push as well that took us above the 300 level low point and then several high points here. So that was another big breakout area. So we can also see that even though we do still have a green upward sloping trend line going across the lows on the RSI, for now, the RSI has retreated from that overbought area, that threshold of 70. What the bulls would want to see would be for price to retake those old highs, push beyond them, and for RSI to re-enter that overbought area and make new highs in tandem. So be on the lookout if that starts to happen, if you have a bullish outlook in this name. When we look at our volume profile study, we can see that there was some heavy trading around this area near those old highs, right around 350 or so. This could be a supportive area to watch. Beyond that, volume picks up once again from 300 to 310. That's also the site of our green line that we mentioned earlier. If price were to keep moving to the upside here, well, we can see that our +2 standard deviation channel, our orange line here, 2 standard deviations up from our linear regression line, which is a line of best fit, that could be potential resistance, comes in right below 369. So that's about where price topped out today. So by one measure, this could be a consolidative or resistance point to keep an eye on, that level near about 369.
Okay, Jessica, if you have a final thought on Coinbase, hit me. If not, let's move on to your next trade, ticker FI for Pfizer. That has been an underperformer compared to the S&P 500 year to date. So I am curious to know where you go from here. You can tag team on them if you have a final thought on Coinbase. If not, let's move on to Pfizer.
Yeah, let's move on to Fiserv because it's important to understand the investment thesis around this. It's really about powering the future of bank-backed stablecoins. If we think about the concept of stablecoins, really that could have a lot of headwinds for traditional banking. But we need to understand that corporate America is very agile and resilient. We see that with tariffs spreading out. We see that across since the great financial crisis. I think of the most recent headwind, perhaps, that disrupted banking, which was when Venmo came about, but then that's when Zelle occurred, and that's how banks are going to implement within that type of world, and something's going to happen with stablecoins as well. But behind that is Fiserv. They have security and compliance at their core. They have built-in fraud, risk, and settlement controls, and that's very important for banks, mirroring their trusted role that they had in those real-time payment systems like Zelle. So they are positioning itself to be this bridge between traditional banking and digital assets, and it's giving banks the tools to compete in a tokenized world, really, with safety and scale. And that's going to be very, very important as we see these key partnerships roll out, as I'm looking for more evidence.
Events.
With
Okay, we're
these
back down here to
launching
support again.
rated stablecoins from banks, as we're talking about them in theory, to them actually coming through. And if they are, Fiserv is a solution that you need in order to bring those to life. So therefore, it's a longer term play, but I do believe there's a lot of earnings potential here as stablecoins are more adopted broadly.
Okay, I'm glad you said it's a longer term, because you mentioned the like Zelle that stuck out to me, but the question that came up in my mind, is it sticky enough? So then, Rick, tell me what you noticed about the chart for Fiserv.
Well, we held on to an important low fairly recently.
Sure did.
The green line here near about 156. That was an old floor, a general area where price found some footing before what was a nice rally. Took us up to those highs, 238.59. From there, though, we did fall back down to earth, as I said here, finding that supportive area near 156. Now making some progress to the upside here, trending upward, but stuck once again, 176, our red line here. Low points back there, another low point here, and an old high point. So you look for these areas where price repeatedly stops to give you some kind of potential idea about where to find support or resistance. So in this case, we so far have not managed to break above that area yet. We do have a supportive confluence right here. Our yellow 21-day exponential moving average and our short-term trend line up around 170 or so. We can also see that RSI is kind of in this triangular shape here. We have our longer term downward sloping trend line in red, our shorter term upward sloping trend line in green. RSI right about on that 50 midline right now. Now, when you look at this one too, trend lines, sometimes they're very clear, they match up very cleanly.
Yeah,
Sometimes
they do.
they're a little more messy. You could draw maybe two trend lines here. One going across the highs after we had our 52-week high. That would give you this white line to look out for. Some people might also think of it this way. This blue line here, that's kind of like the line of best fit where price would find support and resistance here. So by one measure, we have broken out from a downtrend. By another, we're still kind of stuck at this resistance level. When we look at volume, we can see that the point of control, the heaviest trading area, comes in around 162. So heavy volume at a big low, that often is interpreted as a sign that an important low point has been reached. Not saying it'll hold for sure or anything like that, just saying that's a notable area now. Volume picks up once again near 202, right around our linear regression line, our line of best fit.
Okay, all right. So thank you for that deep dive into the chart for Fiserv there. Jessica, let's talk about the final name on your list, NVIDIA. I'm looking at this one and I'm like, and what the thought occurred to me, what a different chart, which I know it sounds like I'm teeing up Rick for this, for NVIDIA when you look at it from April to now. But again, if you look at it overall for this year so far, it's been an outperformer compared to the S&P 500. So tell me about your thesis here now, Jessica, and then Rick will go over the chart.
Absolutely. I think a lot of times on Wall Street, at least, we equate NVIDIA to purely being this AI demand play, which it is not. There is software in addition to hardware. There are hyperscalers that are spending so much, and it's really this heart from AI to even crypto. They are this silicone behind the scenes when the world digitizes, if you will. So it's infrastructure backbone of the entire digitized world. So they're powering blockchain too. They're key enablers of the blockchain network indirectly because they support the scale of stablecoins through GPU-powered mining and network validation.
Come on.
So lifted the AI diffusion role, which increases sovereign demand, which could be another tailwind. So they're essentially everyone is spending on AI, and if everyone's searching for gold, NVIDIA is the shovel, if you will. NVIDIA is selling shovels, and you need that. And hyperscaler symbiosis, I think, is important to point out because we see even today, Meta announced this, someone from Apple coming over as the race to AGI, artificial general intelligence. Nobody knows what that is, but it's critical game theory, and technology is very iterative and agile, meaning we want artificial general intelligence. We don't know what that end state or that prize is, but everyone wants to be in the game. Therefore, they're willing to spend because whoever owns that owns the next leg of the AI rally. Whoever that is and whoever the spending is, it creates hyperscaler symbiosis within NVIDIA because AI infrastructure now is planned. It's executed at scale, and that's really good for a company like NVIDIA that can plan and offset other things that may occur due to tariffs. So I think NVIDIA has a lot of tailwinds for it. definitely in the longer term. In the shorter term, like I said at the top, when we're at a euphoric state and at all-time highs, I always have a pause. I wouldn't necessarily add them to my position here, but I am bullish on the long term, selling cash secured puts that are shorter term than those 45 days might behoove you in this, but any pullbacks are opportunities to add to your position.
Okay, so Rick, take us through what you noticed about this chart. Any shovels looking for gold?
Well, perhaps, yeah, but, pullback being a buying opportunity, that's pretty much what just happened recently here. So we broke above 153, the old double top highs you can see here at our red line. Price pushed to the upside. Then after the initial breakout, we retested that old resistance area, which now became support. Now it seems like the trend is continuing on to the upside. A common situation that happens in trading. Not saying it's going to happen every single time or anything like that, but, it's after a breakout, it's very common for people to, take profits or reduce positions or whatever, and we get that pullback to an old area of interest there before the trend continues here. So just something to consider here, but we can look at our blue trend line sloping upward across those lows that took us really straight into those 52-week highs, about a 84% gain or so. But the trend has moderated somewhat here. Now the price action is mostly between these two white dashed lines here, giving us a slightly more modestly sloping upward channel. RSI, tiny bit of bearish divergence here, but still re-entering that overbought area. Looking like it really could break out once again here if the bulls manage to push above that 161 level. So when we look at volume, we can see here that the heavy volume is a bit below where we are now. Mostly here between about 135 to 145. That's the next big volume node. +2 standard deviation channel comes in just below 162. That could be a potential resistance area to watch, but for support, our old highs 153, and then our 21-day EMA comes in around 150. Those could be some areas to watch.
I'm in the 6250s at 120, so I got to watch them.
That's our Rick Ducat, lead market technician, and Jessica Inskip of stockbrokers.com. Thank you both. Have a great rest of your day. Coming up next, we're going to spotlight how President Trump's tariffs are affecting global markets and see what kind of impact they may have on the inflation outlook. Trading 360, we'll be right back. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Trading 360. Tracy, I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight the global impact of tariffs. For that, I'm joined by Ben Emmons, Chief Investment Officer and founder, Fed Watch Advisors. Ben, it is so good to see you.
Good to see you,
let's talk a little bit about market impact. It seems like the market is like, meh, they've moved on past trade fear. So what do you make of that?
Yeah, it's interesting, right, that it actually doesn't take the tariffs so seriously anymore, even though Trump announced high tariffs.
On South Korea, on Japan,
Exactly.
on South Africa, more than a dozen countries.
And actually, the Nikkei and the Kospi overnight rallied, and within the index, I think the sectors are most sensitive to tariffs, say steel, were up like 4 or 5%. So what I'm guessing from that is that there's going to be this deal where Japan and Korea's already announced this, that they're going to make a deal with the US to invest in the US for lower tariffs, and that the companies in these steel indices in Nikkei are potentially benefiting from it. That's one way to think about it. So I think we're going to go to the next stage here, where the tariffs become an incentive for investing in the US.
Speaking of that, so to your point about, say, Japan, one of the things that I noticed in that letter that was posted, for instance, to Truth Social by the president was, by the way, unless some of your production is done here in the U.S. So I bought a car recently. It's a Japanese automaker in terms of the name, right? But I found out the model that I got is actually made here in the U.S. So I wonder if we'll see more of that because, you know, there's this push by the government for reshoring.
Yeah, and that's right, and I think that you could see initially that just expansion of production by those companies here in the US, but then having to hire US workers to do it.
Which affects, you know, margins because wages, they'd have to pay higher wages depending on which country we're talking about.
But the other part of it is more about, well, actually one of these Japanese automakers set up a completely new plant, which some of them have said they would do. Hyundai is one of them. It's actually a Korean automaker, but some of them have said they would do this. And that's the next stage here, because Trump is not about anymore about you can't renege on this. You made this commitment to me, and if you don't, then he will raise the tariffs on those countries. And that will be then, I guess, the risk-off moment if he actually does that. But he will do it to try and continue to incentivize countries and companies to stick with their commitment to actually invest in the US inside of his term, his presidential term, not when he leaves. For the markets, this is a big deal because, one, you can tell a little bit from the individual sectors in the S&P. Autos are up, steel is up, copper is up, electric is up. That's all up since he spoke about the USA Investment Act in late April. Secondly, it's about the economy. If we're going to actually invest in more, this negative GDP print that we had last quarter, inside of it was the investment component was already like rising quite a bit. That will really take a lead on GDP, getting GDP actually accelerate. And I feel that the treasury market is gauging that. It's not the deficit, but it's actually the economy that could take off. These companies actually start to make real plans to invest here, and the market start to anticipate it. So I think you should watch this because if you look at these particular indices in the S&P and treasury yields, they're quite close aligned. When I put them a note today, that could drive the economy. Like as in GDP goes high because of investment.
Are we out of the woods with regard to inflation risk? I mean, you know, the pace of inflation has been cooling, right? And it seems like the markets and economists are in agreement on, you know, like inflation risk seems to be, I don't know if moderating is the right word, but it's definitely not a heightened concern now. Do you think we're in the clear, especially when you think about tariffs?
So the tariff will definitely transmit for the next number of months, because as they are on, the universal ones, and if whatever reciprocal ones result from this pause that we're in now, because we still have a pause on it, we'll get some transmission, some pass-through from it. The Fed thinks it's about 10 basis points per month on PCE, and that seems to be relatively in line with what we've seen from April into May. So the June number that we get next week will show us a bit more pass-through. But then the energy prices have fluctuated, so we had drag from energy the last few months, and that's flipped now to potentially a bit adding energy inflation because of the shock from Iran that come a bit through. But that's about it. I think there's not much more of a shock. So the way the market's pricing it, thinks that headline somewhere to 2.7, that's fairly in line where the economists think it will be too. Still higher than it was before, but nothing like a major shock. So if the number comes out that way mid this month, the Fed has all the clear to start cutting rates in September.
Those sectors that you were talking about, I want to go back to that point, steel, auto equipment. oh gosh, it's escaping me, the other sector that you were just talking about.
Heavy electric.
Heavy electric. Okay, so do you
Yeah,
think
there
that
we go.
is
35.
sustainable? Like, is that going to be, are you viewing that as short-lived or
40.
really sustainable?
So it's one hand is the momentum play, like we've seen before with policy. When it gets announced, you get momentum plays through these sectors, through ETF-like vehicles that will try to mimic those sectors. But it will be sustainable in terms of that as the investment actually happens, the companies that are involved in it will benefit from it. They get money in the door, they make money off these investments. So I think it's not just a cost thing, it's like an economic impact. But we got to think about the ripple effect from there on housing, particularly, for example, right? Because if you get in certain areas with massive expansion of production, there's going to be more people moving in particular areas. We've seen this kind of thing play out before. So the housing market being a bit of a sluggish period.
It has been, but do you think this will be
Bingo.
positive for housing?
Potentially in certain areas could be. I'm thinking again Midwest, South, where some of that investment could take place. Most of it is now more on the coastlines where this is happening. So if it gets more to the middle of the country, yeah, you could see there's one major impact. The other one would be just employment itself. That we've had a bit of drag here, and there's certain sectors that the employment picture starts to firm, and payroll start to become not 100, 150K, but again above 200K. That the picture changes, right? It's in terms of like people's perception about the economy changes.
Very good.
The conference is still so depressed that the whole picture flips from the negative on tariffs to positive on tariffs because of investment.
And then what are you paying attention to within the bond market? Are there any signals that should be concerning us there?
So we had a lot of talk about the deficit as the beautiful bill was passed. That's a long-term story. Will the deficit at some point become problematic? Yes, when we can't pay for it anymore, or we have to somehow extend the maturity of our debt to somehow control the debt. That's the biggest risk to the bond market, I think. It's not so much the deficit in itself, it's more how do we finance it. At the end of July, the Treasury meets again and announces a new refunding program. So there will be a lot of T-bill issuance, and the markets may look at this saying, okay, you can't keep issuing T-bills to finance a large deficit, and you kind of change that at some point. So that's, I think, a risk to the market.
Are we paying it off for 100 years, basically?
But if you look at long-term rates, we're in kind of like a wedge upward trend. It's like kind of going like this. So at some point it could go higher, I think really because of this story, this investment story. It sounds maybe overly optimistic, but it is a story about productivity, about investment. Yeah, that drives rates higher. And so you could get a strange situation where the Fed can cut rates because inflation is controlled, but long-term interest rates rise because of stronger GDP driven by investment.
Okay, quite the balancing act there. Ben, thank you. It's great to see you in person. That's Ben Emmons joining us here on set at the New York Stock Exchange, Chief Investment Officer and founder of FedWatch Advisors. Coming up next, the disruptors. We'll take a look at CoreWeave. Made headlines yesterday with that big acquisition of Core Scientific. Analysts not loving the deal, though. We'll dive into the details next on Trade 360.
Let's do it.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Tesla at the 63, squeezing. Gonna do something. AMD's at the 200 on the 1 minute with a double bottom. And resistance on Meta. We had a bounce. Jimmy's mentioned that a couple times today. Meta. And Apple's at a pivot point off the 200. And Nvidia's got a break to 200. So not much. And I got out of the 6250s, so market's been open a couple hours.
Diane. Hello again. So looking at the stock, Mizuho did downgrade, but they downgrade from outperform to neutral. So think of it like buy to hold, essentially. But their price target is more than doubled. So that's where you can see how this is
Interesting.
Somewhat of a mixed message. Their old price target was $70. It's now up to $150. So we were talking about this actually with Uber earlier on, where when a stock runs up a lot, you either have to adjust your price target when it catches up, or you got to adjust your rating. Well, in the case of CoreWeave, it ran so fast that they had to do both. So they adjusted up their
now
rating,
at 155.
up down their rating to a hold, but their price target is substantially adjusted. Now, the reasoning behind it is they think that this acquisition of Core Scientific does bring additional financing flexibility and also expanded internal expertise to build upon an already powerful partnership. But they do acknowledge that this is an extremely volatile stock. And as
Wow,
a result,
170.
both directions.
5.
And as a result, they see it as relatively fairly valued at
That
these
hurts.
prices. Similar sentiment from Stifel, maybe a little bit less optimistic in terms of their price target, which is at 115, but it's raised from 75. They also downgrade to a hold or neutral equivalent rating from buy. And they do like the long-term benefits of this Core Scientific acquisition, but they do see key near-term overhangs for the company.
Now
to get
170.
through. Notably, that as it repositions as more of a vertical data center provider, that might require us to change how we look at this from a valuation standpoint.
So then, okay, I think there are some great points
Triple
there
bottom.
in these analyst notes, and I agree with your view, Alex, that it does send some mixed messages, but maybe they did have to catch up when you think about, for instance, Mizuho's price target. I'm curious to know what your approach is for an example trade, especially not just in the context of these moves by the analysts, but how powerful the move in CoreWeave has been this year. It's a young company.
Yeah, and I think this is probably a company that many investors believe in, particularly given its performance, the sector that it's in, partnerships with companies like NVIDIA, etc., that make this a position I think, investors maybe want to be more bullish than bearish. So with that in mind, I looked at something that kind of threads the needle here. It's neutral to bullish. Kind of the way I look at these analyst notes. They adjust their price targets significantly higher, but they downgrade the stock to neutral, feeling it's closer to fairly valued. And as a result, if you're looking for a way to trade something that's closer to fair value, but you still want to participate, selling a put vertical below the market can allow you to do that. You do take risks to the downside, but if it holds on to its gains for the year, or holds on to these levels, or even turns higher again, this is a strategy that could really work out over time. So what we're looking at is going out to the July 25th expiration. Reason being is this stays earnings for this stock, and it's short-term enough that it allows some of this volatility to be taken advantage of, given the fact that the stock moves around quite a bit and can move quickly, as you see today, down $4, and it's actually off its lows here intraday. Looking to collect $1.65, that's about a third the width of the strike, so it creates a 2-to-1 risk reward. The trader would be risking $335 with a chance to make $165. And the break even would be $133.35 for this strategy. So right now, Diane, the stock's at $155. You got $20 in cushion over the next couple weeks, and you could still be at max profit on this strategy. So that's why these type of trades, I think, are alluring to some investors.
All right, neutral to bullish example trade there for CoreWeave. Shares under a little bit of pressure today, down about 2.5%. Thank you, Alex. That's our Alex Coffey, co-host of Next Gen. Coming up next, time for our 360 round. We'll discuss the outlook for EVs after the passage of that massive tax and spending bill. How it will affect EV buyers. Trading 360. We'll be right back.
It's on the 5-minute.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle.
SPY moving up. Nice little breakdown from the bottom here. Now we're back at resistance levels. So I'm not in no hurry. Though if we stay here and break out, it'll create strength a little bit until we get up to the orb. Well, I wish I knew where Funky was. We are waiting patiently.
Credit is people are not used to these EVs or electric cars because they're scared about range or maybe they're not comfortable yet about not having to get
range.
So I think the reality is a lot of people are not very compelled to buy these electric cars, and having that $7,500 credit that we had before was a very, very good reason, and now that it's gone, so I think the whole market will probably struggle as a result.
So Chris, I'm curious to know, what do you think would be the turning point where you would see more appetite for EVs? Because I will give it this, it was a nice drive. I had driven one before, it was a nice drive. But yes, Hatem makes a great point about range, because when I drove one before, there were times I was nervous because it's like, you know, running low on electricity, and I'm like, oh, okay, I need to, you know, get some power somewhere. What do you think is the, you know, is it a build out of infrastructure where we see demand pick up?
Yeah, I think this is exactly the thing. It's really interesting you say about range, because we were discussing with one of our team one-off
for a holiday and used an electric car to see what it was like, and you were impressed with it as a car, but it was the fact that you were constantly, as you were, looking at the range and going, how much have I got? What happens if I run out? You're just not. Consumers just aren't comfortable with it. You need that infrastructure to know that, okay, if something does happen, I don't know, if the range just drops and you lose that charge, then there's something around the corner that you can use fairly easily, and that also isn't going to tie you down for a distinct length of time. You can fill up a car very, very quickly with gas and petrol, as we say in the UK, but with electric charging, there's still that uncertainty around it. Sure, you can sit for a while at a service station, but not everyone wants that. Everyone's in a rush sometimes, and it's just, we haven't reached that tipping point yet. We're on our way, clearly. I think EVs have done so much better than anyone thought that they'd be just a few years ago. But the infrastructure just isn't there yet.
Okay, Chris makes a great point, Hatem, especially when he said we're on our way, because it became, for me, the second choice on my list, in terms of how I was ranking my vehicle choices. When you think about EVs in general, Rivian's had some steady delivery numbers, right? But they're not at scale yet. Do you think for Rivian it's about building momentum, or are they just bogged down by their own unique issues?
What I think before we talked about Rivian, I think to add to Chris's point, it really depends where you are. Like I live in California, it only takes you 10 minutes to charge your Model Y because the supercharger network from Tesla is so good. And even if you have a Rivian, which I do, you can actually use the same network. So the infrastructure has been built here. In China, you can charge your EV in 5 or 10 minutes, right? So I think depending on where you are, you're gonna have different experience about adoption and how easy it is to really adopt this new car. I think going back to Rivian is just an execution. I mean, they barely met 10,000 cars. They just cannot scale. They're having issues sorting the right parts, really kind of changing their manufacturing process to be able to deal with tariffs and things like that. And I think they have some work to do to really scale up.
Okay, we'll have to leave our conversation there. I think you make a great point about depending on where you are, because I notice in California there are Teslas everywhere. We'll leave our conversation there. That's Hatem Diab with Gerber Kowalski Wealth and Investment Management, and Chris Beecham with IG Group. Thank you both. Thank you so much for joining us today on Trading 360. I'm Diane King Hall. Download the free Schwab Network app. It's available
220 for the 6250s.
SchwabNetwork.com. Stay with us. You've got Fast Market with Tom White and Kevin Higgs up next.
We got a 1, 2, 3 coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors.
Very interesting.
With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network. Welcome to Fast Market here on the Schwab Network. It's time for us to get going here. Stocks are relatively flat in today's session with losses from Monday, not kind of carrying over, but we've got some weakness. We're going to talk those markets, and then we're going to have some option strategies. We're going to cover Amazon as Prime Day launches today. It's 4 days instead of 2. The stock is still off about 9% from those all-time highs. And then we're going to cover Uber, which hit all-time highs earlier in the session but has pulled back. And then Folio is going to have consumer sentiment data in Airbnb, which is struggling, down about 16% from those 52-week highs that we saw. Let's get a look at the equity markets as we kick off the show here. The S&P 500 up fractionally. The Dow Jones Industrial Average off over 60 points, or just over 0.1%. The NASDAQ 100 up over 0.1%, and the Russell 2000 leading to the upside, up 0.9% on the back of a lead in energy and financials within the small caps. To help me break all this down, let's bring in my co-host. That's Kevin Hinks. Kevin, give me your take here. A little bit of consolidation in markets, just below those all-time highs. But is there any catalyst right now? Because maybe some consolidation's warranted at this point.
Tom, it's hard to make more out of this market in the first going into the second week in July than it really is. And that is, it's a slow summer market that is waiting for headlines. We had some headlines yesterday. They moved the market. A little less headlines coming out today. The market's drifting a tad bit. There is some headlines making news. They're just not major moves. They're not creating major moves in the market. I mean, I thought that Japan, after the tariffs hit 25% on Japan, they came out and said rigorous negotiations are still going on. Everyone's leaning up towards that August 1st deadline. That's when things get more serious. Tariffs hitting, that kind of worked on the market. Yesterday, Tom, this is a dry powder day. You're waiting for Trump just started a cabinet meeting. I don't know if headlines will come out of that or not, but Tom, it's I've seen enough of these to know that don't try to make more out of a day than it is. And this is not a day. This is a day
don't try to make more out of a day than it is.
Ready for next week and earnings, and I think that's what you see analysts doing with some of the downgrades to the banks this morning. But all things considered, we're in that chasm, Tom, of when first quarter earnings ended and when second quarter earnings begin. Not a lot of data, not a lot of earnings, waiting on some headlines, and pretty boring trade here, Tom.
Pretty much a summer trading to a T here, but we have had that big rally off of those April lows, the best since, I believe, 1950. Still about 0.8% off the highs that we saw last week for the S&P 500. But let's expand this conversation. Bring in Alex Coffey, senior equity contributor here on the network. Alex, it seems like this market's a little bit Teflon with the tariff headlines. We were weaker yesterday on the back of that announcement with Japan 25%, South Korea 25%. Then after the close, came out with a bunch of other countries, Malaysia, Kazakhstan, South Africa. So he put a hardline date on it.
A little pullback.
We're not moving from that. The negotiations still continue. But even if nothing gets resolved, it feels like this market is just kind of bypassing and looking past what's going on as far as tariff possible headwinds.
Yep.
Yeah, and do you think that makes sense? Because I could argue that it does. I mean, I think we're taking at face value that the tariffs are like guaranteed.
I'd have caught that. I might
cause,
would have
this
took that one
tremendous
too.
Inflation, recession. Like,
Boeing.
That's not necessarily going to be the case for one. But two, I also think the market doesn't actually think that August 1st is a deadline. Like it may end up being that, and perhaps if less negotiation frameworks are set up with some of these key trading partners, we'll see more of a reaction closer to that date. But what has the market seen so far this year? Well, it's seen one major surprise around Liberation Day, a 90-day kickback on those reciprocal tariffs that really surprised the market, and now basically another month pushback from that date. So I think the market's looking at this as this is an ongoing public negotiation, a very complex one, where basically U.S. is negotiating bilateral trade agreements with the entire world in real time. It was caught off guard in March and April, but I look at it as like the peak of that uncertainty. Like, what would it take now to overcome that in terms of surprise? Like, it would have to be significantly more than was just announced, because this is something that we just already learned on Liberation, which was a surprise. It was a surprise the first time, but I just don't see how it can negatively surprise to the extent that it already has. There may be a pullback. It may be because of tariffs. It may not be because of tariffs, but I don't see the same kind of volatility around trade as we had this year. The worst of that seems to be in the rearview mirror. Now, it could be a longer, prolonged sell-off, but what do we move? 10-15%. It seemed like in a week. Like I don't see like what we can learn from the administration regarding trade that could bring that kind of volatility again.
Yep. If you look at the SPX's rally 29% from those April lows that we saw. But Kevin, when you look at this, what are the areas? And Alex mentioned the lack of volatility. The VIX is back below the 17 level. Is yields. We've got the 10-year yield above 4.41%, highest level since June 20th for yields, 5 straight day of gains for yields. Is that one of the caveats here? Because that's what I'm kind of focused on now, is the bond market and yields. That any volatility there might kind of leak over into the equity market. And we've got a 3-year note auction today and a 10-year tomorrow.
Yeah, I think the bond market
change.
And what you're watching for is does something take it
3
out
black
of there.
crows
Remember, it was
off the orb.
for 10, 11, 12 days ago and got down to below 4.2, and now it's shifted back up. So it's had a little bit of movement, but still stayed in a pretty close range. So when I look at the 10-year yield, 4.41, it's not scaring me, but it's something worth watching, right? Because everyone's starting to get comfortable with there's going to be no July cut in interest rates. But the people are thinking now, and I heard it on financial news this morning from an ex-Fed member.
62.50s.
Guiding towards a September cut. Unless we get some data that changes the narrative. I think it started a couple weeks ago.
At 130.
With Christopher Waller, and then Fed members are all starting to talk about it. Like I said, not going to happen in July, but I think the big turn towards lower interest rates the second half of the year, probably starting in September. Remember, no August meeting. I think that is going to keep the market under wraps for a little while. So that rhetoric, I think, should be important going forward. But then, Tom, earnings start out with what? Airlines and banks, right? We're going to get Delta on Thursday. Next Tuesday, Wednesday, we're going to get a bunch of banks. We're also going to get United Airlines. So remember, here's the question for everyone. Is the bar going to be high on banks? Or do these downgrades and these sell-offs, will that lower the bar slightly for the banks? You know they're going to put up good numbers, right? The banks are going to do extremely well. But how does that correlate to the valuations of some of these banks? That's what the notes that HSB put out today said. They've all run too far for everything that's going on. A lot of the good news is already in. So I think the banks are going to be a real interesting start off.
62.50s at 130.
Yeah, bar high.
We're now at 160.
But if the economy's improving, you've got that yield curve normalizing a little bit, that's going to be a benefit for them. But Alex, we mentioned the volatility index. The VIX is back below the 17 level. It's kind of reflective of, and this kind of gets me scared a little bit because I've been in this business so long, is when
you sure
everybody's
have.
so
No
optimistic,
timer.
markets spiking higher, all-time highs. We're just below them now. Is that nothing can defeat this market, but then, when you least expect it, maybe VIX should be down here because there is no fear, but at the same time, there should be a little bit of fear, shouldn't there?
So I'm going to push back
Yes.
on this narrative just a little
Only
bit.
because we're
The reason
overbought.
being is agreed, right? There's so many things of uncertainty, whether it's geopolitical risk, whether it's just simply valuations and the fact that earnings revisions have gone down throughout this rally, whether it's fiscal policy, whether it was the tax and spending bill, whether it was trade policy, whatever it may be. Maybe it's the Fed, whatever you want to pick. There's a lot of things that are causing concern for many regarding this market. Yet you look at volatility.
165.
17 for spot VIX. You look at July futures, they're at 18 even. But if you look at the VIX futures curve, which I have here up on the screen, tells a different story, Tom. So this is where I'm going to push back. I do believe there is a complacency for right now, maybe the next week, maybe the next 2 weeks, where this market does feel a little bit Teflon, like nothing can get in its way. But as you start adding time as a component to this marketplace, swiftly more and more risk is being priced in. The difference between the July future, which is
coffee
18 right now, and let's even call it just the end of the year, which is December, which is at 21, is like a 15 plus, almost 20% difference. That's significant. And if you're buying hedges, this gets very expensive over time as you're buying volatility now, which feels cheap. But if you continue to have to do this, you're buying more and more expensive volatility as it goes out into the future. So
you get out and take profit here.
Complacent right now. But these prices and these risks are being reflected as you increase the.
So we called the bottom of this orb right here off the 3 black crows at 130, and now you're at 165, 160, 155. Bingo. Alex is a whiner today.
The lack of volatility that Alex mentioned, but then you mentioned the banks. And you know what? These downgrades by HSBC, JP Morgan to reduce, Goldman Sachs to reduce, Bank of America, to hold. I mean, these are pretty strong when you'd expect the financials to kind of set the tone here for the equity market at the kickoff of earnings season next Tuesday.
I think some of the comments were interesting from HSBC. Here's what they said. They're more cautious on universal banks and brokers following a recent rally in the shares, recommends a more constructive stance on the super regional.
160.
And they all say in the note, you're right. Bank of America, they took from a buy to a hold. JP Morgan from a hold to reduce. Goldman from a hold to reduce. That's a little different, right? They basically say don't add to Bank of America, but the other two, they're talking about getting out of some position. So a little bit different there. But they also say, remember, if you look at the number, last 3 months, Tom, Bank of America, 38% higher. JP Morgan, 36% higher. Goldman, 49% higher in the last 3 months. That tells you a lot of what you need to know. The bar is going to be incredibly high, even with the numbers they're taking $11 out of J.P. Morgan just today. So I still think the bar is going to be high, and it's going to add a little volatility to next week for sure.
Yeah, and remember, HSBC had holds on Goldman and JP Morgan when they were hitting all-time highs, so maybe they were behind the curve already. But Alex, I mentioned those yields rising. We got the 3-year note auction here today. Does that cause you any consternation here? Because it's still in a range, yields, but there could be some effect there in the bond market that could spur volatility in the equity market, right?
Well, we had this conversation, I think it was just yesterday, about, what is out of line right now when you look at sort of a yield curve analysis. The curve looks pretty healthy.
Right.
The piece that doesn't necessarily fit is the Fed funds. However, if you're the Federal Reserve, maybe what you would like to see is the market start to slowly inch yields higher as you're starting to bring down the Fed funds rate and meet in the middle somewhere, because the 2-year yield at 385 is significantly lower than where the Fed funds rate currently sits. But if it's going to meet somewhere, maybe the Fed would like it to meet in the 4.5 range, the 425 range, because at 3.8, from where we're at, if that's to happen relatively quickly, that would probably be more indicative of an economic slowdown. The soft landing scenario maybe is more of the same. I agree with you that yields continue to be range bound. I think yields going higher is actually healthy. I think it's a reflection of a more confident market, especially given that we don't have serious inflation concerns driving this.
Right.
So hey, some yield curve steepening is a good thing, and probably your best case scenario for long-term gains in the equity market. Short-term, anything can rattle a market that's all-time highs. So yeah, if you're a disappointing auction or you see a spike in yield, sure, it could be seen as negative. But longer term, 6, 12, 18 months, higher yields, usually more indicative of better economic times than lower yields.
Yeah, those banks are going to like that normalized yield curve, I think, for earnings also. All right, let's take a quick break here, guys. When we come back, we're going to discuss Amazon. The Prime Days starts 4 days of sales on their site. Adobe Analytics had some positive commentary on that. Stick around. We're talking Amazon when we come back.
Nice little bounce back off the orb, so we're coming back up 130 to 185. On the 2-minute.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics,
no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking Amazon Prime Days kicks off today. 4 days instead of 2. Kevin, when you look at the stock, it's pulled back from those all-time highs. It made a nice run from those April lows, but still negative from those levels above $242 at the beginning of February. You know, this is
come on, Kevin Hickey.
Revenue for this Amazon Prime Days, according to the Wall Street Journal, to about nearly $13 billion. That's up 53% from year-ago levels. But they added 2 days, so it should be higher, right, Kevin?
Well, exactly right. I mean, soon it'll just be, you know, this is the business model, right? If you find something that works, what do? You give them more of it. And Prime Days, you know, add to their overall revenue stream. Last quarter, $155.7 billion, up 10% year over year. You think the consumer's backing off? AWS, you know, this company seems to be, in my opinion, with their finger on the pulse of everything that is important in this country. They're into e-commerce. They're into streaming, right, with Prime. They're into cloud with AWS. They are on the pulse of so many things. Yet,
195.
like you said, the stock still lags $20 off its recent highs from earlier in the year. So I think that, you know, this stock is in a pretty incredible place. Now, the problems, CapEx spend, right? Their free cash flow came down pretty significantly because they're spending money on regional fulfillment. I guess they're spending a lot of money. Robotics is really playing a key role here. But all this will pay dividends in the future, Tom. So I think this stock is poised awfully well here. Like I said, still $20 off its highs. So this 4-day event, as opposed to 2, should just make the numbers bigger.
230.
Yep, you CapEx spend on AI also, but then they've got the
Bingo.
revenue generation from advertising also. That was above $55 billion last year. That's a growth rate of about 20%, and that's the high margin portion, one of the high margin portions of their business. But Alex, when you look at this, it's all going to be about sales. We'll probably get some early indications on this. Adobe Analytics said that spending is supposed to increase to $23.8 billion from July 8th to 11th. That's all retailers.
Bingo.
Target's doing it right now with Circle We. You've got
Anybody take that one with Bobo?
Costco's even doing it. Walmart's doing it. So everybody's on board. But I mean, think about it. The wealth effect with what's going on in the stock market right now, near record highs. Job market's still robust, 4.1% unemployment rate. It sounds like it's lining up for a pretty good, 4 days.
Yeah, it's definitely possible, right? I mean, we have talked a lot about throughout the last few years about this idea of a K-shaped recovery, and those on the lower income portion of the bell curve have certainly felt the pressures of increased prices, more than those who aren't. And things like deals from Prime Days or Circle Week or whatever it may be present opportunities for those who are on a tighter budget to accumulate items. I will say though, we're getting to the point where it seems like these events are happening monthly to some extent. Now I know not maybe to this extent, but the more frequently you have sales, the more likely you are to train behavior for consumers to wait for them. So it's always a kind of a threading of the needle with that. That said, I expect it to really have nice numbers, as Adobe said, and expect to see a buoy of maybe revenue generation as a result of this. But all the while, this is allegedly happening as these companies are going to have margin squeeze as a result of tariff and trade impact. And so when you're already having tighter margins, is now the time to be discounting significantly. So time will tell what the ultimate impact is, But
darn,
certainly,
$3.
perhaps, as long as there's some good deals out there. I mean, I was doing some, browsing myself. I don't know if I need anything, and you just feel like, why am I on these websites? But for those out there who do and are looking to take advantage of them, hopefully they're able to.
Yep. Roth Capital raised the price target to 250 from 215 earlier today, saying that price cuts are going to kind of be offset by scale and volumes. But the stock's pulled back over 1% here today, now down 8.9% from those all-time highs. How do you want to look at this from an example trade?
Yeah, this is always going to be a situation where, it's a very difficult stock to be, net bearish in over time. It just hasn't been a winning strategy. There's always times where you can consider it, and if you're tactical with it, you can, of course, as Kevin says, make money on, being bearish, bullish, neutral, depending on where the stock is. But it isn't at its highs. It's got this big event. It's down a little bit today.
340.
It's in a neutral to bullish strategy going out to August
370.
So
God.
basically trading around this event.
Okay, that's it.
Before earnings, but not going all the way to earnings. So August 1st,
Damn
215,
it.
210, looking for $1.70. Basically a 2-to-1 risk reward in which you risk 330, chance to make 170, 213.30 be your break even. Now the strike, sometimes I just select it based off of pricing, which this certainly would have impacted that, and getting that kind of 2-to-1, 1/3 the width of the strikes. But it's also the one month.
Unbelievable.
Just over 215.
That's what we are.
A level where if it does continue to slide.
Today's special guest, Matt King Cole. Unbelievable. That's what I am. $4.20. Can you? That's $3,000. Fudge. 450? 470? Are you kidding me? Randy, call 911. Yabba dabba doo. I was in it. Good call, Jim, off the 3 Black Crows. Good call, Jim, off the 3 Black Crows. This is God.
Down to 213.30 to the downside. So you've got a pretty good cushion on this one to the downside, and you're still risk defined, right?
Nope. Not me.
This is a high probability short put
If I was,
that is collecting theta, and what Alex
they would be
did,
the
he
6225s.
took the general theme, the fundamental concept of a short put vertical. What did he do? Move those strikes closer to at the money, right? That gives you only a 60% probability of finishing out of the money, but it gives you a bigger credit. There's that trade-off that we talk about all the time. You take the fundamental trading strategy and you
I think that trade right there would have really done it in for me today.
So yes, he's selling a put vertical, but he gave it a little bigger delta. This one's got a delta of slightly over 8, and so the trade-off, bigger premium but slightly more risk. But if you're bullish on this name and you think you could sit here or go higher, this is a strategy that works, obviously.
Yeah, and Alex, you mentioned that even if earnings does occur during this event, I mean, the idea is it stays above the 215 strike or strike that you're short in this position. But this could be one of those things. Say the stock goes up to 225, time decay is in your favor, maybe implied volatility levels come down a little bit, that'll contract it. You could potentially get out of this prior if they do announce that that earnings event is during the
good little run.
cycle.
Yeah, no, exactly right. And this is actually the interesting piece with any of these risk-defined vertical spreads, which is, let's say this goes to, I'm just going to use an example. Let's say it goes to being worth $1 for the spread. So you'd be up 70 in theory if you filled it at this price. But you now go from a trade that could make $170 and had $330 in risk to a trade at that point that can only make $100 but has $400 in risk. So as these trades start working, the risk reward parameters around the trade get worse and worse. So there's always a moment that's unique to the trader. It may be a reflection of how close to expiration you are, etc. It could be earnings related. But there's always a decision point, and it's, again, unique to each individual, in which the risk reward no longer makes sense. And so if it gets to a point, maybe it's because earnings are announced and you don't want a trade that goes into earnings. Maybe it's because the trade has worked. Maybe it's because it hasn't. You can think about taking it off, assuming the market's open and liquidities are provided.
All right, great discussion there. Thanks to Alex Coffey, Senior Equity Contributor here on the network, helping us break down markets and Amazon. But now we're going to get into a discussion when we come back from Like Folio. We're going to look at sentiment data. In Airbnb, the stay stock is up a modest 4% so far this year and down about 16% from its 52-week highs. We're talking Airbnb when we come back.
Airbnb.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our
there's a knife.
webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Definitely got support right here, 240.
Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. That's going to be Andy Swan, co-founder at Like Folio. Welcome back to the show, Andy.
Thank you.
All right, so Airbnb, it's starting to consolidate under this $140 a share level here. It seems like
235, the 50,
some of its
62.50s.
luster here, even though maybe some of the hotel chains are doing a little bit better. Is this declining according to maybe some of your data?
Yeah, I think declining or consolidating is really the right
The
word.
prison guy is on.
The stock is exactly what we see in the Like Folio data. The first thing that we look at with Airbnb is always, web visits. And when we look at Airbnb versus others in the space, Airbnb web visits are down 10% year over year, whereas, Hilton and Hyatt and some of the other hotel chains are holding steady or gaining, which really tells us
Might get right back out of it.
Airbnb is clearly losing share to traditional hotels and bundled travel services. It's just become one of those things where the luster has worn off in terms of Airbnb, and people are starting to really appreciate the value and services that hotels provide, especially in urban areas where there's plenty of hotel options.
You think so?
The other metric that we look at is Airbnb's app engagement, that's down 3% year over year, despite a rollout of some really interesting and high quality features. So engagement is slipping. Airbnb's pushed hard on AI, concierge services, etc., but that really doesn't seem to be taking hold, or it's at least only allowing them to kind of hold the line. And so I think the big takeaway for us is, Airbnb is great when you've got a rural vacation, or want a place for a very large group, or somewhere where there's not a lot of hotels. It's a phenomenal option then. But in terms of competing inside of cities or in areas, where it's just 2 or 4 of you in a hotel room will do. People are really moving back towards the hotel experience.
There's 2 big fat candles,
and that's showing up in the data. So we think, overall, Airbnb very fairly priced here. Don't really see a big edge either way.
Andy, I like having this discussion because there's so many interesting topics about Airbnb. Let's face it, Airbnb is kind of the Uber of vacations, right? They're asset light. It's really that their app or their website, their app that links, vacationers to rent to vacation homes. And that's probably going to work. But the competition, it seems like to me, the real competition is the hotels, who can compete on what? Price, right? I think it's the expenses that seem to weaken the interest from Airbnb users. They start to look at the expenses of cleaning and all the different things, and they just say, unless they have a group, it's really just not worth it. What can Airbnb? Here's our thing we do a lot, Andy. Andy, put on your Airbnb CEO hat for a moment and say, how can you make Airbnb more attractive financially? Because that's got to be what these hotels are doing. They're competing financially with them. Or what are they doing that they're beating Airbnb here?
Well, I think Airbnb's done some of those things really well. They've kind of gone to all-in pricing, so that when you do a search and you see it's $159, for one night, you don't get to check out and figure out that you also have to pay a $250 cleaning fee. I think that was critical to the user experience, and they've done a pretty good job on that. The other thing I would say is, if I'm Airbnb, I would really think about leaning into what I'm best at. It's very difficult to compete with hotels where the customer's going to be satisfied if they get, kind of the a experience that they expect, a cookie cutter experience. They can just kind of leave the room a mess, check out and pay their bill, and that's all they needed was a place to stay. It's going to be tough for Airbnb to compete with that. But when you're talking about unique homes and unique places for unique sizes of people, or groups of people, then Airbnb really
Here we go.
shines.
T35.
So leaning into what
T30.
you're great at is probably the best advice that I can give Airbnb. And quite frankly, I think they're already starting to do that. The other problem that we see that Airbnb has to face is, Yahoo Finance survey said 60% of Americans say that Airbnb's hurt their local property appeal, and over
I'm
half
very
of
happy
people
today.
support some sort of ban on Airbnb
At a
in their
T35.
neighborhood or in their general area. So there's a political risk to this too that I think Airbnb has to get through. So again, I think it's about not trying to be all places and all things to all people, but instead lean into what made Airbnb great to begin with and what makes it still a great option for a lot of people in a lot of situations, and really highlight that and maximize the profits on those experiences. I think that's the key, and I think Airbnb could do it. They're a phenomenal company with great execution. They just kind of got a little ahead of themselves, a little bit overexpanded, and users kind of fought back and said, nah, the hotel's good enough.
Yeah, and I think it goes back to what you mentioned earlier. People are willing just to stay in the hotels. It's an easier process. You don't have those additional fees, those hidden fees, cleaning up before you leave and all that. And you mentioned, the higher interest rates, this is all about scale with an asset-light model, Andy, right? Is the fact that, hey, the more units that you have for Airbnb, the better Airbnb does. Barcelona just cut 66,000 units in their city, and other cities across Europe are doing it. So is that maybe one of the fundamental bases? You said getting back to what they know, but at the same time, if they can't scale up their business any longer, maybe interest rates, where people can purchase a second property, Airbnb it out, that's also a headwind at this point. So there's a lot of headwinds out there for this company as far as growth goes. And I think, investors are, telling them that because the stock has pulled back significantly.
Yeah, I totally agree. And, that's one of the problems with asset light is that you don't control the assets. And, you're really relying on people that may have significantly more interest rate sensitivity than Hyatt or Hilton does. Hyatt and Hilton can sometimes deal with interest rates in a much more powerful, commercially viable way than individual Airbnb owners who may have gotten ahead of themselves, who may have, an adjustable rate mortgage that's about to roll over, and they can't make money on their property anymore unless they charge out of market levels. So when you're asset light, you're also dependent on a lot of people and a lot of organizations that may not be as sophisticated at managing assets, interest rates, and the financials as your hotel large chain type of competitors. And so asset light does come with a cost. It comes with a lot of benefits, but I think we're starting to see some of those costs here. And I think the stock market's done a very good job of pricing and signaling to the company where it needs to go next.
All right, great data as always, Andy. Appreciate it.
Thank you.
All right, that's Andy Swan, co-founder of Lightfolio, breaking down Airbnb, which has been breaking down a little bit as far as their data goes, Kevin, because I remember, a few quarters ago, most of their data was pretty positive on this. They've run into some roadblocks here. How do you want to look at this one from an example trade?
Well, Tom, yes. The answer to that is yes, but the stock is still down 10% in the last 12 months, 9.8%. So it has discounted some of those. The question is, can they turn this around? So, Tom, what I thought about is this. Looking at something bullish to neutral, right? Not a short put vertical, but a long call calendar where I go, the earnings event right now, it looks like August 6th. So I went ahead of that. I bought the August 1st and then sold just this week's July 11th 142 call calendar. So that's collecting theta. Implied volatility right now, the IV percentile is about a 31%, right around the bottom third. So I feel okay buying some Vega.
The 6250s were at 190.
Too far, stayed ahead of the earnings event, and I did the 142 call calendar. Here's why, Tom. The break evens, 136.80 and 148.10, a big range where this trade still is profitable or above break even, Tom. So
interesting.
More passive in
right
terms
back.
of delta, only a 22 delta
Boom.
is bullish.
Back to resistance.
But it don't get hurt if it just stays right here, Tom.
All right, yeah, let's break this one down. 3-week wide call calendar to the upside, just slightly on the 142 strike, buying that August 1st weekly 142 call, selling the same 142 call on the July 11th weekly options that expire in just 3 days, paying roughly about a $310 debit for that spread. That's your risk, $310 per spread. But as Kevin mentioned, this gives you a little bit of upside exposure from the current 137.5 price that the stock's trading at. And as Kevin mentioned, it's range bound. Yeah, you want it to go at or near the 142 strike, but as Kevin mentioned, those break evens near 137 on the downside potentially, and 147, 148 on the upside gives you that range. Now, as you get closer to expiration over the next 3 days, you can roll or adjust that short options. The idea there is buy that short option back as it decays in price closer to expiration over the next 3 days, and then sell the following week or 2 weeks, or just close the entire spread if it's up near that 142 level and the calendar expands in price. You do have some assignment risk on that short option over the next 3 days also into expiration, so keep that in mind. But you can see here from the risk profile, you got the range, you want it to go kind of grind higher up to 142. That was the high where it failed, remember, last month in early June, about the 142 level. So if you think it's going to get back to those levels, this trade may potentially be profitable on that. But a good look at it, some upside exposure in Airbnb if you think it's going to grind higher. All right, let's take another quick break. When we come back, we'll talk Uber, the rideshare stock. Hit all-time highs earlier in the session, pulled back from those levels, but is still up nearly 60% so far this year. Stick around.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Uber, let's get a quick market update. Stocks did rally. S&P was up 0.2% earlier. President Trump was making some comments about the tariffs. EU is going to probably get a letter in a couple of days. August 1st is firm as far as the date that those tariffs start. We got the S&P 500 up about 0.05%. The Dow Jones Industrial Average now off 111 points, or 0.25%. The Nasdaq 100 up nearly 0.2%. The Russell 2000 up about 1%. Got the heat map here, kind of reflective of what we're seeing in the market. A little bit of consolidation phase. We got some energy that's doing well today. Financials, despite those downgrades, are doing okay today, but a mixed bag for equities on the tariff headlines. All right, let's get into a discussion about Uber. As I mentioned, stock hit all-time highs today, up about 60% so far in 2025. Kevin, when you look at this one, it seems like the analyst community is really getting behind this since the beginning of the year, when some activist investors kind of got involved, said they're buying shares in Uber. There were some headwinds at the end of 2024 when it was staggering a little bit, just due to the fact that autonomous vehicles and the concerns around that, they're partnering with Waymo at this point, and they got their hands in everything. They're trying to make a super app, Kev.
That news event where they announced that they're partnering with Waymo alleviated or made a bunch of fears dissipate about their role or were they going to get one in autonomous driving. Remember, Elon Musk basically gave them the Heisman when it came to their involvement in the robotaxi or the cybercam. That Elon Musk doesn't sound like he's interested, but Waymo and Google Alphabet certainly was. And Tom, what's the end game here for Uber? Are they an acquisition target by one or two of those? Uber or Google Alphabet or Tesla? Are they an acquisition target? Possibly, right? That partnership usually starts with something for Google Alphabet. So I think that's important. When they announced that, all the fears about their involvement in autonomous driving dissipated and the stock went up to new highs, Tom. So I think that's where they sit right now. They're firing on all cylinders, but there was risk. That risk seems to be going away.
Kevin, over the past couple of days, Wells Fargo yesterday raised the price target to 120 from 100, keeps an overweight rating. Today, B of A raised their price target to 115 from 97. And they stated that no tax on tips provision in the big, beautiful bill includes 1099 workers and gig economy workers, Uber and Lyft. And we just talked about that with Andy Swan. This is all about scale, right? And Uber does better when more drivers want to drive for them, just like Airbnb does better when more people have places to rent out. Is that going to be a bonus, or is that the bonus moving forward?
It is a bonus.
You can make a case that's a bonus for a lot of service industry, right? Leisure and hospitality and service workers that get paid by tips. Let's face it, Tom, everywhere you go, if you pay electronically, there's a tip window, right, for you to hit. No matter if you're paying at a counter, if you're using a service, everyone's getting paid or asking to get paid via some type of tip right now. So does that part of the big beautiful bill help all these workers? I think it does. I'm not a tax expert, but it seems like that's a positive for them as well. And now they're talking today, Tom, about finding ways to get gig workers benefits without joining a union. Now the union's fighting that. That's another whole topic. If they get them benefits without having to go full time, without having to join a union, that's another positive for Uber and its drivers. So
yay!
Headlines out. Remember, I'm a big fan of the news flow, and the news flow seems to be really positive for Uber right now.
Yeah, it's reflective in that stock, as I mentioned, hitting all-time highs. The 50-day moving
Hickey and I agree there.
$87. We're at about $97 right now. So far above those levels, the most it's
we're
been,
pulling back some
in over a year at this point, as far as a technical basis. So Kevin, I looked at something pretty straightforward on this one. You look at the IV percentile rank; it's below the 30% level at this point on this rally that we've seen. So in the bottom 1/3 of volatility levels that we've seen over the last 52 weeks. So I looked at a straightforward bullish example here. If you think this thing is going to continue to grind higher and hit more fresh all-time highs. Now, they report earnings that first week of August. The 5th of August is when the data is for earnings at this point. So I looked at buying a call vertical, buying that 95
okay,
strike
get ready.
call, slightly in
We're at
money,
the 63.
Selling against that, selling the 101 strike call. So basically a bullish $6 wide call vertical. We've got $2.25 debit on this trade. That's where it was trading earlier. It's trading closer to $2.90 right now because the stock has bounced off to those session lows. It was down over 1% earlier in the session, now flat. But the debit you pay on this is going to be your risk. So if you pay $2.25, it's going to be $225 in risk. If you pay $2.90, it's going to be $290 in risk. Remember that. That's the most you can lose on that trade. Now, if you pay $2.25, it takes your break even to $97.25 to the upside. That's not even that far above the current share price.
It's good.
2%, Kevin. But it's pretty straightforward. I think one of the keys is, Kevin, you're giving yourself 3.5 weeks in this position, and it gives you some flexibility as far as trade management goes because you're buying a directional vertical.
Upgrades coming. I mean, there could be upward momentum in this name as long as the overall.
There's
market,
$25 a contract.
Stays,
35.
Tom, basically buying a $6 call vertical, spending somewhere between $2.20 and under $3 for it, so you get a chance to minimal double your money up there, or possibly more, based on where you get this in, what debit you make, Tom. But remember, the risk is the debit paid, and you really have very little Vega risk in the summer. You know, both options are in the same expiration, so nothing to be worried about there. This is just a directional play in Uber on the upside.
Yeah, and you know, Kevin, I looked at it this way. If you buy the 95 calls, because a lot of people will go, why don't you just buy the call? You're cutting down your potential profitability by selling a call that's above the market. Well, this is a duration, right? You've got a finite amount of time till expiration. If you were to buy the 95 strike calls just outright, it cost you over $5. That takes your break even above 100. So by selling something above where you're buying and making it a call vertical as opposed to a straight call, it lowers that break even. If you offset some of those costs by selling the 1-1 strike, that's trading over $2.10 at this point, with the expectations that, hey, yeah, it can go higher, but on a percentage basis that, or probability that's going to touch above 101 is a lot less than maybe just buying the call outright and waiting for the stock to even move higher to get above a break even when you're just buying a straight call. All right, good look at the directional bullish example there. That's going to wrap it up for us today here on Fast Market. But stick around right here in the Schwab Network. Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest.
I was thinking we could pull back to another.
GE Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus
there.
cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and
I should
start
add
investing in
it.
stocks,
Dadgummit.
bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It'd been nice.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
No politics, no noise, and a lot of cleavage. Got my 130.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor?
Yes.
Our investing webcast series breaks down different investing styles, including growth, value.
As long as it ain't over 24 hours.
Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
No.
Welcome to Next Gen Investing. I'm Jenny Horn, joined by my co-host, as always, Alex Coffey, and here to break down markets for the next hour here as we hit the noon hour in Chicagoland. So as we check in, we are seeing markets actually relatively quiet on the session today.
1 o'clock Eastern.
S&P's trying to edge out a modest gain, while the Dow is our laggard, down 0.3%. The Nasdaq up about a 0.1%, and the Russell actually out in front at about 0.9% gain. But Alex, as I was just saying, it does feel very much like we are in peak summer trading right now. As it's quiet, we're earnings light, we're even economic data light. Thank goodness, I guess we have tariff headlines to talk about.
Yeah, and it's interesting. We talked about this a lot. You were talking to me before the show about how July, I think you just said, every year since 2015, the market's been green for the entirety of July.
Yes.
But I've been talking about this for about a week and a half now. The first 2 weeks in July, historically, some of the best 2 weeks on a 2-week stretch for the S&P 500 of any year. Simon White from Bloomberg actually put out an article today saying the same thing. It doesn't get much better for stocks over the next 2 weeks, calling week 28 and the next one the best 2 weeks going back to 1990. So this first half of July, historically, pretty darn bullish.
Okay, and that's, I think, even more impressive when you think about the outpaced, I mean, just like price activity we see for these first 2 weeks. Even the week of the 4th of July, I was reading on average closes up, specifically in the S&P 500, about 1.3%, which is pretty strong historically. So yeah, some of these...
Just do if that happened every week, it'd be 50-some% average return. So obviously there's some down weeks in there too. Now, the one thing that we should preface is, seasonally, those weeks tend to be August, September, October. So it's like you get the good, and then it's like everybody gets back from vacation, and suddenly it's sometimes not so good.
That's true, yeah. So I guess maybe some of those people that are on vacation stay on vacation. We like things right now relatively calm and to the upside as we've seen price over the course of July thus far. But as always on this show, we will start things off with some movers to keep on your radar today. We will also be discussing Meta as well as Apple, as there is some news that Meta is stealing a top exec from Apple. So we'll be charting and trading both of those names, as well as looking at CoreWeave today for FOMO. Big move yesterday following that acquisition of Core Scientific, but today catching a few downgrades as the street right now has some pause about its valuation as we approach this now deal. We'll also be discussing the tech outlook from Danielle Rubino. So a great conversation there, as tech has been hugely in focus in terms of this market recovery. And we will close things out with Sunrun. Unfortunately, solar stocks looking for some sunnier days ahead, hopefully, as we did see Trump slash the green tax breaks. So not to be expected, or not unexpected, I should say, to see that weakness in solar, but continuously just taking it on the chin. A great example of how things can always move lower.
Yeah, one, it kind of goes to show if a business is set up with needing kind of kickbacks to make the business work. Not saying that that's the case for Sunrun or its peers, but you see the tremendous impact of the stock price from subtle changes to the tax codes. Maybe there's an issue with the business model. The same thing that we've said about other, firms that, are running on, no profitability and constantly issuing stock to stay alive. So this is when fundamentals matter. And so you got to...
It's true.
We'll get more on that with Jeff Pierce later on. Let's get to some of our movers of the day, though. D-Dog, Datadog down a little bit today, 4%. This on a Guggenheim downgrade, but it's got a word in there, sell. We aren't getting a lot of those, ratings that much lately right now.
That is exactly what jumped out to me, because I will say this is not as pessimistic maybe as a note as the sell rating would have you think, or maybe I'm trying to frame it optimistically. They did downgrade shares to sell from Mutual Guggenheim, that is, with a $105 price target, citing the risk of potential significant optimization by OpenAI, which they believe to be Datadog's largest customer. So they believe that OpenAI's overall observability software roadmap is shifting towards more cost efficiencies and in-house technology. And as a result, contending that OpenAI may have already started to move off its Datadog platform for log management and onto its internally built solutions instead, which they see then being followed by some depreciation of overall Datadog's functions. So given this risk, they're modeling about 17% growth still for Datadog in the fourth quarter, as a plausible scenario. On the other hand, though, I was reading a really optimistic note out of B of A from yesterday because of the fact that starting tomorrow, this name will be included in the S&P 500. So shares have rallied about 15% since that announcement. That was hugely seen as beneficial from right now the B of A securities analyst. But Guggenheim, yeah, with a rare sell today, which we just don't get to talk about conviction of that magnitude that often. I like a more, go one way or the other instead of these neutral ratings.
Well, Howard Ma, which is the analyst at Guggenheim that issued this call, is standing alone at the moment. The only sell rating that I'm seeing of the, let's call it 46 analysts compiled by Bloomberg. So 105, the price target. Now, it's a very specific reason, right? It's, hey, OpenAI is finding this way to do things more efficiently. They're building in-house tools. They're not going to use Datadog. Well, we should be able to see that in Datadog's numbers in the next few quarters if that's the case. As this analyst points out, potentially the largest company, customer for their company.
So far, not good.
Maybe more will either jump on this call, and this will slowly become, one analyst, 2, 3, 4, 5 that have similar ideas. Or this analyst is either early or wrong. And so something to monitor for Datadog. But I do agree with you. Standing alone, making a call, putting themselves out there a little bit.
Yeah, definitely. And I feel like that's something you also see from right now a lot of like I do tend to look at the average analyst coverage because I feel like comparing to some of these specific notes, I mean, it's just like one firm or one person's opinion. But a lot of these price targets are like overall ratings to me haven't caught up with price, probably because in a lot of these names, we've repriced so quickly that it does
we
feel
didn't
like
hold support.
That that'd be like your guiding point for some of these names.
Like the next one that we're talking about has made quite the move, I would say, in the last several months.
Exactly. So that speaks to Oracle, which Bernstein reiterated an outperform rating and raised its price target to $269 a share from around to $225, saying Oracle has always been the safe harbor stock amid economic uncertainty, but its growth story is now shining through. So amazingly so, 28 buys, 13 holds, there's no bears in this name. The average price target right now is around 223. So this is exactly what I started to see, but the overwhelming was over the last several weeks where average price targets tell you nothing. It implies about 5% downside because again, I feel like it's like either you're late or you're wrong. And so, or you're just waiting for things perhaps to normalize, which I can also understand right now.
Yeah, a unique situation happening for Oracle is we've really seen implied volatility levels start to uptick. It's almost 40% implied volatility, which you don't think of Oracle as like a volatile stock, but that's about 2 times the market's volatility. But it's still not keeping up with the actual realized volatility over not only the last month, but the last 3 months. Historical volatility or realized volatility of the last 3 months was closer to 50%, and for 1 month it's close to 60%. Now normally, that would be a bearish sign, right? The market's moving more than even options can price in. But uniquely, the movement's been to the upside. So this is a stock that basically every other day and the pace it's been on is making a new all-time high. Really impressive rally, and from the looks of it, no end in sight.
From the looks of it, yeah, another day of upside for Oracle. I mean, who is even surprised at this point as this name is leading our group of names, at least on the top of our show, to the upside, up just shy of 1.9%. Now, our next name today has also been a volatile player, and that is Circle, which is also seeing some modest upside today, about 0.25%. Bernstein was Oracle, of course. Mizuho actually is initiating coverage on Circle with an underperform rating, also with an $85 price target, saying they are bearish on shares, seeing about 25 to 30% potential downside to the fiscal 2027 consensus revenue estimate of around $4.5 billion. Consensus estimates, they do believe, do not fully reflect or account for the upcoming interest rate cuts, and also does overstate the medium-term growth potential of Circle's USDC stablecoin. So they are concerned right now about the company's rising distribution costs as well. So, I mean, $85 price target, that's why I think what threw me off here is it's so far off where we're currently trading that would be a long way to fall. Obviously, I mean, crazier things have happened.
And it's not the street low either. I'm seeing Goldman at 83. I'm seeing JP Morgan at 80. Now, some of these haven't been updated in a few weeks, but all things considered, these are the jobs I do not envy. Dan DeLev, for example, having to cover these type of stocks because they move around so much in the short term, but they're trying to think out a year, 2 years from now in some cases. 47% in the buy camp, 35% in the hold camp, 17% sell. Now the average price target pretty close to where we're trading, so it's $207.
A lot more drama coming in.
Right now the consensus price target using 15 of those analysts is about.
Well, then put some would have worked, Randy.
Again, don't envy trying to figure out what this one should be worth, but it's certainly one that's garnered a lot of attention the last several weeks.
Yeah, this has been like our flagship IPO of this year. I mean, I guess thank goodness that we had at least this.
Is there any other big ones? I guess CoreWeave.
Not yet. Okay, CoreWeave. Yeah, I guess we're talking about that later on. So we are just touching on some of these newly public companies. But yeah, it's been, to me, very much reminiscent of like when ARM went public or Kava, where there's all this enthusiasm. Obviously, very different worlds, but it's pretty much right now our only name that's carrying the torch of some of these IPO markets. Now, our last name today is Block, which I've always said this is now the worst ticker because it's been changed, it's evolved. I want it to be now SQ back to that so badly, but nonetheless, XYZ is where we are today.
Block.
Morgan Stanley, though, with a raised price target to 73.
Why they come up with XYZ, I don't never know.
Overweight rating on shares. They're modestly increasing their
I'd have voted no on that.
to account for this more resilient macro backdrop, as well as an adjusted sum of parts view to account for overall re-ratings amongst peers, which they still see room for upside in terms of revision estimates at Block. However, within the fintech banking group, they do maintain their preference for Chime, where they do see some more upside as far as better execution, and right now also considering their customers versus those of Cash App customers, which I've only been on Cash App a few times, and it hasn't to me had like that mass appeal of like Venmo, but it all depends on what world you obviously operate in. And separately, CEO Jack Dorsey has launched now this new beta version of a decentralized messaging service, BitChat, that operates entirely over Bluetooth. So interesting. We'll be curious to know how that plays out. But they've tried to, I think, be a fintech company. They've tried to be in crypto. To me, that's where Block somewhat lacks an identity as far as like where its growth is moving forward.
Yeah, and this is, I mean, I'm not picking on Jack Dorsey in particular, but the leadership team for Block, formerly Square, of course, just hasn't seemed to pivot at the right places to the right areas. And what I mean by that is this is a company that renamed itself to Block, basically short for blockchain, was all in on digital assets. Well, Bitcoin at the time, I mean, I'll key it in, I mean, because this happened, I don't know, back in 2022 maybe or so. Bitcoin at the time was 30,000, 40,000 probably, and now it's 110, and XYZ has basically lost 75% of its value from those points. So it just seems like it made the pivot and then it didn't pay it off. And so I just don't know what the identity of this company is. And if you're going to be an investor in something and believe in them, you kind of want to know what the direction is. And so I just don't know what it is. I don't know what the direction is.
Okay, to speak to that, because you made such a good point. So they changed their name back at the end of 2021, which if you look at the chart of Bitcoin futures, I mean, that is pretty much when we saw the first downside.
At the end of 2021 for XYZ, when it was SQ and Square, it was $260 a share, coming down from $290, and it's never sniffed those prices since. It basically was a one-way street to $90 a share, and has only deteriorated from there. All the while, its whole big thing was we're going to move into digital assets. We're going to be this big player in digital finance, decentralized finance.
Didn't work out that way.
Bitcoin has only gotten stronger. We just talked about Circle and this idea of stable coins really ramping up. You know who's not participating? Block. Were they left behind? Have they not actually made the investments in these things? Or were the investments into things like the metaverse that didn't pay off?
I know, you know what? It would have been a really good time for them to change their name to Block maybe 6 months, 12 months ago even. But I feel like they missed the boat on that hype cycle. They were always a bit behind.
But if you're just doing it for the hype cycle too, I think that's the issue. That should have been indicative of this is where we're focused. Okay? Well, what's to show for that focus?
A whole lot of nothing, frankly, because this has also been a pretty disappointing chart. And I know it hasn't necessarily been weakness specific to block in the fintech space, because PayPal has frankly not looked impressive either. But yeah, it does feel like they've been behind the curve on a lot of these like various sort of enthusiastic points of the market, like behind the curve
I'll be right
on
back.
blockchain, behind the curve on some of their peer-to-peer payments. So
Yeah, it's definitely fair. Firms struggling, PayPal's struggling, but you look at Visa, you look at MasterCard, not struggling.
Not struggling.
Look at Bitcoin, not struggling. So it's like the space you operate in, which is payments, and the other space you operate in, which is digital assets, both doing quite well, yet you're not participating.
yeah, and that's a problem. That's a huge problem. So that's, I guess, why to keep this name perhaps on your radar, to hopefully see an improvement or see further weakness and further deterioration of Block's story. I think they got an identity crisis as far as the ticker versus the name of the company, but I'll leave it there. Now, coming up next, it's time for Chartmaster. We are looking at charts and trades of both Meta as well as Apple. Some mixed feedback today regarding Zuckerberg now stealing, of course, away top executives from Apple. The latest blow for the iPhone maker.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network. Welcome back to Next Gen Investing. It's now time to dive into the technicals with our chart master, Rick Ducat. So Rick, we will talk two of the biggest names out there, two names frequently discussed on the show and of course on this network, Meta platforms as well as Apple. The story linking the two today is that Meta and Mark Zuckerberg are snagging a top executive from Apple to be on their super intelligence team. So not entirely like a new news cycle, because Zuckerberg has been very outspoken about hiring this top talent, but Meta today, in terms of price and on the year, frankly, looking a bit more favorable as well than Apple.
Boy, I really picked the wrong field to go into.
I know.
We're getting poached.
$100 million for a signing bonus. Shoot.
For sure. But anyway, though, so it's like a basically V-shaped recovery. Basically, like the past several months kind of got wiped away. We had our lows that we experienced here during our tariff news announcement. Then we can see that the price very quickly made its way back up. First with this steeper blue trend line, then transitioning to this more gradual wedge type shape between our two white trend lines there. But eventually we took out those old highs just below 741. So now price is retreating a little bit here. We have not really had any kind of big breakdown, but we also haven't had perhaps the big breakout to the upside that the bulls may have been hoping for. 705, our red line here, that's sort of where we had some highs after we started to break down, then a repeated ceiling and then low point. So that could be one area to watch. It also lines up very closely with our yellow 21-day exponential moving average right here. So around 703 to 705, a downside area to keep an eye on here. To the upside then, 741, that's our old high. We made some intraday highs beyond that point, but I can't help but notice too, we did not make a higher close versus the previous high close here. So another thing to consider as well, perhaps, that there's a bit more work to be done for the bullish crowd here. Notice as well, RSI showing a bit of bearish divergence here, declining momentum. The pace of the gains is slowing down here, even as price made new relative high closes here. Not exactly what you'd want to see if you're bullish, maybe not the most ideal situation here as we make these highs.
So, okay, as we zoom out and do look at the bigger picture here, some long-term trends that you've been keeping on your radar. I mean, this was our name that was up for 20 consecutive sessions. It was such a fun rally to watch, but all things considered, with the overall pullback in the market, we've recovered pretty nicely here.
Yeah, for sure. And what really needs to be done is we have to hold on to this supportive area here, 705, that, like I just mentioned here, lines up with this volume node. So a bit of additional weight to that as a supportive level. Then just below that are our lows here, our relative lows, 681, our green line. That could be another area to watch. To the upside, well, the same level I mentioned before, 741, quite close to our +1 yearly linear regression channel, or standard deviation channel, excuse me. One standard deviation up from our blue linear regression line, our line of best fit. So potential resistance there. And if we were to just take a glance at our longer term chart, our 5-year chart here, we can see that we've left those old lows behind in the dust here. Heavier volume right around here, once again around that 700 area, matching up with our +1 channel here. So that could be a supportive area once again based on this longer time frame.
Okay, yeah, so a lot to consider here, and up about 0.2% almost on the session, so at least hanging on to a modest gain. I almost said both these names were lower, but to Meta's credit, they're slightly higher on the session. So now, as we do look to trade this name for example purposes, Alex, walk us through your thinking here, and of course leaning into a lot of the optimism we've seen with, frankly, no signs of momentum slowing.
Yeah, tough time to trade in terms of stocks near highs, but trending higher. And so going with the trend, but trying to increase the probability of success with a risk-defined neutral to bullish strategy. Looking at selling the 700-695 put vertical spread, trying to stay ahead of the earnings announcement that's due out at the end of the month. It's a July 25th cycle. 700-695, looking for a $1.50 credit. In that case, you could collect 150 max profit on $350 in risk. 698.50 would be the break even. So you got about 3% in cushion down at that break even, Jenny, but this is a stock that we know can move swiftly if there's some sort of news or even risk off in the overall market. So most importantly, it's risk defined. The 1 month EMA, that 21-day EMA that Rick talked about down near that 700 line as well. So this could act as a potential support level. And if that happens, well, that's where we're making max profit at, which is right at 700.
Yeah, all these names will be reporting before we know it. So that's at least something to look forward to as far as catalysts. Although I know Meta doesn't necessarily need one, and neither really does Apple, as Apple has been seen now as somewhat of the laggard of this AI hype cycle that's driven a lot of these really nice comebacks on the year. But unfortunately for Apple here, Rick, I mean, we've seen a recovery, yes, modestly off lows, but failing to really see that momentum that the rest of these tech names have really seen completely recover their share price on the year.
Yes, some similarities between this and our last chart. Once again, kind of stuck at resistance here. Though in this case, it comes after a rather lengthy decline and a much worse recovery off of those same tariff news lows. In this case, we never even really filled the gap that formed here shortly before that announcement around that 220, 222 level. For now, we have gotten stuck here, 213. We topped out there several times. We also formed an accompanying low point here near about 196. If you were to backtrack even farther here, you can see that matches up with another significant low from almost a year ago there. So for now, a range-bound trade kind of stuck in the middle, sandwiched between our moving averages here, our purple 250 two-day EMA, right on that same resistance point of 213, so extra emphasis on that as a potential ceiling. We can also see our two shorter-term moving averages, yellow 21-day and orange 63-day EMAs, are clustering closer together near about 204, 205 or so. This could be a supportive confluence for traders to watch out for, but really if we were to break through this trend line as well, that could open the door to that 196 level once again. And you mentioned momentum as well here. So momentum, according to the RSI, more of a triangular shape for a while here. We did break out to the upside above that 50 midline, but price is not really behaving as you might have hoped. As I said, we're kind of stuck at this resistance level despite the momentum improving. We broke out from here, but now we are trapped once again in this broader range.
Yeah, and a far cry away from highs at roughly 260 a share. So, I mean, given the wider scope of your technical analysis, has this been uncharacteristic for Apple, or does this give you any sort of pause in some of that recovery in the more midterm?
It is kind of concerning that we are stuck at this level here and that the recovery has not been as strong as some of these other big tech names. I mean, Apple is such an important part of our market here. You know, it's concerning somewhat, but, you know, for now, we are still on the verge of making another push to the upside here. Linear regression line, our line of best fit here, matching up with this smaller volume node near about 210. We have a larger volume node just below here, so a supportive point potentially near about 200 or so based on that. But to the upside, the point of control, the heavy trading area is right around 229, which is quite close to our +1 standard deviation channel and these old highs. So quite a bit to consider in that area. And when we take a look at our 5-year chart here, just very quickly, for the most part, still trending downward though, still within this broader downward channel. We had this anomalous price activity during the tariffs, but you can see if you look back at 10 years, these old highs and these lows, that's where we held on pretty firmly during that news shock sequence here. So perhaps that's a key point to watch going forward if things do continue to deteriorate.
Yeah, and it's been amazing to watch the overall market's participation in this rally, even with the exception of Apple, really. And I know they haven't seen all down days, but I do think this speaks to the lack of really upside that Apple's provided the market's overall just indices that it's in. So great point there and great takeaways from a technical perspective. Rick Ducat, our chart master. And now as we do look to trade Apple for example purposes, Alex, I mean, this data also reports, I believe, the 31st of the month, so we have a bit of time there, but perhaps looking to lean into more of the same and more of this somewhat neutrality that Apple is seeing.
Yeah, maybe earnings will shake it out of this rut, but until then, maybe again spinning its tires just a little bit, kind of in place. It does seem it has plenty of headwinds, as well as the fact that it is one of the biggest companies in the world, a big part of passive investors and portfolios that are doing index tracking type investments that maybe works as tailwind. So as a result, maybe it's a bit of a tug of war, and maybe this 210 level can act as a balance point. Gave it a little bit of cushion, looking at selling an iron condor. 200 has seemed to be sort of a support level that it's based out at several times over the past couple months. At the same time, it's been struggling to get through 220. So selling to 210, 220 strangle, buying $5 wide wings, looking for a $1.25 credit. Expiration stays ahead of earnings, Jenny. So you mentioned it's at the end of the month. This is the week prior to that. If you get a $1.25, the break evens would be $198.75 on the downside and $221.25 on the upside. 3-to-1 risk reward. You risk $375, chance to make $125. So neutral, not the most fun trade. Sometimes you got to root for boring, but it's a relatively short-term trade as it just goes out to that July 25th expiration.
Hey, neutral is still conviction, because obviously things can always change in Apple as rapidly as they've fallen. So it's still definitely a peaking conviction, just looking for, again, more boring, more of the same for shares. Now, We'll leave it there for our Chart Master segment. Coming up next, though, it's time to dive into the latest with CoreWeave. After shares quadrupled following their IPO, we're seeing some analysts now turn to the sidelines, especially following that deal yesterday, of course, to buy Core Scientific. So we'll discuss some more coming up next.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
At each and every angle, the whole picture, everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk the latest with CoreWeave, as this name was very frequently discussed yesterday, of course, following the acquisition of Core Scientific. Lots of cores in both of these company names. But joining us now is Marley Caden, of course, contributor here at the network. So walk us through some of the pessimism we're seeing, unfortunately, from the sell side today, as 2 downgrades right now on CoreWeave for another day of pressure, although yesterday actually closing off of its session lows by quite a bit.
Yeah, and pessimism probably isn't fair. There are downgrades, but they did come with price target increases. So short-term pessimism, long-term optimism is sort of the story here. The pair of downgrades come from Mizuho and Stifel. They both downgraded them. Stifel last night, Mizuho this morning. Mizuho's note was a bit more detailed, so we'll cover them a bit more, but both say that they view shares as fairly valued right now. For Mizuho, they downgraded to neutral from outperform, but they raised their price target to $150. That's up from $70. So a pretty substantial mark. We're at now more than 2x. Now, of course, that follows that Core Scientific pickup, that $9 billion all-stock transaction that they're talking about. And that's a combination of 2 significant players in the AI world. So the acquisition itself is being viewed positively despite the red we saw from both companies yesterday and these downgrades. It's just in the short term there are some potential issues. So Mizuho does say they view it positively. They note that CoreWeave will allow them to verticalize the infrastructure supply chain while driving significant cost synergies and enabling more financial flexibility. But they do consider the risk-reward profile as balanced right now because they have a 300% stock price increase since the IPO. So just the last 3 months. So, you know, they're pretty high up there right now. They also said that the price target increase reflects a recent appreciation in comparable company multiples, also the growing demand for AI structure, which we continue to get more data on. And what Mizuho describes as, quote, a means of efficiently acquiring additional capacity at scale. So I know we talked about this a bit yesterday, Jenny, on the show, but they're going to have a lot lot more capacity at this point with this acquisition. So long-term positive, short-term some issues. Stifel did cite those near-term issues more prevalently. They did their downgrade from buy to hold. They cited near-term challenges despite recognizing those potential long-term benefits. They raised their price target from $75 up to $115. And they did say the repositioning of the company as a vertical data center provider does change their valuation structure, adding they do think they're fairly valued, but short-term there are some potential issues. Macquarie and Barclays have not changed their ratings. Macquarie has a neutral rating, $65 price target. Barclays equal rate with a $100 price target. So pretty wide swing right now from the analysts.
Yeah, that Barclays note obviously kind of reflects consensus too. It's neutral, which is what the majority of the analysts, 72% of those who cover it have. And the average price target of the 19 or so compiled by Bloomberg is right at $100 a share, which is their price target. But I think Greg Moskowitz of Mizuho really highlighted what I think makes this so difficult, and I do not envy. We were talking about this with Circle earlier. We're talking about a growth stock, not a lot of trading history, that moves around a lot in the near term. He highlights this. He said, hey, this is a highly volatile stock. It's going to have risk to the upside. It's going to have risk to the downsides. But they're trying to figure out what is this worth and where will it maybe be trading a year and a half, 2 years from now, a year from now. And as traders and as market commentators, we get stuck in today. And today this stock's at 150, and we're hearing you just moved your price target up to 150, and we're there now. The other analyst moving it to like 120, and it's like these are both neutral. These are both neutral, but it just reflects how volatile the stock is.
And it's interesting too. You were talking about the valuation; it's so hard to value. They've only been public for 3 months. They've had 300% growth in that time. It's very hard when watching the stock price to have any idea. But right now, they're trading at significant premium multiples. They have an EV/EBITDA ratio of more than 58 times. So not an easy task for these analysts trying to figure out how to price out this company and this stock. But I guess the overall message is some potential short-term issues. We could see some volatility in the price, but long-term, across the board, everyone seems to view this as a positive acquisition.
I definitely think so, especially because right now, if you look at their revenue, it's heavily concentrated. They have about 72% of their sales derived from Microsoft alone in the most recent March quarter, which is wild in itself. So, well, it does oftentimes work, and Microsoft is not a bad partner to have. It also then just tells you diversification is going to be critical here as we move forward and see a more, hopefully, signs of mature company as it does expand its legs here and continue to trade with more duration than just 3 months. So with all that being said, and now as we do look to trade this day, the difficult job of sort of gauging then some of this volatility, it has had a pretty brutal week now just over the last 2 sessions.
Yeah, I think there's one last thing to highlight too. This hasn't been public that long, and there's a lot of people in the investment banking world who make a lot of money to make sure 300% returns post it going public doesn't happen in a month, because that essentially means all those insiders and those who were in the private investment space just sold their shares pretty early to allow for this to go public, and so they want to value it as close to market value as they can. And so it goes to show just how momentum driven this stock's become. All that said, I hear the analyst calls, I see maybe what those roadshows valued this stock at, but it's a momentum stock. This is FOMO. We're looking at an upside play here for this particular example trade. It's a call calendar spread. Most importantly, it's risk defined. But if you think this stock has another run, maybe back to those highs, or at least on its way up to those highs, it stops at 170. This one would have a chance to make some money. Looking at selling the July 18th 170 call, buying the August 8th. So it gives you about a month's worth of time to that long option and about 10 days or so to that short option. The idea here is looking to reduce the debit overall down to $250. Means your total risk on this trade as is $250, but it gives you that upside exposure, Jenny, where that mountaintop risk profile peaks out of the strike. It's customizable. But if this stock is at 155 now and it starts running its way to 180, 185 again over the next couple of weeks, along the way you would potentially see 170. It maybe give a trader an opportunity to manage this position if they so chose. But most importantly, if it never goes to that and it just goes straight down to 100 like some of these analysts think, or even lower, your risk going in, and it's going to be limited to that $2.50 debit per the spread, or $250.
Which I think is so important, as we know this now, as we've all discussed. I mean, not one that is volatility light, at least. So definitely not for the faint of heart when looking at some example trades. We'll leave it there, though. Appreciate that, Marley Caden, of course, for all of that insight. And now coming up next, though, we will stick with our tech conversation. We'll be talking, of course, the latest with Elon Musk and Tesla. Tesla up about 2.3% today, as well as the broader Mag 7, specifically NVIDIA and the rest of tech right now, continuing to make actually a pretty decent session today. NVIDIA up about 0.8%.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Nicole Penalese, live from New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk some of the Mag 7 names, and we'll start off with, unfortunately, one that is underperforming the rest, and that is Tesla. Although today actually outperforming the rest, so it just goes to show any given trading session could depict an entirely different story. Joining us now is Dan King Hall, the host of Morning Movers. Dan, we did get a note from Blood Bush's Dan Ives regarding some of the political commentary, and I can sense he is stressing because he was a huge enthusiast behind Musk leaving Doge, of course, a few months ago.
Yeah, he is. And I'm not going to bury the lead here because Elon Musk has already responded on Twitter. This is a quote. Shut up, Dan. Dan Ives actually retweeted this, guys. This all started with a note that Jan put out this morning, and then he went to Twitter to summarize it. He calls this the soap opera around Tesla. He says the Tesla board must act and create ground rules for Musk's soap opera must end. He gave three main points, recommendations for Tesla's board. Number one, he says that the new pay package should have 25% voting control. He argues they should grant Musk a new compensation package tied to him reaching around 25% voting power. The goal would be to incentivize long-term commitment and pave the way for a Tesla XAI merger. And he said it would be designed to keep Musk as CEO through at least 2030. So he does believe in Musk's leadership. The second recommendation he has, guardrails on the time commitment to Tesla. He thinks that Musk compensation should include time allocation requirements to Tesla. As we know, that's been one of the concerns that's been hovering around Tesla and why Tesla faced some pressure for a chunk of this year because of Elon Musk's ties to the Trump administration and working on Doge, etc. His side projects, if you will, side hustles, if you will. Establish expectations and accountability to reassure shareholders is underneath that second point. The third point he mentions is just oversight on Musk's political activities. He thinks they should form a special oversight committee to monitor if political involvement conflicts with Tesla responsibilities. Not so much about politics, but the actual execution of the role. And he said the aim was not to limit free or donations, but to enforce boundaries where the action
Sideways Darvis box.
duties as CEO.
You know, Diane, this is one of those situations where, like, as market commentators and those who are talking about this in the media, this is like gold. You know, we're talking about this spat between two really, let's call them popular or influential figures within the world of finance. One being Dan Ives, an analyst who has certainly made plenty of headlines. And then you have the other being, the CEO of a really, really big company that is very, very important to kind of the trading infrastructure. But I kind of see both positions.
Dan Ives ain't shit to Musk.
I'm bullish this stock. This is what I think could help this company do better. And then Elon's perspective is like, I'm running this company. What do you know? And so it's super like it's funny and it's like perfect to talk about, but like both points I think resonate.
I think so too. I couldn't agree more with you with regard
I
to
can
that.
disagree.
Yeah, that's my takeaway too in terms of Elon Musk. He's like, it's my company. I can run it how I want to run it. But Dan has a great point, makes great points. One, and then two.
It's none of Dan's
we know
business.
that Dan is a longtime bull in this company. He's maintained that $500 price target, even when, I mean, look, Tesla has underperformed the Mag 7 year to date outside of the move that we're seeing today. But it's, you know, got some distance between where it is now and that price target that Dan Ives has on it, which is a $500 price target. That even when it was under more pressure, it's made quite some recovery.
Well, we got a head and
But
shoulders.
again, there are still headwinds around it, and then, you know, him creating this new or announcement of creating a new political party that just creates some more, you know, kind of noise around it. So
exactly.
That seems to me what Dan Ives' point is. He believes in Tesla, but he worries about the side hustles. But, you know, Elon Musk's point probably is, this is my company and I can manage multiple things.
I have to say, I had to see the tweet for myself or the post on X, and that's hilarious. I mean, I love that. I wouldn't even be mad if I were Dan Ives. I'd be like, hey, I got a response from Elon Musk.
He retweeted it.
Yeah.
He retweeted it.
Exactly, yeah. And I love that. So great insight there, Diane King Hall. Always appreciate it, all of her insight. And now, sticking with our broader Mag 7 theme, I'd now like to welcome in Daniel Rubino, the editor-in-chief of Windows Central. Daniel, thank you so much for being with us here today. And so now we're pivoting away from Tesla. We're talking to some of these behemoths in the AI world, although I know many argue that Tesla is one of these important players. But NVIDIA still stands to be the most important. And really, what are you watching as far as what's working right now in AI, what's not working, near and far-term headwinds and tailwinds here?
That's a lot to unpack there. Thank you for having me. NVIDIA, yeah, obviously they're doing quite well at the moment, and I expect that to continue. There is no shortage of demand for AI and where it's going in computing and companies that need their hardware. So I think they're positioned very well. We are seeing a lot of effects already, starting with AI in the workspace. The latest round of layoffs through a lot of the tech companies have been focused on AI. That is, they are trying to replace workers with AI, and this includes gaming with Microsoft and their Xbox console. So we're starting to really start to have the impacts here, I think, of what AI is going to mean for companies who are really just very excited, unfortunately, to replace workers with AI because there's so much potential here for productivity. NVIDIA, though, they're still the king of doing hardware. I still say there's a little bit to be concerned with the administration and tariffs. Of course, China is also a looming threat there as well. They've been able to, you know, with DeepSeek, it looks like cheat a little bit in the sense that they don't have to require as much hardware to get the job done. And we're going to see, I think, a lot of innovation here in this space, but what may end up happening is you see a lot of small companies coming up doing some great innovation or some breakthrough and then quickly getting swallowed up by some of these bigger companies who are going to, you know, absolutely need that technology. This is a race. Which country gets there first, and I don't even know where there is, but we are seeing some really big gains here in AI, especially in the PC market as well.
Daniel, maybe you can set the record straight for me, because I oftentimes think about how important the NVIDIA's sort of first mover advantage has been in this space. Not only did they take advantage of this first wave, but my understanding is it's not just chips. There's a software element to this product that they're providing.
SPX up to 200.
And whenever there's a little bit more of a complicated product that you're giving, there's probably a learning curve associated with that. So if I'm Microsoft and I'm buying all these chips, even if an AMD or a Broadcom or some unknown name, an Intel, catches up, aren't they just more likely to keep going back to what they know in the future unless there's a substantial productivity increase or cheaper offering from one of these other competitors?
Yeah, no, it's a really good point. There has been, I would say, especially in the consumer market at least, a lag between the potential of AI
watch this, see what happens.
is actually expected. But, this is why every company, and you bring up Microsoft, needs to be sort of almost independent of some of these bigger other companies like NVIDIA, because once you become dependent upon them, then everybody's competing for those chips. So it's well known Microsoft has been developing their own processors internally for their servers as well as other computational needs for AI. They're also, of course, trying to distance themselves from OpenAI. They're not publicly quite saying this, but we can all read between the lines. OpenAI is going one direction, Microsoft in the other. Microsoft can't be beholden to just OpenAI, because if something changes there, something happens, their Copilot service gets really affected. So what you need to see is all these companies need to invest billions of dollars so that they can both get the hardware and software components done and be as independent as they can without relying on other companies. Because once you become reliant on them, then you have less choice in the market for pricing, and it affects everything else down the line.
You think so?
Okay, and so to shift gears here ever so slightly, but just focus on Samsung a bit, because they did report operating profits were down over 56% on a year-over-year basis. And I was reading all of these and read-throughs about what this means, either if it's like broader implications for the overall market, or if this just shows that, hey, Samsung is maybe not the competitor it once was. I mean, what did you read of some of those headlines we got over the morning?
Yeah, companies like Skynex and some of their competitors and the high memory bandwidth tools and memory that's used for AI here is an extremely competitive market. Samsung has had, I would say, a rough couple of years in the sense where their processors haven't quite made as much of an impact as they wanted on the industry, against Qualcomm and other companies there. And when it comes to AI, they're caught a little flat-footed, not nearly as bad as Intel was, I would say, but they're struggling. That said, I think Samsung has a lot of potential. Switching to their consumer side, tomorrow we're expecting Samsung Unpacked, where they're going to announce their new flip and fold phones, as well as updated watches, using some of their own technology there. And as someone who covers mobile, I'll say that for the last couple of years, Samsung really hasn't made a lot of waves when it comes to its hardware. And a lot of companies have almost kind of made fun of them for the lack of innovation. I think that's going to start to change tomorrow. If the rumors are about the new fold phone that's coming out are true, this is going to be kind of where China has been going. China's been very competitive in this side. Unfortunately, due to the bans with Android, they don't compete in the United States as much. But I think Samsung is finally kind of getting its act together. They made public apologies before over their lack of innovation. There's also a rumored tri-fold phone that they're going to be working on that may be due out later this year or early next year. So I'm actually pretty excited for Samsung. The mobile market is flat. There are little spikes here and there, but they're timing this right for the holiday season. And I think these upgrades will actually be significant, especially for the watches too. There's some really neat innovation that's coming there.
Daniel, real quick, last point. As we're starting to watch this AI race, solidify and come into focus, it seems names like Apple, names like Alphabet are pulling back on the reins and trying to find the winning horse. You think that's a good strategy for the companies that didn't seem like they were keeping pace?
Yeah, you mentioned Apple, and they're definitely in a tough position. I'm a little concerned about them. Their services are doing quite well. The new F1 movie was a huge hit for them, and there's rumors that they're going to try to bid on the F1 rights next year. So from that perspective, they're doing well. When it comes to their software, AI, including their phones and the latest iOS versions, I think they're starting to make some missteps here. Of course, they did miss the big AI boat, so they're relying on other companies right now as they quickly scramble to build up their own internal systems. Again, especially a company like Apple wants to be completely controlled from the top down for the hardware and software, but they're really not there. They do have the hardware. I'll say their processors have a ton of potential for AI, and they're already thinking about using those for server farms for developers. But when it comes to the software and the magic behind there, they have a lot to catch up on.
Yes, they
Good
do.
stuff, Daniel Rubino. We appreciate it so much. You stopping by, Editor-in-Chief, Windows Central, with the Tech Space update. So we say goodbye to Daniel. We welcome in our next guest. That's Jeff Pierce, Senior Manager, Derivatives Trading, Charles Schwab & Co. for Under 30. And today we discuss Sunrun. Jeff, good to see you, my friend. And obviously this is a sector-wide
We're 245
move in response to some fiscal changes on the policy front. Give us the latest from what you're watching.
Yeah, of course, if you've been watching these stocks, some sharp moves up and down as this bill has kind of come to pass here. Solar stocks have already been hurt coming into this year by demand dropping, largely due to interest rate challenges, some consumer spending concerns.
Nice recovery.
Residential solar installations down quite a bit in 2024. And
Sunrun. Just broke double top resistance on SPX. These are at 270. Double top coming in. 3 white soldiers.
A bit more optimistic than where we started, as I was calling things boring, but right now firming up in at least 3 of the 4 major averages.
Yeah, we've been back and forth, but in a tight range throughout today's session. And
Yes, we have.
I'm watching 62.25. That's sort of been the balance point throughout the day, so we'll see if that continues to be the case.
Yeah, and a decent also recovery here in the NASDAQ, with still the Dow as our lone laggard. But that'll do it for Next Gen Investing for this Tuesday. We have the watch list coming up next.
Boom! Now to 320. The 6240.
Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power.
For being a small trading range, it's doing pretty good.
at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Welcome to the Watch List. I'm Sam Bartas. It's 2 p.m. here at the New York Stock Exchange. Thanks for joining us. Here's what's coming up on today's show. We'll break down Charles Schwab's June stacks report to gain some insights on Schwab client activity and investor sentiment from the past month. It's Technical Tuesday. Charles Schwab's very own Kevin Horner will join us to take a look at the charts of the S&P 500, ASML and Ready Computing. And our panel will discuss the outlook for crypto and where stable coins fit in the future of finance. But let's just take a quick look now at the markets with only 2 hours left in the trading day. And suffice to say, it's been a quiet all day. It's been pretty range-bound, particularly for the S&P 500, which has been sort of struggling for some direction today. We've seen a bit of a pickup in the NASDAQ, right now 0.2% higher. We've got the Dow that's continued to stay underwater for most of the trading day. But the Russell 2K, as we've been mentioning, has been outperforming, sitting up 1% higher. So a bit of a moment in the sunshine there for some of those small caps as we start to see a bit of rotation, it looks like. Let's take a look at other things on the move, particularly the dollar, which has been picking up a bit in today's trade. Right now, it's sitting at 97. The 10-year yield has, of course, been a big focus today with regards to what we're seeing internationally in the bond space. 442 right now. Gold lower, 0.8%. Crude up. It's at $68. And Bitcoin, we'll be talking about that throughout the course of the program with our panel, particularly around crypto stablecoins, sitting at 109 levels at this stage, 0.9%. For some of the biggest stories in the markets, let's welcome in Kevin Hinks, who is the host of Fast Market Schwab Network. And just in the last couple of hours, we've learned from Trump that another commodity is on his radar now, this time copper. Tell us what you're seeing there, Kevin.
Hello, Sam. Yeah, breaking news about, let's call it 40 minutes ago now. President Trump coming out talking about putting 50% tariffs on imported copper. Now, you can go to /HG copper futures. They're currently up right around 9%. You can go to stocks, Freeport-McMoran. That's up about 4% on the day, but this is another ploy by, or a play by the Trump administration to, focus on American production of copper. And so any company, cheap production overseas that is shipping to this country, a 50% tariff. So, President Trump, in slow markets like this, Sam, we look for midday headlines or headlines that break. There's no real news, there's no real earnings, but this, headlines coming from the Trump administration and the cabinet meeting. that started late morning is now coming out with headlines, and yeah, a 50% tariff on copper imports, copper futures, and stocks related to copper jumping on that news.
Yeah, it was really interesting in terms of how he phrased it, Trump. I mean, he just said, today we're doing copper. So it just feels like it's just another day and another tariff. I know Lutnick's on the air right now, so perhaps we'll get some lines from him too. But, you know, as far as where they get this stuff from, I believe it's Peru, Chile, Canada. So as you say, it'll be interesting to see if they can tap some of that domestic production, if that does certainly help things along. But switching gears to another story you've been tracking, we've been looking at some of the big bank downgrades over at the folks from HSBC. What are they saying?
HSBC coming out with a note today ahead of the bank's earnings next week. They focused on three names: Bank of America, JP Morgan, Goldman Sachs. They're said, talking about all three, a more cautious tone on universal banks and brokers following recent rally in shares. What do they mean by rally? Bank of America, the last 3 months, up 38%. JP Morgan up 36%. Goldman Sachs up 49% in the last 3 months. They recommend a more constructive stance on the super regionals, and they point to limited upside. Now, three things. They lowered Bank of America from a buy to a hold, price target of $51, but a little different tack on JP Morgan and Goldman. They reduced them from a hold to a reduce. The price target in JP Morgan, $259. Same on Goldman Sachs, hold to reduce, price target of $627. So ahead of next week's earnings, a little bit of caution on the banks. And a lot of the theme behind this is the incredible run that they've had. Like I said, big percentages in the last 3 months. They just think there's limited upside going forward. Sam?
Thanks so much for that, Kevin. Kevin Hinks there, appreciate it. That sets us up very nicely for our next guest. Let's take a look at the bigger picture with Phil Blancato, who's the Chief Market Strategist over at OSAG. I'm going to start there where Kevin sort of left off, because you and I have spoken about the banks before, and it's really interesting as far as what HSBC is saying here at the moment, Phil, isn't it? Because, I mean, it's not about the fundamentals, it's just about the run-up that we've seen.
Well, the stress test looks like that's going to go really well. There's got a lot of discussion about how strong they are. We're going to find they're incredibly strong. I think what HSBC is missing is the trading volumes that they've been experiencing since this run-up. There's going to be a huge second quarter revenue boost. And here's where I don't disagree with HSBC, is that they are trading at all-time highs. But why I like Goldman? It's a buyback story. But a company that's going to grow earnings next year at 15% and buy back maybe $30 billion worth of stock. Now you're talking about an opportunity to really took advantage of where can I win on any market sell-off.
A little bounce off to 21.
I think it's a bellwether name that's looking to access greater into the private markets by buying somebody. It's about their long-term story here and not where they're trading at today. I think they have much greater upside.
Okay, it's good to have diverging views, and I suppose we'll get a bit of an idea of how they're faring right now when we get the first cap off the rank.
By the way, we just sent everybody not to sell out. I'm telling you to buy it. Trust me, I know about it.
It's good to clarify, but obviously the bank's being one of the first cabs off the rank of the earnings season, so we don't have to wait too long to get a bit of an idea of how they're going. But let's talk about the sort of broader market, performance at the moment, because both Dan Ives and Kenny Pocari have described this market as exhausted today. Exhausted with tariffs, exhausted with Tesla, and perhaps some of Musk's side hustles or distractions, exhausted even with some of the banks, maybe to HSBC's point. But would you subscribe to that description?
No, I would, and here's where I'll agree with it. You look at valuations, they're stretched. They're not inexpensive, but it depends on where you look. So we know what's happening in the large cap, this gigantic reversal, the tech names, all these wonderful things. Well, look at the Russell 2 today.
Yeah.
Look at what the Russell's done, and any day we get marginal upside, you real strength there. Why? Because valuations are much better. International, which I have not loved, again, doing well today. Why? Because it's better valuation. So I think assuming the market paying with a broad brush is dangerous. It is
8 after
action in the large caps. But at the end of the day, there's other opportunities, and I think this is your chance to, where can I pivot from some of these names, take some profit, which is never a bad idea. Remember seasonality here, the month of July, August, and eventually September are your worst quarters, especially that September, August timeframe. So take some profits, pivot to where you can actually get some better valuations. And if by some chance we get a cut going into September, those stocks are going to rip higher.
It was interesting, folks over at Goldman Sachs, David Costin raising his S&P forecast, I think 6,900 in 12 months. What gets us to there when you take a look at, as you say, internationals and the Russell 2K, the small caps, getting a bit of a look in at the moment. What happens? Where do we go from here?
I'm building a portfolio. I'm trying to put where to put my chips. Generally, you want to be careful where you're putting international and small cap. It's a 5 or 10% allocation. You're still getting predominantly large because of U.S. exceptionalism, which I don't think is dead. But here's where you have to look at that market and ask yourself, what's it going to take to push it higher? Well, you needed probably a solid year of earnings growth that accelerates and market returns that are flat. Well, where have we been since really last September? Flat. We're up a little bit on the S&P 500. Think about where we were, the rally up, the sell-off. Now we're back to all-time highs. But really, in reality, we haven't made a lot of money. Yet we've had 3 solid quarters of earnings growth. We get one more good quarter this quarter. Let's say we beat the 4. We end up at 10 or 12, which is I think where we're going to end up. Now you've gotten a bigger E, and your P stayed flat. What does that mean? We get valuations in that 2021 range. There's your opportunity to end the year in that price range.
So the Liberation Day was a bit of a fly in the ointment then?
You know, it's funny. I just was never bought into the rhetoric. I've talked about this a lot. Trump was never going to punish the U.S. economy so greatly that we would have a breakage in unemployment. And we're seeing a little bit of cracks now from some of the tariffs, where you really suppress the U.S. economy. It was going to be some negotiation time. Where do we end up? Probably 14% all-in tariffs, which means we were on an average about 10, end up at about 14 on average, everybody pulled together. What's that mean? About $500 billion to the federal government, but ultimately to earnings. Earnings are going to carry a heck of a lot more where interest rates end up than they do a marginal increase on tariffs. So I just don't buy into the rhetoric yet.
Okay, another story that certainly is driving the market today, a lot of focus on Amazon with Prime Days, obviously. Not a great start. I think Bloomberg was out with some numbers this morning saying that sales didn't get off to the best start, as I said, in the first couple of hours there. But it is something that is on your radar.
Well, I like Amazon. Why? Because it's basically flat on the year. But a 4-day Prime Day is interesting to me, but that's not what's got me excited about. I think we forget about how much they do in cloud storage, which is exploding at a rapid rate. Then you put on Prime Video and Prime. These are 3 other revenue drivers that push us to a double-digit earnings growth next year. So less about the Prime stuff. It's kind of interesting. It's fun. But at a time when the U.S. consumer, albeit is spending a bit more smartly, where are they going to spend more smartly? I absolutely think it's Amazon. And why? Guess what we're about to enter? I hate to say this, folks, but it's very soon back to school season. So you'll see those numbers pick up steadily going into the fall and really push higher. Multi-billion-dollar spending seasons in August and September. Who's going to benefit? Amazon. So for me, it's a stock you should own of the Mag 7 that hasn't had a run up this year. Own it for the next 3 to 5 years and watch your double-digit earnings go pay your reward.
I suppose it comes down, as you
So
say,
far looking good.
It's stuff that really is a necessity when it comes to things like back to school. And another company that perhaps might also benefit from that is Costco. I mean, how do you look at this company?
You know, when I think about anchors in portfolios, and we talk a lot about, fringe work, large cap, small caps, international, there should be anchors. And one of your anchors, without a doubt, is Costco. And the reason why I like it so much, it was once a discount retail store. Now it's become this international conglomerate of international consumers. Online growth is 5x right now, really exploding online. They're doing buy now, pay later, which is really an interesting scenario, and a Costco credit card. And you're watching foot traffic step up. So in the same way Amazon fits a niche that Costco can't, Costco fits a niche that Amazon can't. When I think about anchors,
Tesla moving,
forget and own for years
double top.
The reason why I like Costco is it pays a decent dividend, but that's not it. It's now
Off the
become
200.
center to many of the consumers in this country who are still gainfully employed, earning a wage above inflation. And where they're going to spend smartly, they're going to spend it at Costco. It's not an inexpensive stock, but the stock you can own for a decade and set it and forget it.
Okay, and so then just lastly, where do you sort of sit on the rate cut expectations then?
So I'm going to take the other side of this one. I don't think the Fed was terribly wrong by not cutting. You could argue 425 on the front end of the yield curve versus the 10-year at 440 with inflation at 2.5. There's some numbers that don't make sense. But here's the problem: if you have a scenario where the big beautiful bill does get some economic lift off, and I think it's a marginal lift off at best. Right now, you're still looking at a scenario where we don't know the end result of tariffs. I'm not expecting a big inflationary event. What I would say is the Fed to cut here, we're probably one cut to 50 basis points behind where we should be. They should cut, I don't think it'll be September. I think it'll probably be December and then 2 next year.
Okay.
I believe we're in a deflationary world. Eventually we're going to get there, just not nearly as quick as everybody wants us to.
Okay. Great stuff. It's always a pleasure to chat with you, Phil. Thank you so much for your time today and coming into the studio. That is Phil Blancato, who's the Chief Market Strategist at OSEC, joining me here. Okay, well, coming up, Options Corner, Tom White joins us to highlight unusual options activity from the day and how investors are looking to trade on recent news of Datadog, Target, American Airlines. Stay with us.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. It's time now for Options Corner, where we analyse unusual options trades seen throughout the day. Let's welcome Tom White, host of Fast Market, a Schwab Network, and Datadog. You've got a bullish trade.
Yeah, Sam, the stock was downgraded this morning out of Guggenheim, and this is after rallying about 80% off of those April lows, just hit 7-month highs yesterday. So under pressure today, down nearly 3.5% on the day. Guggenheim did come out basically saying that OpenAI is Datadog's one of their biggest customers, if not their biggest customer, and they're starting to do a lot of the log management in-house, and with the capabilities of AI actually probably drawing back from Datadog at this point. So that's a concern moving forward. If you looked at last quarter, growth rate was about 25% year over year, and the Guggenheim analyst now says they only see about 17% growth for the next quarter year over year. So maybe a slowdown in growth here, despite the optimism that we've seen in the stock. You see the chart right there. It's been up and to the right during the April rally. $762 million in first quarter revenue, what represented that 25% growth. And AI observation there accounted for about 8.5% of their total annual recurring revenue, and that's up from only 3.5% from a year earlier. So they're starting to expand their AI workloads to their consumer or to their customers. They've got over 3,700 customers now generating more than $100,000 in annual recurring revenue on a yearly basis. So that continues to grow. But stock was downgraded, but I think somebody trying to buy this dip in the stock, it goes into the S&P 500 tomorrow during that rebalance there. So starts trading as a part of the S&P 500 on Wednesday morning. But trader came in, bought some August 15th, the monthly options, the 150 strike calls. They bought over 4,000 of those. Paid an average debit of about $7.20 for those calls. So pretty hefty option premium. So the break even where this trader starts to profit is above 157.20 over the next 38 days. It's about 7.5% above the current share price. So yeah, I think maybe this trader and some others trying to buy the little dip here that we're seeing, with the expectations that maybe people have to buy this stock if they're mimicking that S&P 500 as it goes in tomorrow.
Okay, and a bearish trade for Target.
Yeah, Target, their Circle Day started. Everybody's talking about Amazon and their Prime Days, the 8th through the 11th. Target Circle Days for their Circle members has been going on since the 6th. So that's, everybody thinks that, hey, this is going to be, everybody's buying across multiple platforms because Walmart's in on the sale days, Target, Best Buy, amongst others. But this stock has been a real big laggard, down 25% so far this year. It has rallied off of those April lows about 15-16% when the stock got down to about 87 bucks a share. But if you look at traffic trends, those are actually decreasing. Foot traffic last quarter decreased 2.4% year over year. Sales slipped 3%, while same-store sales fell 3.8% year over year. So it's been a rough go for Target. It just doesn't seem like they're getting anything right, even though maybe that push into the discretionary items where Target is kind of highlights. Maybe that's pushing back a little bit even longer than what maybe management wanted at this point. But even going into these expected sales and robust numbers from Target Circle Days, had a trader in there buying maybe some downside protection out in the August 15th monthly options. So these expire in 38 days. Trader bought 5,000 of the 95 strike puts. Paid an average debit of about $2.20 for those puts. So the break even where this trader starts to profits below 92.80 over the next basically 5 weeks. That's about 8.5% below the current share price, with put volume about double normal daily average volume that we've seen over the last 5 trading sessions. So yeah, bearish outlook here for this trader.
Yeah, it's interesting. Everybody wants to get in with a piece of the shopping festival pie, don't they? And I mean, some of those events go for like a month over in China with the likes of Alibaba and JD.com. So, I mean, 4 days is just a drop of the ocean compared to that, isn't it? But American Airlines, a bearish trade there. Tell us about that.
Yeah, shares have struggled, and a lot of the airlines have struggled. United, Delta were hitting all-time highs in January. American Airlines was trading above 19 bucks a share in January. It's pulled back pretty significantly, off about 33% in 2025. B of A did just recently raise their price target to 12 bucks from $10. And I think if you look at maybe the landscape here for the airlines moving forward, is the luxury is doing well, the high-end flyer is doing well, international's picked up quite a bit, business travel's picked up, but American has probably the worst balance sheet out of the big three as far as debt on their balance sheet, and that's made them struggle a little bit. They haven't cut capacity enough, which typically is a bonus for these airlines, and you had crude oil prices bouncing off 2025 lows, so that's going to hit margins right away. Now, Delta Airlines reports on Thursday morning. Maybe this trader's setting up maybe for some weakness. If Delta's releases weak earnings, we're probably going to see a lot of the airline stocks down, and vice versa. If Delta Airlines earnings are good, we'll probably see a lift in the sector. But we did have some bearish activity in this one too, and this was out in the July 18th monthly options that expire in just 10 days. Trader bought 14,000 of the 11.5 strike puts, paid an average debit of just 32 cents. This is a low price stock, not a lot of option premium in these puts. So the break even where this trader needs to go below is $11.18 over the next week and a half. That's about just under 4% below the current share price in there. So maybe setting up for some weakness, but it could be somebody maybe just hedging a long stock position that they have. But yeah, if Delta Airlines earnings aren't good or they guide lower, that might hurt the whole sector. Maybe this trader, it pays off for this trader if that happens.
Okay, well, all eyes on that report card are coming out on Thursday. Thank you so much for that, Tom White there. Appreciate it. Coming up, we'll break down Charles Schwab's June stacks report to gain some insights on Schwab client activity and trader sentiment. That's coming up next on the watch list.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market. Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to the Watch List. I'm Sam Barnes, live from the floor of the New York Stock Exchange to discuss Schwab client trends from the past month. Let's welcome in our next guest, Joe Mazzola, head trading derivatives strategist at Charles Schwab. Thanks for joining us, Joe. What were the big takeaways from last month's report?
Yeah, so we did see an increase for the first time in the last 3 months. It was small though. It's interesting, kind of given what the market's done. The rally off the April 8th bottom, just to kind of see that investors are still kind of maybe dipping their toes in the water a little bit and aren't jumping in head first. What we've kind of seen is moving maybe out of some of the single stocks into a little bit more ETF mutual funds. We're not seeing a lot of kind of the upside call buying that you might see when you get a move like we have. You're not seeing a lot of margin allocation, so people aren't basically loading up the boat. They're buying. And we have really good volume, really good activity in June. It's not something that's kind of stretching the limits. It's not something that I would call, the fear of missing out trade.
Okay, so interesting rotation into industrials and discretionary away from tech. Talk us through the psychology behind that.
Yeah, so I think that's part of it is that we've had such a big rally in the Mag 7, particularly like Nvidia. That was the number one sell. And so when, they look at what can I rotate into, two of the discretionary stocks popped up as two of our top three, and that would be Tesla and Amazon. Tesla, in my opinion, our clients like to kind of, do some bottom fishing, right? So when you see the stocks pull back, like about that 15% dip that we saw at the beginning of June, below the 280 level, that's where we saw a lot of activity that week on the buy side. And then with Amazon's just kind of been a steady mover all the way up, grinding up, and clients are adding that along the way too. So, Nvidia, like I said, is the biggest sell. Now it's still the biggest, holding in terms of client percentage of their portfolios, or percentage of clients holding it in their portfolios is a better way to say it. But it is something that we continue to see trimming into strength. And Sam, what's really interesting about that is for basically 2.5 years. This was number one on the buy list, NVIDIA was, and for the second month in a row, it's number one on the sell list. It just it speaks to me of this, as you mentioned, the rotation, but also kind of de-risking.
Right. It's interesting, as I mentioned, into industrials. I mean, no doubt that speaks to also some of the themes around this reindustrialization, onshoring, which is what basically the tariffs are all about as far as Trump is concerned. Do you believe or anticipate that this could continue as far as a trend off the back of the big, beautiful bill and some of the clarity around tax?
Sure, and here's the reason why. If you look at strength in terms of sectors and percentages of stocks above the 50-day moving average, industrials is right up there amongst the top three. And if you look at best performing sectors, kind of year to date, industrials is number one. So that trade started back in April, and it's something that's continued all the way through. We'll find out more in terms of the tariffs and what that policy looks like. But as long as
going close to the 200,
as you mentioned, I don't see that trade stopping anytime soon.
Okay, and what were some other popular names bought throughout the month of June? I mean, you've mentioned Tesla, Amazon. Any others?
Yeah, Palantir was number one last month, number two this month. You look across the retail space, that is, it's been a retail darling, and clients have done well in that. Another one, which maybe kind of flies in the face of the de-risking, was Circle. And if you look at kind of what that stock did, it was up fourfold in the month of June. And if clients were able to kind of pare back some of that risk towards the end of the month and got out before the stock got cut in half, they did well. But that was really the only kind of meme stock trade that we saw that made the top five. So those are the ones that kind of caught my attention. I think the other thing that is really interesting is the survey, because along with the behavioral study that we do in the Schwab Trading Activity Index, we also ask them kind of how they're feeling. And the clients became more bullish, actually the most bullish they've been since December of 2024 in terms of what they're telling us. But as you mentioned, it's not necessarily something where they're reaching for tech at this point. If anything, tech was the number one sold sector across the board. It happens to be that they're moving into ETFs, they're moving into mutual funds, big movements into fixed income. And the one thing that they say, that could alter that is, could be news out of Washington, whether it's trade or and tariff policy, or if there's some type of more volatility around that.
And just very quickly, I mean, as far as what was behind that bullishness, I mean, what's sort of driving that? I mean, is it what they're hearing as far as, perhaps some of the rollback of the tariffs or some pricing in or expectations of the Fed rate cuts?
Yeah, I think what they said specifically was that some of that volatility that kind of shook the markets back in April really started to dissipate. And as long as they feel that there is some type of there is some idea of what the tariffs might be. Now, remember, this was taken a few weeks ago, so before yesterday and today. So we'll see kind of what the July report looks like. But they also noted that the calming of the tensions in the Middle East helped quite a bit. So a lot of the geopolitical and kind of tensions, and then also the risk that we've seen in DC in terms of passing of the big beautiful bill, and then also in terms of kind of the tariffs and trade policy. As that starts to normalize, you're seeing less and less of fear of volatility. And you're seeing the options market too. I mean, look, we got a VIX trading at 1670 today. You would think with all of the things that are going on between now and say that April 1st expiration of trade and the tariffs, boy, you would think that people would be buying in protection. They're just not doing it. Between our clients and the rest of the field out there, it really is this steady grind up.
Yeah, excellent snapshot. Thanks so much for that. Really appreciate it. Joe Mazzola there, Head Trading Derivatives Strategist at Charles Schwab, for joining the show. Well, still ahead, Technical Tuesday. Kevin Horner joins us to take a look at the technical levels for the S&P 500, ASML and Rigetti Computing.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Sam Barnes, live from the floor of the New York Stock Exchange. Let's take a look at a few movers in the market right now. Uber hit an all-time high today after Bank of America raised its price target on the stock to $115 from $97. The firm maintained a buy rating on shares, citing the no tax on tips provision of the One Big Beautiful Bill for the price target hike. Bank of America says the tax benefit could provide a modest boost to supply, including supporting take rates. The firm also cited data from Bloomberg, second measure, which showed modestly accelerating bookings growth for Uber. And CoreWeave is lower today after receiving multiple downgrades. Mizuho downgrading shares to neutral, saying that CoreWeave's extremely high volatility presents risk to both the upside and downside. Stifel also downgrading the stock to hold, citing key near-term overhangs and the repositioning of the company as a vertical data center provider. Both analysts are raising their price targets on CoreWeave and see shares as fairly valued at current levels. Well, it's time now for Technical Tuesdays, and for that, let's welcome in Kevin Horner, Senior Manager Trading Services Education at Charles Schwab. Thanks so much for joining us, Kevin. Nice to see you there. What are you seeing in the chart for the S&P 500 first?
Yeah, great to see you, Sam. I'll tell you what, this market continues to impress. We're looking at 2 full weeks now above the 10-day moving average.
22 more minutes.
20-day moving average.
The power hour.
A while here, 10 weeks or more. And we've held both the 10-day now for about 11 sessions, and that 20-day in orange is really notable because it's caught up to the 6,100 level.
Oh.
We really saw a breakout occur about 2 weeks back. So, this is continuing a trend that we are surprised, to a certain extent surprised by, right? I mean, we've had some tariff headlines this week, some reminders of the expectations of the administration, and yet the market is just not showing any give back here. So I think short-term traders probably continue to monitor that 20-day moving average. Maybe the 50-day comes into play some time down the road, but we're a good bit away from that, somewhere in the neighborhood of about 300 plus points from visiting the 50-day moving average here. here. So, this has been an impressive move, and I think traders just watching the trend, continuing to play the trend and stick with it, assuming that the major moving average here, the 20-day, remains held over the coming few weeks. We've got plenty of optimism here remaining in the market, it would seem.
Yeah, that certainly seems to be behind the folks over at Goldman Sachs' view as to why they've raised their forecast for the S&P 500. Moving on to ASML, it's been playing a bit of catch-up since April. Talk us through that.
Yeah, exactly right. Playing catch-up, had a nice push off of lows, up 35%. It did finally pick up its 20-day moving average, interestingly enough, back on April 23rd. That's the same day that we saw the SPX, the NDX, the SOX, all of them right after their 20-day. And so there's some positivity to take from a rally that began on the same day amongst multiple indices and multiple securities. What I find notable here has been the 3 consecutive bull flags that are trying now, the third one trying to resolve bullishly as we speak. We've maintained the 20-day moving average, like I said, since April 23rd. We've got a horizontal support at 78, which has been broken and tested successfully here with recent lows in the last week. And now you're working to break out of that bull flag to the upside. Now, the thing that's most notable to me here is that really far away red line up above. 975 is a potential target zone for short-term bulls. Shouldn't expect to get there on an overnight trade or anything, but if you just, once more, watch that 20-day moving average, potentially the 50-day moving average, it sure seems that things are shaping up more favorably in the near term here. You are also getting that golden cross 50-day crossing the 200 to the upside, notably at the volume point of control, right around 727 or so. So there's been some consistency here in this chart. There's been some bullishness in this chart in the most recent 3+ months, and it looks apt to continue here rather than get reversed anytime in the immediate future, perhaps.
Okay, that's ASML. Turning our attention now to Rigetti Computing. What are you seeing there?
Yeah, Rigetti's interesting, largely because, we've been talking a lot here on the network, external to that. The market is interested in quantum stocks. And the thing that I've noted on this one, we actually looked at this one recently, back in May, because it broke through and looked like it was going through into a new breakout phase. And that happened right in the middle of May. We got through 14, but instead we got pushed back to the 50-day moving average and the volume point of control there, right around $11.10. Now the 50-day moving average now is at 11.5, and what I was noting was the rally through the last 4 sessions here, breaking that downtrend line off the peak. So once more, looks like you could be staring at a continuation move, and new bulls could have joined the trend as early as 3 to 4 days ago based on the breakout of that downtrend line. So closes through 14 here could be really opportunistic, but if you're a new trader to this position, it probably means you want to see a new high close, which would need to be over 14.20, and then that might give traders an opportunity to target 18 up to the $22 or $21.90 approximate high we've seen in this stock. So again, a nice trend developing, a wonderful pullback that has maintained higher lows along the way. So if this can get through 14, bulls are apt to start pushing back into the name here for a potential momentum-based play.
Okay, Kevin, and before we let you go, what do you make of the overall market performance today? I mean, flat as a pancake over on the S&P 500, as is the NASDAQ. I mean, we've got the Dow continuing to stay under pressure. Obviously, data light, earnings light. What are you watching? What stands out to you in this market right now?
Well, honestly, I think the reminder here that we can't unload positions in a market that continues to maintain levels. It's one thing to take some profits and do so positionally and build some cash, but the market doesn't want, apparently, to give back much of this move. And it feels to me as though the optimism that has shown in the face of narrative headline risk doesn't seem to carry as much weight as the price actions carried. And so moving through specific levels, taking out new highs in the market are generally not a bearish viewpoint. So I'm encouraging viewers of the shows and everything to monitor the market closely to their own comfort zone. But obviously, if you're a trend trader, you're not given a lot of reasons to go against what's working right now. You're going to stick with the trend most likely. And, the one thing that I will say that's been encouraging to me has been the broadening out of the rally, meaning while we've taken a little breather in the last couple of days, we've seen other areas step back in and provide some of that leadership. So feels as though it is healthy at this point. We'll continue to watch our trends because that's what traders are paying most attention to, I think. But ultimately, I'm going to say that the big takeaway for me is resiliency in the face of headline risk. I think that we're continuing to see just that.
Okay, good to know. I mean, as you say, Russell 2K outperforming today, up 0.8%. So the clear winner, as you mentioned. Kevin Horner, it's been an absolute pleasure. Thank you so much. That is Kevin Horner, the Senior Manager, Trading Services Educator at Charles Schwab. Still ahead, we bring in our panel to discuss crypto and how stable coins fit in the future of finance. The watch list will be right back here.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Here we go, three black crows again.
Schwab.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
6235.
Specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds,
back to
money market
135
funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome back to the watch list. Let's bring in our panel now to discuss stable coins and the future of crypto. Very pleased to say sitting beside me now is Andy Baer, who is the head of product at CoinDesk Indices, and Mark Greenberg down the line, global head of consumer at Kraken Digital Asset Exchange. Gentlemen, thank you so much for joining me. I'm just going to start off with Andy because he is sitting beside me right now. So, I mean, how are you looking at things? There's just so many moving parts. As you say, it's as noisy as the trading floor in this space right now. So
medium noisy, not super noisy, right?
Exactly.
So it was been a pretty quiet couple of months. The last 2 months, except for one single day, Bitcoin has observed a 10% range, and for 62 days now. So except for that one day, that was the day that we had the incursion into the Middle East. That's kind of a record. So volatility and volume in Bitcoin trading has followed that. So even though we've had 12 straight weeks of inflows into ETFs, the volume and the volatility of Bitcoin has decreased. So it looks like we're moving into another kind of sideways summer, which is fine. Lower volatility.
Three back crows with a hammer.
For traders, it can also kind of crank up the spring of risk. How and when do we want to exit this range? So for now, everything's calm, but we'll see what happens when exit velocity strikes.
Okay, and so obviously a big focus for this market has been the stablecoin. So I do want to bring you back into the conversation, Mark, because you've been talking about, how the market cap has grown almost 50% in the past year. I mean, no doubt there's been obviously a lot of supportive and very positive developments in this space. Everything from the stablecoin bill with sort of the federal framework now, a bit of a legislative win, you could say, for this space. Also with the Circle IPO. I mean, what's the next tailwind? I mean, have you got any sort of figures you can throw out there as to your expectations of, how high we could go here?
Yeah, so as you said, up 50% this year to 250 billion in market cap, and
we're waiting
14 trillion.
Back down to 135
transactions globally last year. By the way, that's actually more than Visa's annual transaction volume. I expect to continue to see that number grow. I'm expecting numbers over $1 trillion, not too far into the future, from the market cap side. And all of it just comes back to the very simple fact that money is still too hard to move around the world. As a Canadian, I live that every day when I try and move money to my friends in the United States, and or move between bank accounts around the world. And so stablecoins just starting to reach that traction point, and that 50% growth, I think we'll see it go even higher over the next few years.
Okay, so it's pretty rapidly growing. So, I mean, Andy, over $1 trillion market cap in the near future.
Absolutely.
But no timeline there. But, I mean, what do you think is the next sort of big story?
Well, for one thing, let's remember that especially in these
60. Let's break
US
it.
Treasuries have sort of become a chess piece, right? It's not necessarily obvious that those are going to get sucked up by the rest of the world. All of these stable coins are usually collateralized or underfunded with U.S. Treasuries. So the U.S. government, in passing the Genius Act, is creating a new customer for U.S. Treasuries. So that's pretty significant. It's a healthy kind of move. I agree on the growth numbers. The volume numbers are also interesting because every time a stablecoin trades hands, that's a blockchain event. So whether it's on Ethereum, or Solana, or Tron, another blockchain, investors wondering what's blockchain for? Well, this is a perfect example.
Okay. And so, Mark, I mean, I'm curious as far as, I said, the next leg to get it to that $1 trillion market cap. I mean, what do you see happening in the second half of the year? Because as I mentioned, we've had some positive tailwinds as far as a sort of more crypto-friendly White House, as I mentioned, the sort of more mainstream adoption as well as institutional participation too. So can you give us a sense of what comes next?
Yeah, so continued work on the regulatory front. Yes, progress in the United States after some progress in Europe over the last year, but a lot of other markets, Canada, the UK, Australia, still a lot of work to do to get to a place where the regulatory regimes for stablecoins are clear. I'd also say the next big sort of topic on the agenda is going to be yield. If I'm holding a stablecoin and I have access and I'm holding it in order to pay for things, to save, I'm also expecting to be earning yield off of that. We're starting to see the first set of stable coins, the Global Dollar Network or others more on-chain like Athena, which are offering yield back to users. And I think that's cool to users, to businesses, to basically anyone who wants to hold and use stablecoins instead of using fiat directly. And I think that's going to be a big part of the next year ahead in continuing to see that growth grow. Yes, in the US, maybe it's a little bit easier to get yield on your US dollars, but if you're in another market, it's actually quite hard to get that 4.5% that you can get through a stable coin in the fiat space.
So you're nodding your head. Do you have some thoughts on this particular
Absolutely.
use case?
The yield question is an immense one, but so is the borrowing question, right? Stablecoins don't have their own money market, yet a lot of borrowing and lending in the crypto community takes place. So last month, we started to calculate an overnight rate, like a SOFR for stablecoins, and that has trended around 5.5% for USDC and USDT, although it can be pretty volatile at times. So we foresee a time when, just like money market or Eurodollar futures, which are now SOFR futures, would trade for stablecoins, which would set borrowing and lending rates, create a term structure. So we really want to try to financialize stablecoins as much as we can, not only in the sense of the experience of the user getting yield, but the experience in the sell side of being able to set term borrowing rates. So we're building a lot on top of this infrastructure. They've been around for a long time. People trade Bitcoin against USDT or USDC just as much as dollars. So the adoption is great. I think that the institutional, the financialization part is going to be really fascinating.
Oh, absolutely. You know, when you talk about coming up with some of the products to trade this stuff, I mean, for the layman out there, I mean, could they potentially be, you know, investing in this stuff without knowing it?
I think the idea is that you want lending markets to be, even institution to institution, to be transparent and to be standardized and to be familiar. And that will invite new people in because they will recognize, oh, I know how a SOFR future works. So is there something that works like that in stablecoins? And if there is such a thing, the adoption gets pretty broader. That creates more liquidity,
6 more minutes to power hour.
Familiarity in those crypto markets. That will find its way down to utility for individual investors. But I'll go back to the other point, 14 trillion in volume, that has to trade on blockchains somewhere. So look at those layer 1 blockchains and see where those stable coins are trading, where those executions are happening. And when you think about what kind of portfolio you want to put together, that's an element that's going to be important to track.
And I was having a fascinating conversation this morning about Bitcoin treasuries as well. But I do want to pick up on something that you said, Mark, too, about you know, some of the regulation. I mean, clearly over the years we've seen that crypto is investable even without some of those guardrails. But you know, no doubt some of the barriers being removed would offer even more of a tailwind. But just want to get your thoughts on prices right now. I mean, you know, as far as Bitcoin trading today, 109 levels, you know, in the face of a pretty quiet old day in equities and what we're seeing in other asset classes.
Yeah, so I think much like Andy said a little bit earlier, I think we're probably in for a little bit of a flat summer across Bitcoin and across other markets as some of the tailwinds lose steam from earlier in this year in the United States, and new tailwinds are added. I would say continue to actually watch the stablecoin space. As stablecoins continue to pick up, as they gain market share, expect to see more interest in Bitcoin as well, and especially among institutions and more traditional institutions looking at stablecoins as their first entry to crypto, and that very quickly turning into them investing in other inflation hedges like Bitcoin.
Okay, I suppose they're called stable for a reason. Gentlemen, it's been a great chat. Thank you so much. It's been excellent. That is Andy Bear there and Mark Greenberg joining us on the crypto space. That's going to do it for us on the watch list today. Download the free Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. I'm Sam Barnes. Thanks for watching. Market on Close is coming up next on the Schwab Network. Stay tuned.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network. Market on Close. I'm Marley Caden. With an hour left in the trading day, let's take a look at
Power Hour
right now as we take a look at the S&P 500 as I look over at our big board here. We are looking, okay, we're pretty much flat. It's a flat day. You know, we're slightly under on the S&P.
No, I don't know about that. Dow Jones ain't flat.
Slightly up on the day at 22,705.79. The Dow down 0.3% at 44,262.47. And the Russell is our winner on the day, up more than 0.8%, 2232.87. And as we take a look at some of our futures products, let's see how gold and oil are doing today. The dollar mostly flat on the day as well at 97.17. Gold down more than 0.8% at 33.14.30. Crude oil up on the day, 68.39 a barrel. And Bitcoin up more than 1% right now at 109,570. All right, well, now it's time for us to take a look at a few of our top stories for the day. To help us do that, I am joined by Jenny Horn. So, Jenny, let's kick things off with a company I feel like we'll continue to talk about almost every day together.
Yes.
Of course, I'm talking about Tesla.
Yes, so Tesla with some drama right now. A drama I will say I love following because it involves two of my favorite people to follow in this space, being, of course, Elon Musk as well as Wedbush's Dan Ives. So Dan Ives did tweet basically directing at the board of directors saying take these 3 steps. They were a new pay package which gets Musk to about 25% voting control, which then clears a path for the XAI merger, but guardrails then established for the amount of time Musk spends at Tesla as part of that pay package, as well as oversight on political endeavors. And Musk responded directly to this tweet to say, to quote, "Shut up, Dan." So in a nutshell, this is really what they're calling this tipping point for the Tesla story. And ultimately, they say the Tesla board needs to act now to set these ground rules for Musk going forward. The note from Wedbush, just to dive deeper into it, was called basically the soap opera must end. So Ives has argued that right now Tesla is heading in one of the most important stages of their growth cycle that we've seen, with the autonomy element as well as the robotics future now on the doorstep, noting the company cannot have Musk spending more money or time, frankly, on right now the political agenda, which requires just countless energy as well as the overall focus of the Tesla fundamental story. So I think that he's not alone in this thinking, but amazingly so, they do still have the highest price target among analysts at $500 a share.
You know, it's so interesting because we talk a lot about Dan Ives, obviously, but I feel like when I saw this headline, the very first thing I thought was he used his first name. He acknowledged that he knows who he is. So I'm sure we're going to hear a lot more about this coming up. But you said an interesting thing. It is, the tipping point in the Tesla story is what Wedbush referred to it in their note with Dan, but it's also like an inflection point for Tesla. You know, they're trying to continue this sort of rebranding away from being a car company to being a tech company. And so much focus is taken away from that constantly by these other endeavors. So, I mean, it makes sense that at a certain point there'd have to be some action to secure the safety of the company. But whether or not that happens
remains to be seen. And you know, Ives is also not the only bull that's been critical of this political activism. Actually, William Blair downgraded the stock earlier this week to the equivalent of hold from buy because of Musk's political plans and the rhetoric that, as well as the negative impacts on the spending bill that was passed in Congress that could have some implications on Tesla's margins and its EV sales. So throw that into the mix, that also isn't helping that you lose a massive incentive that was seen here in the US to purchase EVs. And I know we talk a lot about the declining sales in Europe and the way that some of the brand perception of Musk being so tied heavily to the Trump administration, how it's really, we've seen a direct impact, especially in countries like Germany, which is their third largest market. But I will say to that same narrative, here in the US still matters so much more. It's 50% of their sales. China's roughly 22%, and Germany, which is their third largest, is roughly 3%. So everything going on here domestically does still matter more to their revenue. And we could see some degree of an impact as a result of these now rolled back really incentives under the big beautiful bill, which I think is really where this whole drama started. And I know Musk has tried to say it's more of a matter of like the American people and making sure that we're exercising our freedoms and our rights. But I think that you can put it more plainly. He's probably not happy that this is another thorn in his side as far as the growth story for Tesla.
Sure, it certainly is hurting. You know, look at them right now. They're down more, almost 7% on the day. Whether or not that's because of this current TIF or the notes that came out of the big beautiful bill that they're not going to get that EV tax credit and the rebates are not going to be there for them anymore. It's hard to say, but I mean, year to date, they're down more than 25%. So something has to change here in this narrative if they want to stay on top. And couple that with the Austin launch of Robotaxi, which is certainly not looking like they're going to be a heavy Waymo competitor, at least near term. They don't have the same level clearance, and they're working for it, but they still have a safety driver, and they had some videos that popped up that were unsavory and going the wrong direction on certain roads.
And they're behind.
Yes.
I feel like just the timeline of it, the fact that we've waited now, I mean, we've seen this Robotaxi event pushed back, and I'm happy we got the semi-launch, but they're behind Waymo just in terms of like time on the road, time testing these vehicles.
Yeah, the catch-up process is going to be a difficult one for them, but someone who has caught up is Boeing.
Who would have thought that today we'd be talking about the outperformance of Boeing versus Tesla? I would have never imagined the day.
And here we are.
Here we are. And you know, I applaud Boeing for the hopeful continual recovery. I say that very cautiously because I've been here before, but they did announce their second quarter delivery figures, reporting deliveries of around 150 commercial aircraft in the second quarter, bringing their year-to-date total at around 280. But the widely watched 737 program accounted for around 104 of those deliveries, while the company also handed over around 24 of its 787 Dreamliner jets. And on the defense side, which I do think is a hugely important part of some of the recovery we've seen in share price, which is their space and security division reported 36 deliveries in the second quarter, including a mix of new and remanufactured Apache and Chinook helicopters. And year to date, the defense arm has delivered 62 units. But if you just look at actually the month of June, that's when things get really optimistic. It was 60 deliveries, the strongest monthly total in 18 months, highlighting hopefully the improvements and again the return of U.S. jet exports to China. Strongest delivery month since December of 2023, which was just weeks before we saw that door plug blow out midair. So I think that this marks definitely a continual turning point because you have to see some of these financials match the narrative they're trying to push, but finally it does feel like we're getting there.
And who would have thought that we'd be having a Tesla to Boeing pivot where Boeing's in the positive, but
No
you know,
kidding.
for them, it's been a long road, a multi-year road at this point for them to sort of get back on track, and we'll have to see if it continues in this way. And we have to talk about Meta. And Meta versus Apple, I guess, is what we should really call it, not Meta and Apple.
Yes, Meta versus Apple, as we did see a lead executive of Apple that oversees their various AI models is now departing, of course, Apple for Meta, which is according to first Bloomberg reports, but now we've seen, I mean, this is just the latest string of hiring from Meta, who's been aggressively expanding its AI dominance through its Superintelligence Labs, otherwise known as MLS, which was launched back in June of 2025, so just about a month ago, to pursue this continuous generative AI build. And also fairly, I would say, in terms of their large language models, that's a huge portion of where this talent is expected to be focused, because that's been somewhat of the laggard in terms of their AI narrative. MLS consolidates Meta's Llamas models and their fundamental artificial intelligence research, otherwise known as FAIR research, to deliver what they're calling this personal super intelligence. But fueling this ambition, they've been poaching top talent from other companies like OpenAI. Sam Altman has been fairly vocal about that.
Very vocal.
Yes, as well as Anthropic and Alphabet's Google, DeepMind, and now Apple. So reshaping the AI landscape as far as this fierce talent war. I think what this more signifies is it doesn't necessarily mean that Apple is like falling apart, because I was just seeing some commentary on that. I think it more so shows the money you're willing to spend right now. We haven't gotten confirmation that it's $100 billion in these $100 million, in signing bonuses, but that's been floated where Zuckerberg is willing to shell out pretty substantial cash. And I mean, of their workforce right now, they have increased some of their spend right now by about $50 billion for around, or $5 billion, for around 50 new employees. So that just goes to show their willingness to spend on these 50 new researchers that are, I think, expected to be pretty focused on this super intelligence arm.
Yeah, and I think you hit the nail right on the head too when you said we've heard a lot of discussion about, is Meta behind in the AI race? Are they taking it seriously enough? Well, if what Sam Altman, the CEO of OpenAI, said about them offering the $100 million signing bonus is true, they clearly appear to be taking it seriously.
They do. They appear to be trying to at least maybe, if you can't beat them, join them. If you can't beat them, steal them.
And if you can't beat them, poach them.
Yeah, poach
Take
them.
their best players.
It makes me wonder why we didn't go into super intelligence and with these signing bonuses floated around.
It'll be our next career.
Yeah, these are hefty paychecks that I think we're all wishing, why didn't we go into this field? But I do wish for more and more of this to be seen as like monetization for Meta's AI, because to spend this much money means you have to be able to prove results worthy of the substantial cash they're spending.
Absolutely. All right, Jenny, thank you for catching us up on the top stories today. We appreciate it. The drama days are always a little bit more fun for us, so we appreciate you being here to catch us up. And that's, of course, Jenny Horn. Now let's turn our attention to the macro side of the market. For that, joining me now is James St. Aubin, the Chief Investment Officer at Ocean Park Asset Management. James, thanks for being with us this afternoon.
Hi, Martin. Thanks for having us.
Oh, we're glad to. So I'd love to just get your overall thoughts. Pretty quiet day overall today, very flat across the board. But what are your just general thoughts about the state of the economy as it stands?
Yeah, aside from the drama you were talking about, it is a kind of a quiet day out there. I think the market, sort of the economy rather, has been sort of chugging along. And I think of the word for 2025 being resilience. Right? Resilience in terms of that economic momentum in the face of tariffs, in the face of geopolitical concerns. But we do see sort of a steady momentum carrying forward this year. There's obviously some certain landmines out there that can be stepped on that we're concerned about. But for the most part, I mean, we're seeing pretty healthy economic data. What I think will be really instructive is what we hear from companies coming up in earnings season, which starts in earnest about a week from today. So that will be really something we're paying a lot of attention to.
And as for, let's first start with earnings season there. What are your expectations for earnings season going forward? I know a lot of people looking to see tariff impact, hoping for guidance from a lot of the companies, even though we did see in Q1 lots of companies choosing not to give guidance. What are your expectations here? Are we going to see beats? Are we going to see lots of guidance? Or are people going to really pull back and keep some of the information to themselves?
Well, first of all, the market's been lowered a lot. I think the earnings estimate at the beginning of the quarter for Q2 was about a little over 9%, 9.5%. Today, that's about 5%. So the bar is pretty low, and if 5% does turn out to be the number for the quarter, it would be the lowest since the fourth quarter of 2023. However, obviously the game in Wall Street is that these sell-side analysts tend to lower numbers to a beatable rate. So I do expect some beats this season. However, I think what most of us will be paying attention to are what the companies are saying, the anecdotes from companies that have sort of boots on the ground, that have are in the trenches every day, getting a pretty good sense of how the consumer is behaving, how businesses are behaving in light of the tariffs uncertainty, the trade policy uncertainty out there. That's what's really going to be most interesting. You mentioned guidance. It's going to be really hard, I think, to give guidance when there's so much still up in the air, right? There's so many of these tariff deals that need to be done. Only 2 have been done out of the dozens that are out there to be reconciled and finalized. So I would be surprised to hear a lot of guidance given about the future, but I would like to hear from companies about how consumers and businesses are behaving under this stress, because I think right now that a lot of the economic data that we're seeing has been distorted by the front running of tariffs. So when I think about what companies like the big banks that are reporting next week, Citigroup, and Bank of America, they have a tremendous amount of data on credit card spending for consumers, loan activity, bank balances. That will really tell us a lot in terms of how consumers and businesses are reacting to the trade policy uncertainty.
Yeah, absolutely. That tariff exposure and how contained it is and how much we might see passed on to the consumer, certainly a concern, and certainly something I think the Fed is also watching too. We get the minutes out tomorrow to learn more about the June meeting. What are you going to be looking for when you go through those as to how they'll influence the July meeting and going forward?
Well, I don't necessarily think there will be any surprises, but you will see some debate. You're starting to hear it in the sort of the public sphere, if you will, already about whether or not a cut for July is something that would be on the table. It doesn't feel like with the strong job numbers we got last week, that would necessarily be something that is a likely outcome. But I would expect from the minutes there would be some more discussion about how fast cuts should start to come, whether that's July or potentially more likely in September or October.
And as far as, the labor market goes with the other part of their mandate, we did get those strong numbers. That latest report was strong, but there have been quite a bit of discussion that there are some cracks underneath that maybe we aren't paying enough attention to. Are you of that same mindset?
Absolutely. I think the headline numbers might be overstating the strength of the labor market. A couple of things you noticed in the June jobs report was the lower average hourly earnings relative to expectations. It was 0.2% versus an expectation of 0.3. So that's something that was an interesting undershoot there. Also, you saw average hourly hours worked decrease. So that was something that was to take note of, and the overall labor force participation drop. So I think those three things in this month's report was something to keep an eye on, as well as we're seeing a rising trend in continuing claims. That's the total number of people on unemployment. It's at a highest level since 2021. So I think if you start to look underneath the surface, beyond the headline job growth numbers and unemployment rate, you start to see some cracks, as you mentioned. So that's something we're certainly focused on, something I think the investing community should be watching in the second half of this year.
And at Ocean Park, what's your base case for cuts? It seems to be there's a lot wider spread now. I think once all the Fed heads couldn't agree. I saw B of A come out yesterday. Their base case is now 0 cuts for the year, whereas I'm seeing between 1 and 2 most other places. When are you thinking we might see cuts, if at all?
That's a very tough answer. I think you've certainly got the base case of what the Fed is telegraphing right now is at least 1 cut this year. So that seems reasonable given the conditions that we see today. A lot of that will depend on what inflation does over the next few months. I think if tariffs weren't in the picture, the Fed may have already cut already. But now they're on hold. They're somewhat paralyzed between a rock and a hard place, seeing some numbers that would, inflation data that would allow them to cut more, to be at least get on the way to neutral. But that's sort of a pipe dream now, that we have to wait to see what happens with inflation on the heels of tariffs. So we still believe 1 cut is the most likely scenario, but I certainly could see a scenario if inflation starts to pick up where Bank of America is right and you don't get any cuts this year. So it's certainly a very difficult crystal ball, a cloudy crystal ball right now to look through for the Fed, because they're kind of flying blind, if you will, in terms of understanding how inflation will ultimately permeate throughout the economy.
And James, one final question for you. You mentioned some landmines in an earlier answer. Obviously, I think inflation is probably one of those. What are a few other of those landmines that you think could blow up the market as it stands?
Well, look, we're not through the whole tariff negotiation. I mentioned that earlier. There's only been 2 countries that have finalized deals with the United States. In the last couple of days, we've started to ratchet up the trade rhetoric again. So the market sort of is becoming, in our view, a little bit complacent about that risk, that we could end up back in the sort of tariff purgatory, if you will. And right now we have very high valuations, as I'm sure you've talked about many times, in equities. On the S&P, you're still at a 22 times multiple. You have very tight credit spreads. So I just look at this market as having sort of a low ceiling and also a low floor in terms of sort of cracking that narrative of resiliency that I was talking about. Resiliency being the common theme you're hearing everywhere, that the consumers being resilient and businesses being resilient. Well, if that resiliency starts to fade, I think there's just a lot of room to fall in terms of valuations. Not necessarily thinking that there's a recession, we're not looking at that, but certainly when you have high valuations, you have the curse of high expectations, and I think that's what the market's sort of biggest risk factor is today.
Well, James, we really appreciate you joining us this afternoon. Thank you so much for the insight. Again, that's James St. Aubin from Ocean Park Asset Management. And coming up, Amazon Prime Day is underway as a summer retail sales showdown is on. Does Amazon have the upper hand over Target and Walmart? That and more when we return on Market on Close.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Big boing. We're at 9:39 minutes, and we just had a little bitty breakout.
Whether you're an experienced investor or just getting started, Charles Schwab offered
The 6235s.
Welcome back to Market on Close. I'm Marley Caden. In case you haven't heard, today kicked off Amazon Prime Days, which will be going for 4 days now. Adobe estimates that the Prime Day event could drive record sales to almost $24 billion through that 4-day stretch. Joining us now to discuss all of this is Owen Carr, the Chief Merchandising Officer for Spreetail. Owen, thanks for being with us.
Thank you. Hello.
Hello. I guess my first question is, have you bought anything on Prime Day yet?
Well, I haven't bought anything, but I've been selling a lot of things.
Okay, all right, that's good, that's good. I have, however, bought some things.
Nice.
You know, this is the first time they've kicked off this 4-day Prime Day spree, which really we should call it like Prime Season, as there appears to be one every season now, and it's not a once-a-year thing. How do you think that that's going to influence things versus it being a longer period now?
Absolutely, it's a great question. Amazon has had Prime Day for years, and it's always been 2 days, which is always funny because it's called Prime Day. But this year, changed it to 4 days. You know, we expected that brands and partners that we have, we work with over 200 brands in the durable hard goods space, would spread deals out over that time, and so we wouldn't see the big day one peak of that sales period, but would be spread over 4 days, and that's exactly what we're seeing. There's still a lot of really great deals out there, and there's a lot of momentum, but the day one peak is not as much as we would have expected or have seen in the last couple of years, as customers and brands are spreading that over the 4-day period. A few other factors as well is that Amazon moved Prime Day up a week earlier, and so now it's falling within just a couple days of July 4th versus a week later. And what that does is that actually pulls customers more into purchasing summer type goods as opposed to back to school goods. And so that does change the profile of purchasing. And overall, so we see a few factors that are changing the dynamics of what's happening in the space today, but we continue to see a lot of customers shopping right now, and certainly big numbers that are taking place online.
And sort of what's the expectation just domestically for what this is going to look like for Amazon? Is this expected to outperform last year? Obviously, we've got 2x the length. It's not 2 days anymore, it's 4. But overall, is it expected to be a better sales period for them?
Absolutely. So it's retail. We're one of the largest third-party sellers on Amazon. We also work with the other major marketplaces, including Walmart and Target, and we do over $1 billion of sales. During this time period, we would expect growth rates in the 20 to 30%. So looking year over year versus the similar promotional period of last year, so a week later, we would expect to see sales grow in that 20 to 30%. We still expect that to happen over the 4-day promotional period. And I think that Amazon, Walmart, and Target, and others that are chasing in and partnering to try and provide great deals to customers are also looking for that type of growth rate. And so that's what we would expect even in this environment. And they'll be pushing a lot of deals and volume to do that. Now, we are seeing the deals that are going out right now are very good, lower prices in some cases than last year, lower prices than items have been ever. But we're also seeing not as many deals. And we think that that's being a little bit impacted by tariffs, as many tariffs are still coming, and folks have had inventory that maybe they had 90 days of supply or 180 days of supply. We've seen folks be a little bit more hesitant to push price decreases when they know that they're about to absorb a tariff. But we are seeing the deals that are live are very good, and certainly there's a lot of deals that are already done because they've reached their caps or they've sold out of all the available stock. And so now customers need to go find other deals to look at.
So with some of that inventory pressure, you think a lot of the sellers are sort of front loading those deals and not necessarily holding them off for days 3 and 4 of the Prime days?
I think it's a mix. I do think most deals will go out on day 1, and that's standard for these types of deals. And so your day 1 is going to be your biggest day. But I do think there'll be a little bit more spread from day 1 into day 2, day 3, and day 4. And we're seeing that right now. Day 1 is coming out strong, but not as strong as it has been in years past. And right now, our read is that there's a couple factors. July 4th, folks coming back to the office, and then also just knowing that there's a 4-day period is spreading customers into looking at deals over that multiple day horizon.
And you mentioned that you also work with some of the other big box retailers. Amazon not a physical, well, they do have some physical presence, but certainly not in the way Target and Walmart do. I did see Walmart is doing their 6 days of summer, which happens to perfectly overlap the Amazon Prime Day period. Are we seeing direct sort of anti-Prime Day competition from the other retailers?
Absolutely. I think that Amazon's been doing Prime Day for many years now, and I think the other retailers understand that this is a time where customers are looking for deals, and whether they be summer type items or back to school, etc. And so we absolutely are seeing aggressive behaviors amongst Target, amongst Amazon, Walmart, Lowe's, Wayfair, and Kohl's, and many of the other partners that we work with online to take share. And they're seeing great volumes. Right now, when we look at our data and we sell on 20 marketplaces, we actually don't see any one channel demonstrably taking share this year versus others. We think Amazon's doing a fantastic job in getting their share, but Walmart, Target, and others also have some great deals, and they're moving through volume.
And with that shift of it moving it a week up, you said it focuses that spending, the consumer spending more on summer items as opposed to back to school. Is that going to influence back to school spending, or should we expect another surprise from Amazon and they're going to pop out with another Prime Day period ahead of back to school?
Yeah. I think every retailer is different in terms of their strength in back to school. Amazon probably has had more strength in summer type items, whether that be pools or sheds or lawn improvement items versus, say, traditional pens and books and paper and backpacks that would weight more heavily towards the brick and mortar retailers. So I do think it's a benefit to Amazon to shift it up earlier. However, I do think we'll continue to see strong back to school deals as folks get ready for the fall. It's just that this event will weight a little bit more heavily towards those summer items, which in many cases is helpful. The summer across the U.S. has been a little bit more wet and certainly had mixtures of temperature, and there's been a lot of early importing of goods that were summer goods that were pre-tariffed. And so I do think there's a lot of retailers that are looking to get those summer goods sold out this year so that they can have clean shelves ready for next summer when it comes.
And are there specific categories that you expect to see the most action in during this, not just even for Amazon, but even in Walmart and Target sales as well for this period, as it is slightly going to be more summer focused? Is it apparel? Is it footwear? We know it's likely not back to school.
Yeah, you know, in the data that we see, we are seeing apparel and footwear a little bit softer, but overall home goods, outdoor recreation, lawn and garden, sporting goods have all been very strong, and we continue to see those goods do really well. Of course, additional categories around supplements and other items also continue to be very strong, as I think customers are thinking about those items as well. And so those are some of the categories that we see strong. We focus in the durable and hard goods space, goods that are for your home. And so, for instance, saunas are a big category for us around health and benefits there, and we're seeing those items almost sold out of stock now. There's just been so much demand for some of those goods.
Well, I have a second cart full of items waiting for me, Owen, that I'll probably take care of during the commercial break. But we thank you for joining us and for all the insight today. That's Owen Carr from Spreetail. And coming up, we've got Options Corner. Rick Ducat will join us with the levels that we're watching going into the close. And we'll take a look at the options activity in one of the top movers on the NASDAQ today. That's Intel. We're back after this.
It's now 2:30. Pot stocks moving. At least trade the heck out of them. Tilray.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your
not too bad of a
goals,
day.
you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Today's Prime Day, huh?
Welcome back to Market on Close. It's time for Options Corner. Rick Ducat joins us, of course, our lead market technician here on the Schwab Network. And we're looking at the NASDAQ right now. So before we jump specifically into one of the big movers, what levels are you seeing for the day? You know, I'm looking at the charts and it's just a pretty flat day overall.
Yeah, good afternoon. Not really too much of a change at all in the NASDAQ here. If we were to look at our shorter term chart, a 20-day, 1-hour chart, we can see that the price action has mostly just been progressing within the boundaries of a rather shorter term channel there between our two white dashed lines, mostly just hanging out between these two areas where we can connect multiple lows and multiple highs to give us these boundaries here. Another important area on the short term chart, our green line there, 22,040 represents an old high and then a subsequent low after we saw our gap up, so could be a downside area to watch. But to bring it forward more to a 1 year, 1 day chart, we can see that for now, it's seeming like price is kind of just hanging out above our previous highs. We haven't made too terribly much of a huge breakout above those previous highs near 22,140. For now, RSI also exhibiting a little bit of bearish divergence, trending downward as price makes new closing highs here. So a bit of a question mark here for this general tech sector here. A lot of tariff-related news sure to still come down the pipeline.
But we are looking at Intel. You know, they announced that they're going to lay off more than 500 employees in Oregon as a part of their broader cost-cutting plan. It did appear the market responded pretty positively to this. As I look at them right now, they're up 7.5%. We also saw quite a bit of options activity with them as well, right?
Yeah, for sure. And you know, really, the big story, like we said, is the AI boom and the general state of the tariffs. That's what's really affecting all these chip makers here. You know, yesterday there were more reports that the Trump administration is making plans to restrict shipments of these advanced AI chips to Malaysia and other countries with the goal of preventing them to get to China here. So there's all kinds of things happening in this arena still. But we can see in terms of the chart for Intel, we can see that we are pushing to the upside. We are halting right now at our purple 252-day exponential moving average just below the 24 level. So that could be an important boundary for the bulls to break above and continue this uptrend here. In terms of the options market, about 572,000 contracts traded, 55% calls, relatively heavy volume. The sizzle, when I checked earlier, was around 3, so 3 times the 5-day moving average. Most of that activity, July 11th and July 18th expirations here. On the call side, 21 to 25 is where most of the volume lies. On the put side, more like 17 to 23. In terms of open interest, July 18th, the monthly expiration, the expected move 21 to 26 or so, roughly about a plus minus 10% gain or loss there. A lot of open interest, 22 and 23, also at 30 on the call side. The puts, 17 to 21, that's where most of the activity is. But actually, the highest open interest of all comes in around that 16 strike level here. So really, rather narrow range here where we're seeing much of the activity here, centered mostly in the areas around the low 20s.
You know, and makes sense. Right now we're at 23.68. That's where they're trading. You know, as I'm taking a look at this chart, you've got your 1 year chart out here now. You know, what's this indicating for us? Obviously, you know, we can see April where we descended down towards that low, that 17 mark, which is where you said a lot of the puts are staying. But now, you know, we're creeping up sort of above your first level of resistance and heading up closer to the 26 mark. I don't know if we'll continue in that direction, but what's that indicating to you, Rick?
Sure. So this chart, that shaded area is showing the expected move for that July monthly expiration here. So kind of factoring in the potential for that plus minus roughly 10% move. You can see that those boundaries, I said before, 20 to 26 are 2 green lines. That's where most of the call open interest is for this expiration. The 2 red lines, 17 to 21, that's a similar area for the puts. You can see most of the call activity is kind of centered around that expected move area, whereas a lot of the puts seem to be quite a bit lower here. And, you know, maybe traders taking opportunity of this consistent supportive area that we've seen at these lows around 18 to 19 or so. A pretty solid, for the time being, seemingly at least a foothold there for this stock.
Well, Rick, we appreciate it. Thank you for taking a look at Intel for us this afternoon. Enjoy the rest of your day. Yep. And coming up, we'll discuss the metals market, more specifically copper, which sparked to an all-time high after President Trump announced a 50% tariff on copper imports. We'll dive into it next on Market on Close. Stay with us.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab,
Yes,
how I
it
choose to
is.
invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out there.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services.
Well, if it's going to happen,
Schwab Network, available anytime, anywhere, on any device for free.
it needs to happen soon.
Binge watch the market with the Schwab Network.
Oh, Moonrock. Hey!
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor
Back to the
Checking, you get the award-winning features of our
230s.
checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals
19 more
worldwide,
minutes.
no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Welcome back to Market on Close with a developing story. Copper prices spiked to an all-time high today after President Trump announced he is imposing a 50% tariff on copper imports. The president suggested more steep sector-specific duties are on their way. He did not say specifically when that tariff would take effect. Now, copper is a crucial component in a variety of goods, including electronics and machineries in cars. Tariffs on coppers could potentially make those goods more expensive for Americans. The U.S. imported $17 billion worth of copper last year. That's according to the U.S. Commerce Department. Chile was our largest foreign supplier of the metal, shipping $6 billion worth of it to the U.S. last year. So no word on when these might take effect, when they possibly could take effect, but they did surge to that all-time high as he plans to levy tariffs on that red metal. Copper futures were trading as much as 15% higher on the day. And coming up, we will close out our market session and get the big picture from the team over at Charles Schwab. Stay with us.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is...
Yeah, I ain't gonna be in too much of a hurry. I've had a good day. I don't want to ruin it. $15 more minutes left.
More of it coming out. You know, what are your thoughts on the week so far?
You know, you are right. It is a relatively quiet week, especially if you look at the data that's coming out. So really, there wasn't really anything that's notable this week. I should say notable today. Later this week, we're going to get the weekly unemployment claims, jobless claims. I think that that's going to be an interesting thing to watch because it ties into Fed policy. And ultimately, what we're starting to see is a little bit of a softening in the labor market. Now, that wasn't necessarily something that was confirmed by last week's jobs report. So we'll see if that signals that maybe unemployment claims are continuing to tick up. That's been something that we've been closely following, closely watching, because if it does appear that the labor market is softening more than expected, I think that that's what would give the Fed a green light to go ahead and to cut interest rates. But like you mentioned, if you look at the movement in terms of yields today, it's pretty light. We're not seeing much in the movement of the 10-year or even on the short end of the yield curve. And I think that that's just attributable to the fact that we didn't really get major market moving data this morning. Obviously, yes, we're getting a little bit of tariff data, but that's going to be back and forth. So for now, I think we're in a little bit of a holding pattern until something can break us out one way or the other, Marley.
Absolutely. And, you know, you mentioned
they're trying to figure out what it would be.
Some more jobs data to reveal what really is underlying in the labor market. But we do get the Fed minutes tomorrow. Is there anything specifically that you're expecting or anything that you think could potentially change the thinking of the street as it stands right now?
You know, I really don't think that there's going to be really anything that changes the thinking of the street. I think all likelihood is that a July rate cut is off the table. Our expectation is that we are going to get 1 to 2 rate cuts this year, depending on how the data evolves. And probably September is shaping up for that first rate cut. But in terms of looking at the minutes themselves, I think what will be kind of interesting is to see how the Fed kind of pieces together the diverging views. So if we go back and think about it, when we got the dots plot, there were a number of Fed officials that projected 2 rate cuts this year. There was also a very similar number of Fed officials that projected no rate cuts this year. It's kind of a barbell approach of what Fed officials believe is going to be the likely outcome this year. So I think it'll be interesting to see if they make any sort of a mention in the minutes to try to bring together those diverging views.
And it's funny you mentioned that too. We saw that sort of much wider spread than has ever really been seen before, and quite vocal public action from some of those Fed heads saying, I'm one of the people who felt we needed 2, I'm one of the people who feels we need 0. Now the banks analysts are weighing in, B of A, their base case is now 0 cuts. What would have to happen for that to actually transpire?
I think if we continue to see the economy perform relatively well,
nice little run,
like we have seen, I think that pairs back the number of rate cuts that we would expect to see. Also, obviously, big tariff news is what's happening today. Those were pushed back to the August deadline. So I think that's going to be a notable thing of what happens ultimately with tariffs. President Trump said that no more negotiations after that April 1st deadline. So if we do get higher than expected tariff rates, and that drives up inflation, maybe causes a slowdown in growth, then I think that would cause the Fed to maybe cut a little bit more aggressively, probably put them in a pretty difficult spot because you would see higher inflation, slower growth. So that's not a stagflationary environment that they want to be in.
Absolutely not. And as we think about, what that sort of looks like for the yield market, which seems, bonds so responsive to all of this, what are you expecting, as we move through the summer in terms of what we're seeing? You mentioned it's a quiet day today, but that certainly hasn't been the case in the last few months.
Yeah, you're right. We did get some fireworks. So not just 4th of July fireworks this year, but we have seen some fireworks. So our expectation, Marley, is that we should see the yield curve steepen as well. So being led by lower short-term yield. So again, our view is that the Fed is going to cut interest rates this year, but it's dependent upon, it's a matter of how much do they cut it by. So if we do see the Fed cut interest rates, my expectation is we should see lower short-term yields. As far as longer-term yields, we think that they're probably relatively anchored here. If you look at the term premium is just the additional compensation for holding longer-term bonds relative to rolling over shorter-term bonds. That's moved up and it's still above where it has been post-pandemic averages. So that kind of puts a floor under longer-term yields. Also, if we look at global yields, those have moved up. So kind of puts a limit on how much lower longer-term yields could go. So that's one of the reasons why we do think that the yield curve will likely steepen later this year.
Well, Cooper, we really appreciate you joining us this afternoon. Cooper Howard from Schwab Center for Financial Research. And we did just update you on that news about copper hitting its all-time high. So it is time for us to dive right into metals now. For that, we welcome in Joe Cavatoni, the Chief Market Strategist for North America from the World Gold Council. Joe, thank you for being with us.
Great, Marley.
We're glad to have you, and especially on a huge day for copper, spiking to that new all-time high. President Trump, of course, announcing this 50% tariff. Did you see this coming?
No.
To be honest with you, respect to tariffs and respect to critical minerals or strategic minerals or any metals or that's going to be vital to the future of the U.S. when it comes to defense, energy, etc., I think anything is on the table, anything is possible. Did we see this coming? No. But ultimately, what I'd say is this administration has made it very clear that the dependency on foreign nations to source critical minerals or other assets is vital for them to address it. So I think that this action speaks volumes to it. Now, specifically as it relates to gold, we appear right now to be in good stead with respect to how we're being treated from a tariff perspective. But look, everything is possible, and I think that the deadline being moved out to the August date is just that. It's just moved the date.
62:30s. We got 7 minutes.
About dealing with how we source and where we source our minerals from.
So you said it's been favorable to gold. because there hasn't been much impact. Do you expect there to be any changes moving forward with gold? Will the administration look at gold as a potential metal to put a tariff on?
Everything is possible, but right now what the signaling is that we're getting is
This
that
guy's
right
funny.
now gold is being deemed predominantly as a monetary metal as opposed to a critical mineral.
Everything is
Defense
possible.
Applications, telecommunication applications, those aren't areas where gold mainly plays a role in the economy. It plays more of a role in savings. It may play a role in terms of growth, in terms of portfolio holdings, central bank reserves, etc. So it's strategic in nature, not on the critical minerals list as deemed by the administration or previous administrations as well. But what it does do for us is that when metals move across borders, it can cause logistical challenges. So we're keeping a close eye on what and how these tariffs are developing. We had an earlier move in the gold price, which was very momentum driven, that related to gold being brought to the U.S. to support futures contracts that had a physical delivery element to them before there was clarity on exactly how it in its raw form or in finished form and wholesale levels would be deemed from a tariff perspective. That's all clear for us now. But look, nothing's fine until it's final, so it could change.
As we have seen so far this year. Now, gold holding pretty firmly in that sort of 33, just north of that 3,300 level. You know, not a ton of movement despite some trade talks easing and some easing geopolitical tension. Do you think that that indicates that the market might be a little cautious right now?
I think the market's trying to assess this information that comes fast and furious, and your previous guest just talked about this, and it's not easy. It's not easy to ascertain exactly what tariffs or trade negotiations or a lack of trade negotiations could mean for anything. So what moves gold on the tactical side is momentum and opportunity cost. If we see the Fed moving rates early or later in the year, that opportunity cost is going to be good for gold on the short term. But on the tactical side, people are moving quick to try and assess whether or not momentum is going to move the gold price. For us, we look strategically at what's happening with the gold market right now, and we need to see some real fundamental changes for us to break out of this range-bound area where we are right now. We're up nearly 6% year to, and that's very aggressive versus kind of annual expected levels of return closer to 8%. So yes, we've run up. There's been reasons for that, but right now I think we're going to hold out until we can get some bigger, stronger signals to what's really playing out from the economy. The Fed's going to behave, what's going to happen with the dollar and dollar-based assets going forward, and that's what's going to move us more strategically beyond these levels.
Damn, I missed that.
And are there any supply or production pressures that you need to be cognizant of too as you watch
Well, the
gold
puts
and
paid
where
off.
it might be moving in the future?
I think at this stage, the production levels that we're seeing and our expectation are in line. We've seen for the last few years, still growing at that 2.5% rate on an annual basis. The mining companies, while consolidating in the large scale end of the market, are still making good opportunity to take advantage of the higher prices and still performing above the all-in sustainable costs. Right now, I think what we're thinking about is whether or not the smaller scale mining that's actually done in the artisanal way is actually going to be continuing to grow. Could that be something that we need to be careful about? We're looking at an initiative now to really try and clean up that end of the market. That's about 20% of the demand supply that comes online. So for us, we think large scale mining looks good, growth at about 2%. It's that small scale mining space that we're keeping a close watch on. And then what hasn't actually surfaced as much as we would have expected at higher prices is receipt of gold. That's when jewelers, fabricators bring gold back into the market and simply say, I don't need to hold it any longer. I'm going to deal with it in the recycling end of the market. That's been telling us that maybe fabricators are saying there's more price run for gold in the near future. So they're holding back on the recycling levels.
And we know we've seen increased demand from the central banks, you know, particularly in April we saw a rise in it, but just in recent years as well. Are we still seeing that heavy demand coming in, the heavy buying from central bank? Are they still the biggest net buyer of gold?
Well, they are about 20 to 25% of the annual consumption of gold in the last going on to 4 years. Now, it's been a 15-year trend that central banks on a global scale have been net buyers. I'd encourage everybody to take a look at our annual survey that we just published this month. And the central bank space where we talk to 73 different central banks around the globe. 95% of them are saying gold's going to play a key role for all central banks. 50% of them are adding more gold to their reserves over the next 12 months. And ultimately what it's telling us is that they're looking at their reserves. They need certainty around how assets will perform. We expect them to be at the table. And our gold demand trends report, which we'll be releasing in a few weeks, will give you the second quarter total number, and you'll probably see that to be another strong quarter for central bank demand.
Joe, we really appreciate you joining us this afternoon.
We sure do.
Tony from the World Gold Council. Coming up, we've got the closing debt.
Definitely a tight day today. Listen a minute. Yeah, and that's it. What a day. Patient day.